Hello traders, welcome to another Supercuts. If you're just tuning in and putting us on the background to learn some trading strategies, hope you enjoy it. We're going to cover a lot of the recent ones on this channel again in one long edit so you can listen to them back to back from start to finish. Anyways, hope you enjoy it. Make sure you like and subscribe for more. I'll eventually get back to putting up more new content. I've been kind of busy with life. Started something else different, got into another thing, ended up like sort of accidentally the director of a charity and some other BS. But anyways, I'll make some more YouTube content eventually regarding the trading stuff. So make sure you watch up and talk to you soon. Thanks. Hello, I'm the Augur, and the channel is TQFM Trading Strategies. I trade stocks and options and make content to help you take your own trading and investing to the next level. So if that sounds awesome, make sure to like the video and subscribe to join my little growing Augur army and help us grow, take over the entire world with future talent. Starting out in trading is really tough. I remember exactly how hard it is to learn how the market works and how to use all sorts of technical indicators to understand price action and market structure. You can spend days and nights just staring at the market trying to understand it, pulling out your hair. And this video is for you to help you understand exactly how that market works and help us all become better educated traders and investors. So in order to do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of math and indicators. All this math is specifically designed to peel back the mystery behind price and the markets and help us understand what market makers and algorithms are doing to move price around and target you and other retail traders. So make sure you watch all the way through the end so you fully understand everything we're going to cover today, so you can learn as much as you can to help better defend yourself from everyone who's out to get you. So in this video, we're going to be taking a look at how to use a double Ichimoku Inko Hayo for either scalping or some sort of swing trading. And you can use it on the 1 minute chart, the 5 minute chart, whatever you want to do. It basically is just using the fractal patterns that are present in the market to better understand trend and make decisions based on that. So what we're going to do today is we're going to talk you through how the strategy works, how to set up the indicators for the strategy, entries and exits for both bulls and bears. And we're going to do a little bit of back testing to see how it works using real market data to see if the double Ichimoku strategy is helpful and useful in today's marketplace. So let's get going. So this strategy is actually quite similar to a lot of the other strategies I've shown on this channel, where it operates on a sort of trend inside a trend function. But the Ichimoku Inko Hayo is a very interesting indicator, which has several trends inside of it already. So it already does a somewhat decent job of displaying the sort of fractal pattern I look for in the markets. And this is just deviation over time. It can deviate a little bit or it can deviate a lot. In either way, it always reciprocates back to a mean over time, because that's just a function of mean reversion and moving averages in general. It doesn't mean that it's going to be higher or lower when it gets back to those means. It just means it's going to get there eventually. At least when we're talking about the shorter term charts. If you go out to like a monthly chart or a yearly chart, it doesn't actually have to get back to the moving averages. Inflation, growth, other things, keep it far away from those for, well, ever. You will die long before it gets back to a 1,000 year moving average, I bet, but who knows. Anyways, back to this. The way this strategy functions is similar to a lot of other ones. We're looking for it to, well, the way the strategy works, let's break down how the indicators work first. You're going to have two Ichimokus. The first one you're not going to touch. It's just going to be your standard settings, conversion line of 9, baseline of 26, a leading span of 52, and a lagging span of 26. I usually turn off the lagging span. The second one, the slower one, is just going to be twice as long. We have an 18 conversion line, a 52 baseline, a 104 lagging span for the B length, and a lagging span of 52 for the initial. And I go ahead and turn off that lagging span, and some other ones for the slow one, so because those are actually just going to sit on top of the other lines, so you don't really need too many other ones. What you really want to look for is you got these two fast lines here, and then you have these two slower clouds. When the fast lines break below both clouds and price is trading below both of those, you can look to take a trade in that direction. You can use the clouds as your stop, and what you're looking for is a fractal exit. And let me explain how that works. You see, you have a bunch of lines here, the blue one, the red one, the greenish one, and the orange one. And those are all going to be ones that aren't part of this white cloud. So if you're using the white cloud at stop, at your exit, you want to be taking profit on a faster fractal of some measure. So watch what happens. It breaks down below this and the trend is continuing. This fractal line, this mean reversion, is going to push, and then it kind of makes this little, basically it's making a trend right as it goes. And then when this orange line encounters price, that's usually an exit on a fractal trade, or at least a trend trade. This one didn't work amazing, but it's just an example of a bearish trade. A lot of them do work great. And really, all this is about the risk to reward. You can get a really tight entry with a little bit of risk and a decent play on it. The idea is, well, hopefully you get a decent, you're looking further back to optimize this with some sort of support and resistance or something like that to get better entries. But worst case, you can always use the fractals. So let's look at some more of these fractals. So let's look at a couple more of these fractals. Let's look at the next one. It comes up, it's say you stopped out of there or you didn't, either way. It comes back down here, it gets back up into these little lines here. Let's say you're going to take another trade. So you're going to take a short again, your stops are going to be above this cloud, and you're just going to let it trend. And you're going to see let's use the orange line here. And you can see the orange line working its way along. You kind of just drag a line, just keep dragging that line. Just keep dragging that fractal line. And it's going to get all the way down here, and it's going to hit price either here or down here. And that'll be your fractal exit. See, you entered here, you started tracking it at literally the same price, and you just dragged it down the entire way. Let's look at this trade to the upside. It comes and breaks out of these. You can take a trade anywhere in here with a stop down here. That's about 3-4 points. Then you're going to follow it up here. You start drawing your line. You start drawing your line, following the orange one or the green one, or following the orange one in this case. Drawing your line, drawing that orange line, drawing that orange line, drawing that orange line. And somewhere up in here, it smacks the orange line and it cuts you out. And you see that's a really good trade. It took, maybe 6 points in risk, and you made 18 or so. So there you go. So some of them have really good risk to rewards, and even some of them that don't work, like if you look at this one here, it definitely didn't work, right? Come in, you breaks out, wait for it to get back in between these two lines, take a trade, you're looking down here at like either the green one or the red one. Let's use the red one, we've been using the red one, so, and track it along, you're hoping it goes up, and it just doesn't. So somewhere in here, there and there, you take your loss, and that's still a very small trade. It's honestly, the bars that break it are like almost touching bars that touch your entries. So it's almost the same price. And it actually saved you, if you think about it, taking your loss there versus taking your loss there, it saved you a point or two. So when you're only taking a couple points in risk on these sorts of trades anyway, saving a point or two on taking it on the first fractal versus the other fractal. Alright, and to test out the double Ichimoku strategy, I've gone ahead and set up a back test on Ethereum. So we're going to go ahead and run 100 of those, and I'll be right back with you after the quick little montage. Back with the back test. You can see it performed pretty admirably. We took 100 trades, we had 36 winners, we had 64 losers, so we had a 36% winning percentage. Our average win was $46, our average loss was $12. So that's about a 3.75 risk to or reward to risk ratio. It took us about 12 days or 4,600 bars. That could be a quite large annualized leverage return. Granted, it doesn't go bust. You can see it had some big winners and then a bunch of little losers. And it's kind of how it looked like in the beginning and kind of how I explained it. So it did sort of how we expected it to do. But it was a pretty trendy market over the last couple of weeks where we tested it, so it might not perform as well in a choppier market. That being said, make sure to backtest it on your own time frames and tickers to make sure you've learned everything you can about this strategy to help you in your own trading and investing. Alright, thanks. Glad you. Well, thanks for watching. I hope you enjoyed it. If you like that, you'll like my other ones on my channel, so make sure to check those out too. And I hope you have a wonderful night. Bye. Hey, welcome to the channel. This is TQFM Trading Strategies. I trade stocks and options, make videos about it, and to help you take your own trading and investing to the next level. So that sounds cool. Make sure to subscribe and like the video, and check out the rest of them. So today we're going to be looking at a strategy utilizing 3 RSI in a sort of waveform function. This will allow us to look at trends, support and resistance, and make all sorts of trades, long and short. Okay, so in this video, we're going to break apart the strategy, how it works, talk about the indicators involved, the settings for those indicators. They're all free and available for anyone to use, so you can set it up yourself, follow along. Then we're going to run a bunch of tests on the strategy to see how it performs using the historical market data, all in an effort to better understand the market to make us all better traders and investors. So let's go ahead and start off with how the strategy works. So this strategy works, well, it's kind of simple to see in this couple of setups. You run a series of RSI with stacking lengths. When the faster length RSI crosses over the 2 slower ones and holds it, it's going to show you that trend is building in that direction. When it's reciprocating back and forth, this shows you how price is behaving inside of a range when they all get stacked up and tight like that, meaning that it's all over these last couple of time frames, it's all within the same blocks. So it's more of a square market than a line, if that makes sense. Square market, all bunched up, line, all spread out. So 2 kinds of markets you can have, either a consolidating one, or it's a box, or a line, or it's a line. So this is how we're going to set up these RSIs to understand what we're looking at. The fast one is going to be your standard setting, and just keep it at 14. The second one is going to be about twice as long, about 30, and the third one is going to be twice as long as that, so about 60. That gives us this triple RSI setup. So the trades themselves, in a ranging environment, you can see that the RSIs are not making any higher lows or higher highs or higher lows, and reciprocating around the middle. So what you can do here is, as long as it's not breaking out above the top or below the bottom, you can trade it back towards the middle, if that makes sense. So if it comes up, you can trade that back towards this middle line here. It goes down below it, you can trade it back towards the midline. It goes up, you can trade it back towards the midline. It goes down, and trade it back towards the midline. Until it breaks one side or the other. See how it's broken out of this range right here. At that point, you're going to probably, or if you haven't already, you want to switch to more trend trading. Trend trading with the triple RSI is waiting for it to cross below here, and you can take a position and you can hold it until it gets all the way back out, or take it any time you have profit in here. Same thing on the upside. It crosses up, take a trade, and you can take it at any point in here that you like, or when it crosses back over down here. And then going the other way, you can take a trade anywhere in here, and you can sell it in here, or when it crosses back over. That'd be kind of a tough trade. It's kind of scratch if you wait for it to cross back over. It just gets back into consolidating there. But if it goes from trend to consolidating and you're still in the trend trade, just wait for it to chop back down to where you consolidating for you, right? So with all that being said, let's hop back into some back testing and run a bunch of trades and see how it performs. You can see some good sample trades there. You see this one coming here, breaking down below, and take it anywhere in there. You can sell these, put a stop up there, and you can ride all the way down. It's a nice 6 or more risk to reward ratio trade there. It comes up on the upside here, breaks back above there, and buy that. Stop at the bottom and trade all the way up there. It breaks back down there, and you're about flat. And you have all that time there to take your trade off and make profit. Comes up here, breaks above there, and bottom there, and then you got all this. And if you're not up by there, you kind of messed up. And it's another great trade. See this guy here, it comes, breaks up there. Take that to the bottom of there, and right there. Look at that. A short trade here, anywhere in there. Alright, well, thanks for watching. I hope you enjoyed that and you learned something about the markets. That'll help you become a better trader and investor in your own activities. And with, all that being said, I hope you have a great night, and I'll catch you later. Remember to like and subscribe to the channel, and, yeah, bye. I remember when I first started trading, it's very difficult to learn how the market works and how to use common technical indicators to understand price action and the market structure. You spend days and nights staring at the markets, trying to understand price, pulling out your hair in frustration every time you've entered the market, and it's immediately gone and stopped you out. Well, this video is for you, to help you understand how the market works, to help us all become better educated traders and investors. In order to do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of indicators. All this math is specifically designed to peel back the mystery of price and help us understand what the market makers and algorithms are doing to manipulate the participants and target them and you and stop out your trades. Make sure to watch through the end to fully understand everything we could learn from back testing all these indicators using real market data, and to help you better defend yourself from any hedge funds and market makers using high frequency algorithms to target your account. In this video, we're going to take a look at data back testing a 1-minute scalping strategy using common free indicators that anyone can experiment with, so you can learn more about the market and run this test on your own time using your own data. I'm going to start by covering how the strategy works and the indicators involved, any settings we need to change to set this up, and then I'm going to go over the specific entries and exits for long and short trades. Then we're going to go over a 100 sample backtest to see how it performs using real data. So, with all that said, let's get right into it. So this strategy is a quick 1-minute scalping strategy. It works using an EMA, 2 EMAs, and a RSI. Your first EMA, your faster one, will be set at 10. Your second EMA, your slower one, will be set at 30. Your RSI is going to be sped up to be about 7. And the reason we do this is we want the RSI to be a little bit faster than the white one, and both those to be 3 to 5 times slower, or 3 to 5 times faster than the blue one. And we get a sort of trend inside a trend mechanism, and we can scalp the extensions. This is sort of a hot potato type strategy where we're buying into the extension and selling as it leaves. So for instance, a long position would be with the white trading above the blue and the RSI breaking through the top band. You can buy that close, you can put a stop at the bottom of this bar or the bottom of that bar with a 200% profit ratio, or a 2 to 1 reward to risk ratio. And you see that one got it there. Let's look at another long trade right here. The white is above the blue and the RSI is crossing into the upper portion. So you can buy this close, the stop at the below of this bar. You can look for about 2 to 1 risk to reward ratio. See that it came very close. Just hold it there. You kind of want to close below. I don't like these little ticks. You set it down there. Something like that. A short trade is going to be somewhat similar, where let's do one right here. The white is trading below the blue. It crosses through the bottom. Also cross to the bottom there, but it's hard to say. So this one's easier to say. Nice big bar. Stop at the top. Let's go to the next one. Maybe like that. You would have gotten stopped out of that one. Let's find one that would have worked. There you go, right here. So it comes down. The white's below the blue. Crosses through the bottom. You can short this close. Stop at this top of the last red one. And you're looking for a 2-to-1 restored ratio. Would have gotten the next bar or two. So sometimes they're very quick trades. Sometimes they take a couple of bars. But most times they're very quick. This one comes down. You can short that close. Take it to the top of this bar here. Look for a 2-to-1. You didn't get it. You get stopped out. The idea is to win. Try to win about half of them with a 2-to-1 risk to reward ratio, which will give you a nice profit to loss. So with all that being said, we're going to give it a quick test, run it through 100 trades, and we'll see how it performs. And I'll see you guys on the other side. Wow, that was fun. And I'm back with the back test. If you enjoyed all of that, make sure to like and subscribe to check out the rest of these. Now let's get into the data. So we started with 1,000 trades on our EMA hot potato test. We run 100 trades. We won 42 of them. We lost 58 of them for a 42% winning percentage. Our total P&L was $164.05 per one Ethereum, and our average trade was $1.64 for a return on capital of 16% and a little bit better. It took us about 22 days to run this test. Our average win was $24.61. Our average loss was $14.97 for a risk to reward ratio of 1.644. That could give you an annualized leveraged return of 1,831%. If you like this video, make sure to check out the rest of them on my channel. You'll like those too. Thanks for watching. I hope you have a great night. Hey everybody, thanks for joining me on this video. Today we're going to cover a 1-minute scalping trading strategy used for Bitcoin, crypto, other stuff like that, maybe forex stocks, whatever you want to use it for. So we're going to hop right in. Alright, in this video I'm going to quickly cover the indicators used for this strategy, the basic idea behind this strategy, how to set up trades long and short, and then we're going to do a 100 sample backtest to see how it performs. So this is a whole moving average strategy using average true range as well. So you're going to need to set up a couple of indicators if you want to run a similar backtest. Learn a little bit about the market, help make everyone better traders and investors in their own practices, doing whatever they're going to do. So this one I'm going to start off with a long-term whole moving average, and this one's going to be set at 100. And then we're going to do an even longer term whole moving average. This one's set at 500. Then we're going to run some Keltner channels off a 1 length just to set that right to the bar. And then we're going to use a 3 multiple of 20 ATR to give you these average true range bands. So the basic idea behind this strategy is the faster whole moving average crosses the slower one. Both of them are very long term, but one of them is faster than the other one by about 5x. So it crosses this one, and you're going to use the average true range to set a stop and profit target. Assuming that if trend has failed that far across such a long-term trend, it'll continue at least for the next little bit. So let's say here you take a short, and you're away from the cross. You go here, you take your stop up to the average true range, your target down to the average true range. It should be about 1-to-1 risk to reward ratio. And if you keep going, we might have to keep waiting for it, but this one will probably close for profit. And that's a short trade. A long trade is going to set up very similarly, where you wait for the whole moving average to cross. The short one, or the short-term one, the faster one, crosses the slower, longer-term one, and you're going to take a long position. Take it at the end of the first bar that crosses there, and go down to the, and then that's your quick little scalp trade for the long side. You could set this up to take multiple trades inside of that if you wanted to run like one that's set like a couple of these, and so you could take a trade every time one of the faster ones crosses the slower ones, if it's going to create like a rainbow effect. Or you could just run one at a time. For simplicity's sake, we're just going to run one, and we're going to start the back test here in a second. So I hope you guys enjoy that, and I'll see you on the other side to go over the data. the back test. I hope you guys enjoyed it, and it was pretty interesting. So we set this up to have $10,000, so you could buy 2 Bitcoins with forex leverage, and that's about what we set up these trades for. So we kind of went up or down about $100 each time. We took 100 trades. We won 68 of them. We lost 32 of them for a 68% winning percentage. We had a total P&L of $4,970 and an average trade win of $49.70 to give us a leveraged return on capital of 49%. It took us about 46 days to run this back test, and our average win was $114 and our average loss was $87 to a risk and reward ratio of 1.306 reward for your risk. That gives us an annualized leveraged return of just over 10x. But it's a very risky strategy, and every time you see an annualized leverage return like that, failure is definitely a possibility. And I would suggest that you run this test on your own tickers and time frames to get a best idea of what we're trying to communicate here, so you can learn a little bit about the market and become a better trader and investor. And with all that, I hope you enjoyed the video. If you like this, make sure to check out the other ones on my channel. They're just as good. And I hope you have an excellent week and evening. You're here because you're probably like me. I remember when I first started trading, it seemed so hard to learn how the market works and how to use common technical indicators to understand price action and market structure. You spend days and nights staring at the market trying to understand it, pulling out your hair in frustration every time you enter a trade, and then the market immediately reverses and stops you out. Well, this video is for you, to help you understand how the market works. To do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of indicators. Indicators specifically designed to peel back the mystery of the market and help us understand what market makers and algos are doing to manipulate price to target you and stop out your trades. Make sure to watch through to the end to fully understand everything we learn from backtesting these indicators using real market data to better defend yourself from the hedge fund market makers and high frequency algo traders after your capital. In this video, we're going to look at a 1-minute scalping strategy. It utilizes several common free indicators so anyone can test it out and see for themselves how it works. This strategy uses 2 Bollinger Bands and the Heikin-Ashi candlesticks, as well as the Fibonacci retracements. Fibonacci is a special numerical sequence developed by a mathematician of the same namesake way back in the day, and it's been used for countless things between architecture and physics, understanding nature, and just the way the universe works in general. So we're going to apply it today to the market to see if it can teach us anything that can help us become better traders and investors. So let's begin. The way this works is you're going to use 2 Bollinger Bands, a very long-term one set at 100 length with a 1 standard deviation, and a short-term one with a 20 length set at a 1 standard deviation. And we're also going to use Heikin-Ashi candlesticks to better show trend as it progresses. So we actually have 3 bands. We have 1 band, we have 2 bands, and we have 3 bands that operate in a staggered pattern. And we're going to use the Fibonacci retracements to better understand price levels inside of these bands and across trend over time. So the way this works is, let's look at a short trade. Start here when it starts to pierce out of the fat slow band, indicating that trend could be changing. We're going to draw a Fibonacci retracement from the point it pierced to back to the last high, and that's going to give us our levels. And from here we can wait for it to retrace or enter here, or just add. For this back test, we're going to start right here, because you can't mess that up. So we're going to buy here, short here actually, we're going to short here, and we're going to put a stop at the top of the fib retracement or the top of the band, whichever one makes more sense to you at the time. And we're going to drag our target down to either the red or the blue. For this test, we're going to use the blue because it's going to have a higher hit rate and, I believe, better results. And there's your short trade. Now let's look at a long trade. In much the same way, you wait for price to pierce the fat band. Take your Fibonacci retracement, take it from the pierce down to the last low or high, respective. And then what you're going to do is you're going to take a position, we're going to take a position, and we're going to put a stop at the bottom of the band or the last low, whichever one makes most sense. Right now this one pierced it on the last low, so I don't want to do it again because the equal low, it would stop me out. So I'm going to go to the bottom. And then we're going to take a shot at the blue. And you can see this trade also was successful, and that is a long trade. We're going to do a 100 trade back test to see how this performs using real market data to help us understand more about the market and make us better traders and investors. So I'm going to get right to that, and I'll see you guys on the other side with the results. Hey guys, I'm back with the results, and it was a fantastic back test, as I hope you all saw. There was a lot of nuance in there that if you didn't get to catch, I suggest you go back and watch, because there was a lot of trades that kind of set up funky and were hard to kind of call. So if you want to try to mimic this yourself and understand this test, run it yourself, understand more about the marketplace, then I suggest before you do that, you go ahead and make sure you watch that montage to get a total grip and handle around everything we cover. So, the test, it lasted 22 days or 8,581 minute bars. We had a simulation account with $1,000 in it. We took 100 trades. 65 of those trades were winners, 35 of those trades were losers. That gives us a 65% win rate. We had a total P&L of $347 on that $1,000 for an average trade win of $3.47 per trade. That results in a return on capital of 34.70%. For an annualized leveraged return of 2,134.80%. Your average win was $8.86. Your average loss was $6.54 for a return to risk ratio of 1.355. You can see that it had very steady climbing, where the average loss and the average win were close, with the average win being higher, and then you had a better than 50-50 hit rate. So you get to see this nice stair-stepping chart. In conclusion, this performed better than I expected, and it can teach us a lot about the market, as well as how participants think using Fibonacci, whether they plan to or not. I hope everyone enjoyed the video. Thanks for watching. If you enjoyed this, you'll enjoy my other ones, so make sure you check those out too, and subscribe to the channel. If you're going to replicate this test, make sure to replicate it on your own tickers and time frames to make sure it's best suited for your style. And as always, I hope you have a great night. Hey there, thanks for joining me. You're here because you're probably looking to learn more about technical analysis and trading in the stock market. And well, this video is for you to help you understand how the market works. To do that, we need to understand the math behind the market, the gearwork that makes it tick, and how to read that through the use of specific indicators, all designed to peel back the mystery and help us understand what market makers and algos are doing to move price around and target traders. Make sure to watch through the end to fully understand everything we're going to cover today and get the most out of the video and help defend yourself against all the people that are out to get you. In this video, we're going to take a look at a 1-minute trading strategy, not quite a scalping strategy. A lot of the trades run a little long. It uses common free indicators that anyone can experiment with, so you can test this for yourself and learn and follow along. So this strategy works by using the linear regression channel indicator on TradingView along with an RSI. And the way this works is you're looking at the RSI as basically a reading of trend inside of the regression. And we're going to trade using the standard RSI methodology just to see how it works under these conditions. The settings for the indicator are going to be standard. You're going to set the default settings on the linear regression and default settings on the RSI. I'm using Heikin-Ashi candlesticks just to better demonstrate overall trend. So the way this works, a long trade is you wait for this to come down here, the RSI to tap the bottom, and you're going to, well, go through this bottom line, and you're going to take a long trade. And your target is going to be the top of the regression channel. And you're going to go for a 1-to-1 risk to reward ratio. Now it's difficult because the linear regression channel updates in time as you go along, and it goes back 100 bars. So it's really hard to like pull this back and show you this one. You're going to have to watch the montage here to see a bunch of live trades to see how it's set up and run. But short trade would function much a similar way. To go back to find one where it breaks the top. Breaks the top over here. So if it was like the channel would probably be like this, so you would take a short trade off and didn't quite break it anywhere in there. Now let's just say it did for example's sake. Just say it did for example's sake. So you come up here, you have this thing, you draw that down to the bottom of the regression channel, and then you take a 1-to-1 risk to reward ratio. 1-to-1 risk to reward ratio. You see this one actually ended up working like that. If that was your trade, I don't know exactly where the linear regression channel set up there, but you'll see how it works out in the montage. Speaking of the montage, I'm going to go ahead and jump right into that, and I'll see you here when I'm done. Alright guys, I'm back with the back test. And it was an interesting test, let's put it that way. So it started out losing a bunch of trades as you saw, and they kind of turned it around, and it was a lot of choppiness. I'd say till about 75 trades through the 100 sample. It was kind of hit or miss, and they kind of had a nice run at the end to put up some halfway decent results. But overall, it was not a great strategy, not a bad one. You just probably have to run this under your own conditions and on your own tickers and time frames to see how it works for you and see if you can get anything out of it. But it does show us a lot about the structure of the market, looking at the linear regression channel relative to the RSI as that moves over time. You can see a lot of similarities between the way the indicators react with price, and you can also tell some interesting differences. That can show us a lot about the market and help us become better traders and investors. Well, I hope you enjoyed it. Thanks for watching. If you like this one, you'll like my other ones, so make sure to check those out. And I hope you have a great night. What's going on, guys? And I'm back with another strategy video after my hiatus. And this one is going to be a 1-minute scalping strategy that focuses primarily on cryptocurrency. This strategy uses the Bollinger Bands because I love those, along with a volatility stop, and utilizes the Heikin-Ashi smooth candlestick bars. So you can go and set your Heikin-Ashi bars up here, and you can go ahead and use an overlay. Bollinger Band is standard. The settings for the Bollinger Band are standard 20, and I reduced the standard deviation to 1. Your volatility stop, again, is going to be unchanged from the standard settings, just to give us a good reading of trend and to give us a 2 standard deviation reading along with our 1 standard deviation reading. We're going to use this to scalp a trend inside of trend in a way that we have done before in several of our other videos, and we're going to demonstrate it here. The way this strategy works, as you see, the volatility stop is broken and flipped, meaning that price is moved 2 standard deviations in the opposite direction that it was moving, at which point you're going to wait for it to break the Bollinger Band or move 1 standard deviation from a 20 period moving average. What this does is signifies the possible start of a new trend by breaking the previous one and showing strength by moving beyond what it has before. And what we can say is we expect that this trend, if it will continue, will stay above this 2 standard deviation mark below, and hopefully will move with, we're looking for 2 to 1 risk to reward ratio on this. And this one got it. You just had to wait a little while. This can be a scalping trade where it works incredibly quickly, and sometimes when it has a larger reversal, it takes a little while. It's an iterative trading method. So if you took that one and you closed the trade up there, you just have to wait for it to come back inside of the Bollinger Band with a red bar in the case of a long trade, or a green bar in the case of a short trade. Let's see if we have, yeah, like in here. If you took one here, and then you paid out there, or somewhere down here, you could take another one there, or there, or there. The way you got stopped out there. Now this takes advantage of a greater than 1 risk to reward ratio while using essentially a 1 standard deviation target and a 1 standard deviation stop, but starting from either price or the mean respectively to create a spread. Again, a short trade would be, it flips the volatility stop to indicate the trend could be reversing. It's outside of the Bollinger Bands, indicating that it's strength beyond previous, and you can take a trade any of these red bars outside. And you're going to want to go ahead and set your stop for the volatility stops. And you're going to want to set your target for 2 to 1 risk to reward ratio. And you got it like, it's like right there on that bar. It's a little bit high up here. gets really sensitive with the Bitcoins. I mean, you move dollars real quick. It's a big number. What we're going to do to demonstrate how this strategy works is we're going to run 100 simulated tests. Now you can watch along with me in the little montage or skip right to the data at the end, where we cover how the strategy did. And hopefully we can learn a little bit about how the market works to make us better traders and investors. So I'll see you on the other side. And I'm back with the back test. This one did very well, but depending on your fee structure and how much slippage you experience, it might not work for you because a lot of these trades were incredibly small. You can see here $10, $31, $25 for something that is a $20,000 asset. Those are incredibly small trades. Lots of scalping in there, as you saw in the playback. It took us 13 days to get 100 trades. We set it at $10,000, just assuming you use 2-to-1 leverage. You won about 63% of your trades, and you had a total P&L of $1,540, or $15.40 per trade, for a return on capital of 15% and a little bit more. Your average win was $48, your average loss was $40, to give you a risk to reward ratio of 1.196. That means you could have gotten an annualized leveraged return of 3,140%. But again, that is a simulation, and well, you might want to backtest this on your own tickers and in your own time frames to make sure it works for you. This is just a robot running it, so in real life it might not be as clean as this, especially, like I said, taking these small little $10 on 20,000. Like, if you don't hit the button that second, that could be $10 loss. It's really so I don't like a lot of these strategies that tend to put really small trades on really big assets, because I don't really find that it's realistic. But that's just my thinking about it. Anyways, thanks for watching the video. I hope you learned something. If you like this, you'll like my other videos. And have a great night. Bye-bye.
Hey there, traders. Welcome back to TQFM Trading Strategies, where we dive into the best tips and techniques to help you succeed in the markets. If you're new here, make sure to hit that subscribe button and ring the bell so you never miss an update. Today, we have an exciting video lined up for you. We'll be reviewing a new trading strategy that combines two powerful indicators, the Bollinger Bands and the MACD. We'll cover how this strategy works, its advantages, and some potential drawbacks. So, if you're looking to sharpen your trading skills and gain an edge, stay tuned. Explanation of Bollinger Bands. Alright, let's start with the Bollinger Bands. Bollinger Bands are a popular technical analysis tool created by John Bollinger. They consist of 3 lines, a middle band, which is a simple moving average, and 2 outer bands that are standard deviations away from the middle band. The bands expand and contract based on market volatility. When the market is more volatile, the bands widen. When the market is less volatile, the bands narrow. Traders use Bollinger Bands to identify overbought and oversold conditions, as well as potential trend reversals. For example, when the price touches the upper band, it might be overbought, and when it touches the lower band, it might be oversold. Next, we have the MACD, or Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that shows the relationship between 2 moving averages of a security's price. It consists of the MACD line, the signal line, and the histogram. The MACD line is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The signal line is a 9-period EMA of the MACD line, which acts as a trigger for buy and sell signals. The histogram represents the difference between the MACD line and the signal line. Traders look for crossovers between the MACD line and the signal line to generate buy or sell signals. A bullish crossover occurs when the MACD line crosses above the signal line, and a bearish crossover happens when it crosses below. Now that we know what Bollinger Bands and MACD are, let's talk about how to combine them into a powerful trading strategy. The idea behind this strategy is to use Bollinger Bands to identify potential entry and exit points, while the MACD helps to confirm the trend direction and momentum. Here's how it works. First, we look for the price to touch or move beyond the Bollinger Bands. This gives us an indication that the price might be overbought or oversold. For instance, if the price touches the lower Bollinger Band, it might be a sign that the asset is oversold and could be due for a rebound. Next, we use the MACD to confirm this potential reversal. Specifically, we look for a bullish crossover, where the MACD line crosses above the signal line to confirm a buy signal. On the flip side, if the price touches the upper Bollinger Band, it could indicate that the asset is overbought. In this case, we look for a bearish crossover on the MACD, where the MACD line crosses below the signal line to confirm a sell signal. Let's go through a couple of examples. Now, let's discuss some of the advantages of using the Bollinger Bands and MACD strategy. 1. Improved signal accuracy. Combining two indicators helps filter out false signals. Bollinger Bands identify overbought and oversold conditions, while MACD confirms the trend direction, making for more reliable trading signals. 2. Versatility. This strategy can be applied in various market conditions, whether it's a trending market or a ranging one. The combination of indicators helps adapt to different trading environments. 3. Clear entry and exit points. The strategy provides clear and straightforward entry and exit points. When the price touches the Bollinger Bands and the MACD confirms the signal, it makes it easier for traders to make decisions without second-guessing. While this strategy has its advantages, it's also important to be aware of some potential drawbacks. 1. Lagging indicators. Both Bollinger Bands and MACD are lagging indicators, meaning they rely on past price data. This can result in delayed signals, potentially missing the optimal entry or exit points. 2. False signals. Despite combining two indicators, there is still the potential for false signals, especially during periods of high volatility or market consolidation. This can lead to entering or exiting trades prematurely. 3. Complexity for beginners. Interpreting the combined signals from Bollinger Bands and MACD can be challenging for new traders. It requires a good understanding of both indicators and how they work together, which might be overwhelming for beginners. 4. Requires constant monitoring. To make the most out of this strategy, you need to constantly monitor the charts and be ready to act on the signals. This can be time-consuming, especially for traders who can't dedicate a lot of time to watching the markets. To sum up, the Bollinger Bands and MACD strategy can be a powerful tool in your trading arsenal. By combining these two indicators, you can potentially improve your signal accuracy and make more informed trading decisions. However, remember that no strategy is foolproof, and it's essential to understand the potential drawbacks, such as lagging indicators and false signals. Please keep in mind that trading involves risk, and it's crucial to do your own research and practice with paper trading before committing real capital. This video is for educational purposes only and is not financial advice. If you found this video helpful, don't forget to give it a thumbs up and subscribe to TQFM Trading Strategies for more insights and tips on trading. Hit the notification bell so you never miss an update. We'd love to hear your thoughts and experiences with this strategy, so leave a comment below. And if you have any questions or topics you'd like us to cover in future videos, let us know. Thanks for watching, and happy trading! In the volatile world of cryptocurrency trading, where fortunes can be made and lost in the blink of an eye, having a robust strategy is essential. Among the myriad of approaches, one stands out for its potential to capitalize on short-term price movements: Bitcoin scalping. Utilizing two whole moving average (HMA) indicators, set at lengths 33 and 100 respectively, alongside a moving average convergence divergence (MACD) indicator with standard settings, this strategy aims to seize fleeting opportunities in the market. Let's delve into how this amalgamation of indicators can form a potent trend trading strategy for scalping and trading in the Bitcoin market. Understanding the indicators. Whole Moving Average, HMA, is a refined moving average that reduces lag, making it more responsive to recent price movements. The lengths of 33 and 100 are chosen strategically to capture both short-term fluctuations and long-term trends in Bitcoin's price action. Meanwhile, the Moving Average Convergence Divergence (MACD) indicator, comprising two lines, the MACD line and the signal line, measures the relationship between two exponential moving averages. Standard settings typically involve 12-period and 26-period EMAs, with a 9-period signal line. Together, these indicators offer insights into both momentum and trend direction, laying the foundation for an effective scalping strategy. Pros of the strategy: enhanced trend identification. The use of two whole moving average HMA indicators of different lengths provides a dynamic perspective on the market's trend. The shorter HMA, length 33, is adept at capturing short-term fluctuations, while the longer HMA, length 100, offers insights into more sustained trends. By comparing the relative positions of these two indicators, traders can discern the strength and direction of the prevailing trend with greater clarity. When the shorter HMA crosses above the longer one, it signals a potential uptrend, while a crossover in the opposite direction suggests a possible downtrend. This dual HMA approach enhances trend identification, enabling traders to make informed decisions on when to enter or exit trades with confidence. Reduced lag. Traditional moving averages, while valuable for trend analysis, suffer from inherent lag, which can delay signals and hinder timely decision-making. The whole moving average, HMA, overcomes this limitation by employing a weighted moving average formula that reduces lag without sacrificing smoothing. As a result, the HMA reacts more swiftly to changes in price action, providing traders with a real-time view of market dynamics. This reduced lag enables traders to capitalize on short-term trends more effectively, seizing opportunities as they arise and minimizing the risk of missing out on profitable trades. Confirmation with MACD. The Moving Average Convergence Divergence (MACD) indicator complements the dual HMA setup by offering additional confirmation of trend direction and momentum. The MACD line, derived from the difference between two exponential moving averages, serves as a primary signal of trend strength and momentum. When the MACD line crosses above the signal line, it indicates increasing bullish momentum, reinforcing a potential uptrend identified by the HMAs. Conversely, a crossover below the signal line suggests growing bearish momentum, validating a potential downtrend identified by the HMAs. By integrating the MACD into the strategy, traders gain a secondary confirmation mechanism that enhances the reliability of their trading signals, reducing the likelihood of false positives and improving overall decision-making accuracy. Adaptability. One of the key strengths of this strategy lies in its adaptability to various time frames, catering to the diverse needs and preferences of traders. Whether operating on shorter intraday charts or longer-term swing trading horizons, the dual HMA and MACD setup can be applied with equal effectiveness. Traders can adjust the lengths of the HMAs and the parameters of the MACD to suit their desired time frame and trading style, allowing for a high degree of customization and flexibility. This adaptability empowers traders to tailor the strategy to their individual risk appetites and market conditions, maximizing its potential for success across different trading environments. Cons of the strategy. Whipsawing in choppy markets. Despite its effectiveness in capturing trends, the strategy is susceptible to producing false signals during periods of market indecision or choppiness. In sideways or range-bound markets, where prices fluctuate within a narrow range without establishing a clear trend, the dual HMA and MACD setup may generate conflicting signals, leading to whipsawing. Traders may find themselves entering and exiting positions prematurely, resulting in losses as they attempt to navigate volatile price movements without a clear trend direction to guide their decisions. While the strategy excels in trending markets, traders must exercise caution and consider implementing additional filters or waiting for confirmation signals to mitigate the risks associated with whipsawing in choppy conditions. Potential for overtrading. Scalping strategies, by their very nature, involve executing a high volume of trades within short time frames to capitalize on small price fluctuations. While this can result in rapid profit accumulation, it also exposes traders to the risk of overtrading. Frequent trading increases transaction costs, including spreads and commissions, which can eat into profits and erode overall returns. Moreover, overtrading can lead to emotional exhaustion and decision fatigue, impairing traders' judgment and impairing their ability to execute trades effectively. To avoid falling into the trap of overtrading, traders should exercise discipline and adhere to predefined trading rules and risk management strategies, focusing on quality over quantity when identifying trading opportunities. Dependence on indicator settings. While the standard settings for the MACD indicator are widely used and provide reliable signals in many market conditions, they may not always be optimal for every scenario. Market dynamics can vary significantly, requiring traders to adjust the parameters of the MACD, such as the lengths of the exponential moving averages and the signal line, to better suit prevailing conditions. Failing to adapt the indicator settings accordingly may result in suboptimal performance and missed opportunities. Traders must remain vigilant and continuously monitor market conditions, experimenting with different settings and conducting thorough backtesting to identify the most effective configurations for their trading strategy. By reducing dependence on default settings and embracing a proactive approach to optimization, traders can enhance the robustness and effectiveness of their scalping strategy. Conclusion. In the fast-paced realm of Bitcoin trading, where every second counts and market conditions can change in an instant, a well-crafted scalping strategy can serve as a potent weapon in a trader's arsenal. By combining two whole moving average indicators with an MACD indicator, traders gain a powerful tool for identifying trends and seizing short-term opportunities in the market. However, like any strategy, it's not without its drawbacks. Traders must remain vigilant, adapting to changing market conditions and avoiding the pitfalls of overtrading and false signals. With careful implementation and risk management, this trend trading strategy has the potential to unlock profits in the dynamic landscape of Bitcoin trading. It's crucial to recognize that trading, including the strategies discussed herein, carries inherent risks. While the utilization of technical indicators and trend trading methodologies can enhance decision-making processes, no strategy guarantees success in the unpredictable world of financial markets. Traders should exercise caution and conduct thorough research before engaging in any trading activity. Moreover, it's imperative to acknowledge that past performance is not indicative of future results, and market conditions can change rapidly. As such, traders should never risk more than they can afford to lose and should consider consulting with a qualified financial advisor or investment professional to assess their individual circumstances and risk tolerance. Ultimately, responsible trading entails thorough risk management, ongoing education, and a disciplined approach to decision-making.
Today we're going to go over price action trading strategy and test its results. Price action trading refers to using the individual candlesticks themselves to gauge trend momentum and underlying market sentiment and to direct your trading. One way you can do this is, say, to look for an uptrend, is you start to watch the bottoms or the lows of each of the candlesticks. Not particularly the wicks, you got to give it some time sometimes, but the lows of the bars. If it starts to make new lows, the trend is broken. Same thing to the other side, and if it's a short trend, I think the market's going down, you can watch the highs of the bars as they continue to make lower highs. See some equal highs, trend is continuing, it's going to go down, and then start to make new highs. The trend is over. So let's watch some of the strategy in action, see how it back tests on some live market data, and see, so we can all learn a little bit more about the market, and hopefully that helps us with our own trading and investing. Enjoy!
Traders, and welcome back to TQFM Trading Strategies. Today, we're diving into an exciting topic that has captivated the crypto trading community, scalping Bitcoin on a 1-minute candlestick chart using the powerful combination of Keltner channels and channel break trading strategy. In the fast-paced world of cryptocurrency trading, where every second counts, scalping has become a popular technique for traders looking to capitalize on short-term price movements. And what better way to navigate the rapid price changes of Bitcoin than by leveraging the insights provided by Keltner channels? Stay tuned as we explore how to harness the potential of Keltner channels and the channel break strategy specifically tailored for the granularity of a 1-minute candlestick chart. Whether you're a seasoned trader looking to refine your strategy or a newcomer eager to learn, this video is packed with insights to help you navigate the dynamic world of Bitcoin trading. But before we dive into the details, make sure to hit that subscribe button, click the notification bell, and give this video a thumbs up if you're ready to elevate your trading game. Now, let's jump into the exciting world of scalping Bitcoin with Keltner channels on TQFM trading strategies. In the dynamic and highly volatile world of cryptocurrency trading, particularly with Bitcoin, traders are constantly seeking effective strategies to capitalize on short-term price movements. Scalping, a trading approach focused on profiting from small price fluctuations, has gained popularity among traders looking to take advantage of rapid market changes. This essay explores the application of Keltner channels and channel break trading strategy for scalping Bitcoin on a 1-minute candlestick chart. Understanding Keltner channels. Keltner channels are a technical analysis tool that helps traders identify potential trend reversals, breakouts, and volatility. Developed by Chester Keltner in the 1960s, this indicator consists of 3 lines. The middle line represents the exponential moving average, EMA, of the asset's price, while the upper and lower bands are based on the average true range, ATR. The upper band is usually set at the EMA plus a multiple of ATR, and the lower band is set at the EMA minus the same multiple of ATR. Channel break trading strategy. The channel break trading strategy involves identifying points where the price breaks above the upper band or below the lower band of the Keltner channels. These breakouts can signal potential trend changes or increased volatility, providing opportunities for short-term trades. In the context of scalping Bitcoin on a 1-minute candlestick chart, the channel break strategy allows traders to exploit rapid price movements. Application to 1-minute candlestick charts. The 1-minute candlestick chart is well suited for scalping due to its granularity, offering a detailed view of price action. To implement the Keltner channels and channel break strategy on such a chart, traders can adjust the parameters of the indicator to suit the short time frame, optimizing for responsiveness. Identifying breakouts. Traders can look for candlestick closes above the upper band for potential bullish breakouts or below the lower band for bearish breakouts. Confirmation from consecutive candlesticks can strengthen the signal. Risk management. Given the fast-paced nature of scalping on a 1-minute chart, risk management is crucial. Traders may set tight stop-loss orders to minimize potential losses and take quick profits as soon as the trade moves in their favor. Using additional indicators, combining Keltner channels with other technical indicators, such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, can enhance the accuracy of signals and provide additional insights. Continuous monitoring. Since market conditions can change rapidly, continuous monitoring of the 1-minute chart is essential. Traders should be prepared to adapt to evolving price action and adjust their strategies accordingly. Conclusion. Scalping Bitcoin on a 1-minute candlestick chart using the Keltner channels and channel break trading strategy requires a disciplined approach and a keen understanding of market dynamics. While this strategy can offer opportunities for quick profits, it also comes with inherent risks, and traders should exercise caution. As with any trading strategy, thorough backtesting, risk management, and ongoing analysis are essential for success. Additionally, traders should stay informed about market news and events that may impact Bitcoin prices, as external factors can influence the effectiveness of technical analysis strategies. Well, that wraps up our deep dive into scalping Bitcoin using Keltner channels on a 1-minute candlestick chart here at TQFM Trading Strategies. We hope you found this exploration insightful and packed with valuable information for your trading journey. Before you go, don't forget to like this video if you enjoyed the content and found it helpful. If you have any questions or topics you'd like us to cover in future videos, drop them in the comments below. Your feedback is crucial to shaping the content we deliver to you. If you haven't already, make sure to subscribe to TQFM Trading Strategies and hit that notification bell so you never miss out on our latest insights and strategies for navigating the ever-evolving crypto market. As always, remember that successful trading is a journey of continuous learning and adaptation. Stay disciplined, stay informed, and may the markets be ever in your favor. Thanks for joining us today, and until next time, happy trading.
Hey traders, today we're diving into the fascinating world of technical analysis with a focus on TradingView's RSI strategy. The Relative Strength Index, or RSI, is a powerful tool used by traders to gauge the strength and momentum of price movement. In this video, we'll be exploring the ins and outs of the RSI strategy. We'll walk through some common settings, how to put it through the test on some backtesting Bitcoin's 1-minute charts. So to kick things off, let's demystify the RSI with a walkthrough of RSI strategy. It's a momentum oscillator that measures the speed and change of price movements, typically ranging from 0 to 100. The RSI helps traders identify overbought or oversold conditions in the market. Now let's delve into the common RSI settings. Traders often tweak parameters like period, length, and other stuff to align the RSI with their trading preferences, seeking optimal signals for buying or selling. Now comes the exciting part, looking at some backtesting examples. Backtesting the RSI strategy on Bitcoin's 1-minute charts, we compiled a montage of key moments, showcasing trade entries, exits, and the overall flow of the strategy and actions. As we walk these snippets, pay attention to how the RSI reacts to dynamic markets. As we wrap up the backtesting phase, let's take a moment to digest the results. On Bitcoin's 1-minute charts, the RSI strategy didn't show stellar performance, ending up fairly flat after 100 trades. It's crucial to understand these outcomes to make informed decisions about integrating the RSI strategy into your trading arsenal. Now let's talk about some pros and cons of the RSI strategy. On the positive side, the RSI can be a robust tool for identifying potential trend reversals and market entry points. Traders often find success in aligning the RSI signals. However, any strategy is often met with limitations. The RSI may not perform as well in certain market conditions, and false signals can definitely occur, leading to suboptimal results. It's essential to consider both sides of the coin. So in conclusion, as we wrap up today's videos exploring the RSI trading strategy, remember that no strategy is foolproof. The RSI is a valuable tool, but it requires a nuanced understanding and careful consideration. I encourage you to share your thoughts and experience with the RSI strategy in the comments below. Happy trading, and I'll see you in the next video. Thanks for watching. Bye. Hey, welcome to TQFM Trading Strategies, your channel for all sorts of trading strategy stuff. My name is T, and today we're going to be talking about the Stochastic Momentum Index. TradingView recently added it to their list of standard indicators, so I figured I'd go ahead and make a video about it. So make sure to watch to the end so you don't miss any of the great details about how to use the Stochastic Momentum Indicator in your trading, if it might help you, if it might not, and look at all sorts of testing and backtesting examples. And either way, we'll both learn something about the markets from watching it go. So, with all that being said, let's get right into it. And I'm going to have my buddy Freddy the Robot explain a little bit about the Stochastic Momentum Indicator, and then we'll go over how to use it in the trading strategy and the backtesting.
The Stochastic Momentum Indicator, SMI, is a powerful tool widely used in technical analysis and trading strategies to gauge the momentum of a financial asset's price movement. It combines elements of both the stochastic oscillator and the moving average to provide traders with insights into potential trend reversals and overbought or oversold conditions. At its core, the SMI measures the relationship between an asset's closing price and its price range over a specified period. It typically consists of two lines, the SMI line and the signal line. The SMI line represents the difference between the closing price and the midpoint of the price range, while the signal line is a moving average of the SMI line. The calculation of the SMI involves several steps. Calculate the typical price, TP, for a given period, usually 14 periods, which is the average of the high, low, and closing prices, TP equals high plus low plus close, /3. Compute the difference between the current closing price and the in-period midpoint of the price range, where N is usually 14 periods. Equals minus plus 2. Difference equals close minus 2. Highest high plus lowest low. Normalize the difference to a percentage of the price range to ensure consistency across various assets and time frames. Equals price range times 100. Raw SMI equals price range difference times 100. Apply a moving average, signal line, to the raw SMI to smooth out fluctuations and generate trading signals. A common choice is a 3-period exponential moving average, EMA, of the raw SMI. The interpretation of the SMI involves identifying key thresholds, typically at 0 and plus or minus 40, which indicate potential buy or sell signals. When the SMI crosses above the zero line from below, it suggests a bullish momentum shift, signaling a potential buying opportunity. Conversely, when it crosses below the zero line from above, it implies a bearish momentum shift, signaling a potential selling opportunity. Additionally, extreme SMI readings beyond plus or minus 40 often indicate overbought or oversold conditions. An SMI above plus 40 may indicate an overbought market, potentially signaling a reversal or a pullback, while an SMI below minus 40 may suggest an oversold market, indicating a potential rebound or reversal in price. Traders and analysts commonly use the SMI in conjunction with other technical indicators and analysis techniques to confirm signals and make informed trading decisions. However, it's essential to note that like any technical tool, the SMI has its limitations and may generate false signals in certain market conditions. As such, risk management and validation through multiple indicators or analysis methods are crucial when using the SMI for trading purposes.
Hey guys, what's up? I'm back. Hope you enjoyed the robot and watching the back test. This is the results of all the trades. We made about $1,300 on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, about 50 trades. On Bitcoin, I'm just doing some back testing. So the way I pulled this up is I went on over to the He's down here, stochastic momentum indicator on TradingView. Loaded that up here. I didn't modify these at all, I left them as is. And for this back test, all I was doing for this strategy was buying it when it broke above the top, and I closed trade when it broke back below. If it broke back down below, if it broke below the bottom, I would sell it, and if it broke back above this line, I would buy back. And I just did that over and over. You can see it definitely had some choppy areas. It did a pretty good job on this trend here. I probably could have played that better, but it did pop back above here. Yeah, it's some good runs. It got that pretty good there. This one, that's particularly impressive up in here, huh? Buying down here at these lows, buying here, selling there, buying there, selling there, selling there, buying there, selling there, buying there. Pretty good. Yeah. Overall, a decent back test. I would go ahead and back test this on your own ticker and time frame. See if it'll help you out. I hope you guys learned something from watching this video, and I hope you enjoyed it. Thanks for watching. Watch the rest of my videos. Take care, guys. Like and subscribe. Bye. Hey, what's going on YouTube? It's TQFM Trading Strategies, again with another trading strategy. We're going to be covering a Bollinger Band double trading strategy today. We're going to set that up. We're going to go to Community Scripts, Financials, Technicals. We're going to go find the Bollinger Bands. So we want one Bollinger Band. We want two Bollinger Bands. We're going to be doing it on Bitcoin. So we're going to look at the first Bollinger Band. It's going to be 20 with 2 standard deviations. We're going to generally leave that one alone. Let's go ahead and cover the upper and lower one white. And we can go ahead and get rid of the basis. We don't really need the basis. And we'll go for the second one here. This one, we're going to triple. Let's go to 60. In the style, let's make this one black and black, and we're gonna make this black and thick. Then what we're gonna do is we're gonna take this and we're gonna move this behind the other one. Then we're going to take this one and we're going to move it behind the other one. And we're going to go ahead and take this, and I want to change the background to white. Alright, now we got this. This looks super silly, but watch what we're about to do with it. The goal of this strategy is to take advantage of runs in the marketplace using a double Bollinger Band. So we can go like right back to this here. Oh, I see it's starting to pop up out of here. So we can buy one of those. And then we'll watch it. It's going to trade. Keep watching it. We can still see the bars and everything. Alright, it's back under that cloud there. So you give it a second. It's probably done. So we can go ahead and sell it. That's the sort of trade you're. Hello and welcome to TQFM Trading Strategies, the channel for all your other, trading strategy stuff and, whatever. My name is T, and I'm going to do a special video today about the best time frame for day trading. So if you're a day trader, you're interested in trading in general, or time frames in general, technical analysis, any of that jazz, make sure to watch to the end so you don't miss any of the exciting details for in this presentation. And with all that, let's jump right into discussing what is the best time frame for technical analysis and day trading. First, let's talk about technical analysis. Technical analysis is the use of math to understand how people are buying and selling things in a market. It's a very boilerplate, kind of broad scope. People might define it as the use of visual indicators specifically, or the use of algorithmic trading, or something along those lines. But I just look at it as using some sort of quantifiable equation to evaluate the marketplace using the inputs of price and time. And anything that covers could be kind of thrown into the basket of technical analysis. What we're looking at here is my sort of heads-up display, let's call it, kind of what I run on a day-to-day basis. And there's a ton going on here, and don't you worry about that. What we're going to talk about is individually which time frame is the best time frame for day trading. I day trade a lot of the ES 500 or S&P 500, ES futures, SPY, whatever you want to call it. It's all the same thing. It's just the broad market index, and that's what I deal in and day out. A lot of people trade a lot of other stuff, but in my opinion, all markets are more or less the same, because people are more or less the same, and they tend to do similar things given similar stimuli under similar circumstances. So with all that being said, let's approach the question at hand. Which time frame is the best time frame for day trading, scalping, anything like that for any market? And we're going to get into it right here, so stay tuned. Alright, so let's discuss time frames a little bit. The most commonly used time frames are generally the 1 minute, the 5 minute, 10 minute, 15 minute. Some people have the hourly or the 4 hour, and a lot of people just look at a daily chart. So let's start with a daily chart and start talking about pros and cons to a daily chart. The con is that it only gives you one data point per day, or a couple data points per day if you measure the open, low, high, and close as 4 separate data points. But it's just 1 point in the chart. You only get 1 bar per day, so it can be kind of slow if that is your preference. And if we go on down to say like the 1 hour chart, let's look at that. It's gonna be a little bit faster. Some people will trade a 1 hour chart once a week, twice a week or so, something like that. Or maybe they'll even look at it a little bit closer and trade it intraday, try to use it to swing trade the day trading, but it can be a little bit slow for that also, depending on how you feel. Let's pop on down. Let's say look at the 15-minute chart. Let's look at how that looks intraday, right? So you get a good amount of bars per day, 20, 30, whatever it is. And if you're the kind of person who takes trades on the bar, where you're buying a bar with a stop below that bar, you can get some good trades on that, right? That's just a general trend. I mean, if you're going to see a trend here on this chart, I mean, you might be able to pop on down to like a 1 minute chart, right? And if you pop on down to a 1 minute chart and use a longer term trend reading sort of thing, we can see that same thing written in indicators. They give you a nice visual representation of that trend on a smaller chart, a little bit faster, right? So that begs the question, which one of these is best? Which one of these time frames is going to be the best for scalping trading, swing trading, day trading? What is going to be the best? What's going to work best for your indicators? What's going to work best for you? What is going to make you the most money, right? That's the question everyone wants to know. And that's the question I keep getting in the comments. Like, does this work on this time frame? Does this work on that time frame? And I think it's time to reveal what is the best time frame for day trading. So the best time frame for day trading is going to be whatever you feel the most comfortable with. It's going to be an individual individual thing for every individual person. No one is exactly the same. Some people like to move a little bit slower, some people like to move a little bit faster, and you really got to feel it out and see which is going to work best for you and what you're trying to do. Because it's never going to, it's not like one is better than the other. And that's just kind of the sad truth. And let's talk about why that is, because it's actually super interesting. You can see on over here, I got a couple of charts. Let's just get rid of the lines. So, can you tell me which one of these charts, these are all trends measured the same way, using the same sort of data sets, price over time, looking at where bars end versus where they begin, and comparing that to momentum and averages over time to give us a sort of fractal wave structure. And there's an important word in there. It's called a fractal wave structure. Which one of these is... So this one is a 5-minute chart. That's a 4-hour chart. And that's a 10-minute chart. And before I told you a second ago, did you know which one was which? No, you didn't, because they all are the same sort of structure. It's a fractal structure. It's the same on the small scale as it is on the big scale. So we got here, we got 1 minute, and here we got 1 day. So let me go like this. Between these two charts, this one and this one, you tell me which one is the 1 minute and which one is the 1 day. You can't, because they're the same sort of thing. It just makes the same patterns on every time frame over and over in a fractal structure. Now let's talk about why that is and how you can measure a fractal. Because what a fractal really is, and what we're looking at here, is something truly interesting. We're looking at a 4D, four-dimensional phenomena, a market that has 4 dimensions, just gotta trust me here and bear with me, that we can only understand in 3 dimensions, so we're limited, and that creates a sort of Heisenberg uncertainty and all that other fun quantum jazz in our understanding and our measurability of the marketplace, that 4-dimensional structure, or that quantum structure, however you want to phrase it. And the best we can usually get to easily describe that, or easily picture that, easily display that fractal, and that exists in 4 dimensions, that we perceive in 3 dimensions, the best we can do usually to depict it is 2 dimensions. So that's what we're looking at here. We're looking at a 2-dimensional representation of a 3-dimensional understanding of a 4-dimensional phenomena. Welcome to the market. Okay, so why would that mean that whatever time frame, it doesn't matter, it's all the same? Because things are just reciprocating over averages. So let's look at this. I mean, this is just going to be, it's just comparing itself to itself over time. If it's going down on average, it's just jamming a bunch of these together and saying, yeah, this bar's going down. It's making little bars into bigger bars. Essentially, that's all a trend is doing. It's just jamming a bunch of little bars into a big bar using math and then telling you the color of this bar. So this whole thing is just, and let's go find one. This is going to be, let's measure it. So it's about 2 hours. So if we go over here and we find the 1 hour chart, we'll go with our clicker, and we open her up, and we zoom on in, we can go ahead and we can look at the hourly bars, these, on this little thing here. So when the bars are red on the 1 hour chart, we're only taking a data point every hour, it's red. And if we look here where we've taken it and we slowed this data over an hour, it's red, because really these things are trying to say the same thing. And let's, so it's a fractal. Little bars make bigger bars that make bigger bars, and a series of bars is a trend, and a trend is also a bigger bar, and you can split it up or add them together however infinite ways you really see fit. So really what's going to answer your question on which time frame is the best time frame for me, you have to understand what kind of math you're using, what you're trying to do with that math, and then use that to determine how you want to measure the market. And you measure the market using all sorts of math. Like you measure anything with math. How else do you measure stuff? Even if you're counting on your fingers, you're still using math, right? So, which time frame is going to be best for me? It's going to be depending on your indicator. Usually what's going to be a good, general rule of thumb is your length, your fastest length setting in whatever equation you use, the number of bars you take into your equation. is probably going to give you just about, like if you're doing a full reciprocation, it's going to give you about that long of an average trade. So if you're a kind of person that's like, well, I like my trades to last a half hour, then you're probably going to want to use something that, say, for instance, takes 10 measurements. You might be good on you might feel very comfortable on a 3-minute chart, because 10 3-minute measurements is a half hour, and you like half hour trades. That makes sense? So a lot of people go at it backwards, where they're like, well, which indicator and time frame is the best? And it's more what you feel most comfortable with, what's going to allow you to operate in the best manner for risk management, for timing, because like if you have just a ton of trades per day, it's hard to get them all. Or if you don't like, some people just want to take more trades and they don't want to only take one trade a week or whatever it is. They want more, and they can have more. And it's very up to preference. And honestly, at the end of the day, that's why we can measure a market like this, is because a market is just a huge group of people. There's going to be all sorts of people. Some people like to trade for an hour. Some people like to trade for 10 minutes. And these people's preferences, when they move in and out themselves, is what's going to dictate these changes over time in price. So really, the way to look at it is, if I want to trade trades that last 1/2 hour, I'm trading against for the most part, a group of other people who are also prefer trades to last a half hour. You can start to get into some psychology and psychological edge by identifying, let's say, time frames that other people don't feel comfortable operating in, and then that can give you some sort of, it gives you, basically you're not doing what everyone else is doing, so just by default it gives you a little bit of an oomph. But that's not always true, so But anyways, I just had this question come up on 4 or 5 comments over the last couple of days, so I figured I would make a fun little video to address it. Please let me know anything you might think about which time frame is the best in the comments, and I hope you learned something from this video today. Make sure to like and subscribe for more trading content. Again, I'm T from TQFM, and you have a great night.
Welcome back to TQFM Trading Strategies. It's always a pleasure to have you here with us. If you're new here, we discuss and test technical analysis-based trading strategies and talk about the markets. So if you're into that, make sure to subscribe to the channel for more valuable trading content. Today, we're about to embark on an exciting journey into the world of cryptocurrency trading. So, grab your favorite trading notepad and let's get started. In this video, we've got something special lined up for you. We're going to explore a powerful scalping strategy that harnesses the incredible potential of not 1, not 2, but 3 dynamic indicators, the Heikin Ashi, Ichimoku, and alligator indicators. And we're going to put this strategy to the test on none other than Bitcoin's wild 1-minute price data. Now, if you've ever wondered how to navigate the lightning-fast world of cryptocurrency trading, this video is tailor-made for you. These indicators, when used in combination, can provide you with a scalping strategy that's not just effective but also precise. But before we dive headfirst into the action, let's take a moment to understand each of these indicators and why they're such a game changer. So, whether you're a seasoned trader looking to refine your strategy or a newcomer eager to learn, you're in the right place. So, without further ado, let's unpack the magic of Heikin Ashi, demystify the Ichimoku cloud, and learn to ride the alligator's momentum as we explore this fascinating scalping strategy. Stay tuned, because by the end of this video, you'll have a clear roadmap to potentially unlock profitable trades in the blink of an eye. Alright, folks, let's not waste any more time. The crypto market waits for no one. Are you ready to take your trading to the next level? Let's do this. Now, before we delve into the nuts and bolts of our Heikin Ashi Ichimoku alligator indicator combo, it's crucial to grasp why scalping is a must-have technique in the cryptocurrency trading arena. Cryptocurrency markets are known for their incredible volatility. Prices can swing dramatically in a matter of minutes, and that's where scalping comes into play. Scalping is all about making quick, small profits by capturing these rapid price movements. But, and this is a big but, it's not as simple as it may seem. Attempting to scalp without a well-thought-out strategy is like trying to navigate a stormy sea without a compass. It's risky, and you might find yourself adrift. This brings us to the core of today's video, the need for a reliable strategy. In the fast-paced environment of cryptocurrency trading, a strategy acts as your guiding star, helping you navigate through the chaos with confidence. Imagine having a set of tools and techniques that not only help you identify potential entry and exit points, but also allow you to manage risk effectively. That's what we're offering you today. By combining the power of Heikin Ashi, Ichimoku, and the alligator indicator, you'll gain the ability to read the market with greater precision, increasing your chances of making profitable trades even in the most turbulent conditions. So, by the end of this video, you'll not only understand how these indicators work, but also how to integrate them seamlessly into your trading strategy. It's like having a weather forecast for the crypto market, allowing you to set sail with confidence even when the waters get rough. Now that we've established the significance of scalping and the need for a solid strategy, let's roll up our sleeves and dive into the fascinating world of Heikin Ashi, Ichimoku, and alligator indicators. Alright, let's start by shedding some light on Heikin Ashi candles. These are not your everyday candlesticks, folks. They have a unique way of smoothing out price action, making them an invaluable tool for traders. So, how do Heikin Ashi candles differ from traditional candlesticks? Well, the key distinction lies in their construction. While traditional candlesticks rely on open, high, low, and close prices, Heikin Ashi candles take a different approach. Heikin Ashi candles are calculated based on the average of the open and close prices, which creates a smoother and less noisy representation of price action. This means they react more slowly to price changes, reducing false signals and noise. Now, let's talk about the default settings. When we use Heikin Ashi candles, we typically don't need to adjust any settings. The default settings work perfectly for our scalping strategy. So, no need to worry about tweaking anything there. Moving on to the Ichimoku cloud, this indicator is a game changer in the world of technical analysis. It's like having a multidimensional view of the market's past, present, and future. The Ichimoku cloud is composed of several elements, each with its own role in helping us make sense of price action. Let's break it down. First, we have the Tenkan-sen, which is often referred to as the conversion line. It represents the average of the highest high and lowest low over a specified period. Next, we have the Kijun-sen, or the baseline. It's similar to the Tenkan-sen, but calculated over a different period, providing a different perspective on price momentum. Now, the Senkou-span A and Senkou-span B together form what's known as the cloud. These two lines project into the future and act as support and resistance levels. And last but not least, we have the Chikou-span, which is essentially the current closing price plotted backward on the chart. It helps us gauge potential areas of support and resistance in the recent past. And just like with Heikin Ashi candles, we're sticking with the default settings for the Ichimoku cloud in our strategy. These settings have been carefully chosen to align with our scalping objectives. Now, let's sink our teeth into the alligator indicator, which might sound ferocious, but it's actually your ally in the crypto jungle. The alligator indicator consists of three components: the jaw, the teeth, and the lips. These intriguing names represent the different moving averages and their relationships. The jaw, represented by a blue line, is the slowest moving average and corresponds to the 13-period smooth moving average, SMA, at the midpoints of the price bars. Next up is the teeth, depicted by a red line. It's a bit faster and corresponds to the 8-period SMA at the midpoints of the price bars. And finally, we have the lips, which is the fastest of them all. The lips is represented by a green line and corresponds to the 5-period SMA at the midpoints of the price bars. But here's the beauty of it: just like with our other indicators, we're sticking to the default settings for the alligator. These settings are finely tuned to our scalping strategy. So, there you have it, a crash course in the key indicators we'll be using in our scalping strategy. Now that we've got the basics down, let's combine them and unleash their power in the world of Bitcoin 1-minute data. Alright, traders, now it's time to dive into the heart of our scalping strategy. In this section, we'll break down the core concept, entry points, and the all-important risk management aspect. Our strategy's core idea is relatively straightforward yet incredibly effective. We'll be hunting for trading opportunities when the alligator indicator opens up its jaws and starts moving above the Ichimoku cloud. Now, why is this concept so powerful? The logic is simple. When the alligator indicator awakens from its slumber and starts moving above the Ichimoku cloud, it signifies a potential shift in market sentiment. This could signal the beginning of a strong bullish trend or a reversal from a bearish trend. But, and this is crucial, we don't just dive in blindly. Risk management is our guiding principle. We'll emphasize it throughout this video because, in the fast-paced world of scalping, protecting your capital is paramount. So, how do we identify those entry points that align with our concept? Let's break down the criteria for entering a trade in detail. First, we'll look for a bullish entry signal. This occurs when the alligator's jaw, teeth, and lips cross above the Ichimoku cloud. This alignment suggests a potential bullish momentum. Conversely, for a bearish entry, we wait for the jaw, teeth, and lips of the alligator to cross below the Ichimoku cloud. This signals a possible bearish trend. But here's the kicker, we don't rely solely on these crossings. We emphasize confirmation. This means we look for additional signs of strength or weakness in the market, such as candlestick patterns or support and resistance levels. Remember, scalping is all about precision, and confirming the alligator's move with other technical factors increases our confidence in the trade. Now, let's talk about the unsung hero of trading risk management. In the world of scalping, it's not just important, it's absolutely vital. Here's why. Scalping involves making numerous quick trades, and not every trade will be a winner. That's where risk management steps in to protect your capital and ensure you're in the game for the long haul. To manage risk effectively, you need to set stop loss and take profit levels. The stop loss is your safety net. It's the price at which you'll exit the trade if it goes against you. Always place your stop loss orders to limit potential losses. On the flip side, the take profit level is where you lock in your profits. This is the price point at which you'll exit the trade when it's moving in your favor. It's essential to set a take profit level to secure your gains. But, folks, here's the golden rule of risk management: maintain a favorable risk-reward ratio. In scalping, aiming for a risk-reward ratio of at least 1 to 2 is a good starting point. This means that for every dollar you're willing to risk, you should aim to make at least $2 in profit. By sticking to this principle, you can afford to be wrong in some trades and still come out on top in the long run. So, remember, our scalping strategy isn't just about spotting opportunities, it's about safeguarding your capital and ensuring your trading journey is a sustainable one. Now that we've laid down the fundamentals of our scalping strategy, it's time to put theory into practice. Stay tuned as we move on to the practical application segment, where we'll demonstrate how to set up and test this strategy on Bitcoin 1-minute data. Get ready to witness these indicators in action. It's about to get exciting. Before we dive into the practical application of our scalping strategy, let's talk about a crucial step in any trading approach: backtesting. Backtesting is like a crystal ball for traders. It allows us to peer into the past and see how our strategy would have performed under different market conditions. It's not just important, it's absolutely essential. Now, let's take a moment to put our strategy to the test. We'll show you the results of running this scalping strategy on historical Bitcoin 1-minute data. This step isn't just about showing off. It's about gaining confidence in your strategy and understanding how it performs in different market scenarios. Once you've entered a trade using our scalping strategy, the next crucial step is monitoring it effectively. Keep a close eye on the price movement and market conditions. Here's when you might consider adjusting your stop loss or even taking early profits if the trade is moving in your favor. Speaking of exits, let's discuss the criteria for exiting a trade. It's just as important, if not more, than the entry. Your exit criteria should be clear and well-defined. It could be hitting a predetermined take-profit level, seeing a reversal signal, or any other factor that aligns with your strategy. And remember, discipline is key when exiting trades. Don't let emotions drive your decisions. Stick to your plan. To wrap things up, let's recap the key points of our scalping strategy. We've covered the importance of combining Heikin Ashi, Ikimoku, and alligator indicators, identifying entry and exit points, and the absolute necessity of risk management. But here's the golden nugget: practice and discipline are your allies in this journey. It's not about a single trade, it's about the consistency and mastery of your strategy. We're almost at the finish line, but the conversation doesn't end here. I want to hear from you, our amazing viewers. If you have any questions or want to share your trading experiences, don't hesitate to drop a comment below.
And here's a friendly reminder: before you dive into the live markets with this strategy, practice, and practice some more. Consider using a demo account to hone your skills and build confidence. Thank you for joining us today on this exciting journey through the world of scalping with Heikin Ashi, Ikimoku, and the alligator indicator combo. Your support means the world to us. If you found this video valuable, please show your appreciation by hitting that like button, subscribing to our channel, and ringing the notification bell. It helps us keep creating content to empower traders like you. And remember, your success in trading is a journey, not a destination. Keep learning, keep refining your skills, and keep your discipline intact. Until next time, happy trading!
Welcome to TQFM Trading Strategies. In today's video, we're diving into an innovative approach to cryptocurrency scalping using two powerful indicators: Heikin Ashi candlesticks and the moving average ribbon indicator. Heikin Ashi candlesticks are not your typical candlestick charting. They provide a unique way to analyze price movements, and when combined with the moving average ribbon indicator, they create a potent strategy for scalping in the volatile world of cryptocurrencies, specifically on Bitcoin's 1-minute charts. Let's start by understanding the foundation of our strategy. Heikin Ashi candlesticks offer a different perspective on price action, smoothing out the noise and presenting a clearer picture of trends. Contrasting them against traditional candlesticks reveals their distinct advantages in capturing market momentum. Now, let's introduce the moving average ribbon indicator. This tool comprises multiple moving averages, providing a comprehensive view of the trend's strength and direction. When integrated with Heikin Ashi, it fortifies our analysis, aiding in precise entry and exit points for scalp trades. Our strategy combines the moving average ribbon indicator, incorporating moving averages of lengths 20, 50, 100, and 200 to depict the long-term trend direction. These varied lengths provide a comprehensive perspective on the trend's strength and stability over different time frames. Complementing this, we utilize Heikin Ashi candlesticks to discern short-term trends. These specialized candles smooth out price fluctuations, enabling a clearer depiction of short-term market sentiment and momentum. The crux of our approach lies in aligning short-term trends with the prevailing longer-term trends. By leveraging Heikin Ashi to identify short-term fluctuations and comparing these against the moving average ribbon's indications of longer-term trends, we aim to trade in the direction that aligns both short and long-term perspectives. The moving average ribbon's longer-term averages act as a guide, indicating the overarching market direction. Meanwhile, Heikin Ashi candlesticks help in pinpointing opportune moments within these trends for scalping, ensuring trades align with the broader market sentiment. During our live testing on Bitcoin's 1-minute charts, we'll showcase how these indicators collaborate in real time. You'll witness how the moving average ribbon serves as a compass, guiding us with the long-term trend, while Heikin Ashi provides insights into shorter-term fluctuations. Visual representations will vividly illustrate how this synergy aids decision-making, allowing us to trade short-term movements in alignment with the prevailing long-term trajectory. This strategy's essence lies in its ability to synchronize short and long-term perspectives, offering traders a structured approach to capitalize on short-term opportunities within the context of broader market trends. Get ready for the exciting part. We're live testing this strategy on Bitcoin's 1-minute charts. Witness the indicators in action as we demonstrate real-time analysis. Visual representations will help you grasp how these indicators guide decision-making during rapid market movements. Here are 3 strengths and weaknesses of the strategy combining Heikin-Ashi candlesticks with the moving average ribbon indicator. Strengths. Trend alignment. One of the strategy's significant strengths is its ability to align short-term trades with the prevailing long-term trends. By using the moving average ribbon's various lengths, 20, 50, 100, 200, to identify long-term trends and Heikin-Ashi for short-term trends, it enables traders to trade in the direction that aligns both perspectives. This synchronization enhances the probability of trading in the overall direction of the market. Reduced noise and clarity. Heikin-Ashi candlesticks assist in smoothing out price fluctuations and presenting a clearer picture of short-term trends. This reduction in noise helps traders avoid false signals and provides a more coherent view of market movements, aiding in decision-making for scalp trades. Comprehensive analysis. The strategy combines 2 robust technical indicators, offering a comprehensive analysis of market dynamics. The moving average ribbon indicator provides a broad overview of trend strength and direction over multiple timeframes, while Heikin-Ashi candlesticks offer a different perspective on short-term price action. This dual approach enhances the depth of analysis and assists in making informed trading decisions. Weaknesses. Lagging indicator issue. Moving averages, particularly longer-term ones, inherently lag behind current price action. This lagging nature might result in delayed signals, especially during periods of rapid market movements or sudden trend changes, potentially causing traders to enter or exit positions later than desired. False signals in choppy markets. Heikin-Ashi, while smoothing out noise, may generate false signals in choppy or sideways markets. In situations where there's no clear trend or the market exhibits erratic movements, relying solely on short-term Heikin-Ashi signals might lead to incorrect trade entries or exits. Complexity and subjectivity. Utilizing multiple indicators and interpreting their signals could be complex for novice traders. Determining the precise entry and exit points based on the interplay between Heikin-Ashi and the moving average ribbon may require a deeper understanding and experience in technical analysis. Moreover, interpretations might vary among traders, leading to subjective decisions and potential confusion. Understanding these strengths and weaknesses can help traders adapt their approach, mitigate risks, and refine their strategies to suit different market conditions and trading styles. Our exploration has shed light on the potential of this strategy. However, trading always involves risks, and it's crucial to practice and adapt strategies to your individual preferences and risk tolerance. We encourage you to delve deeper into these indicators, experiment, and share your experiences. Subscribe to TQFM Trading Strategies for more insights into effective trading techniques, and don't forget to like and share this video. Thank you for joining us today. Keep an eye out for our future content as we continue our journey to explore and uncover new trading strategies. This is TQFM Trading Strategies, signing off. Happy trading, and until next time.
Welcome to TQFM Trading Strategies, your go-to destination for exploring innovative and effective trading techniques. Today, we're diving into the fascinating realm of the double median indicator trading strategy. Whether you're a seasoned trader or just stepping into the world of financial markets, understanding reliable trading strategies is paramount. The double median indicator is an intriguing approach that we'll be exploring today. It's gained attention for its potential to identify trends, gauge market sentiment, and aid in decision-making. In this video, we'll unravel the inner workings of the double median indicator, exploring how it's calculated, its applications in different market conditions, and most importantly, we'll put it to the test. By the end, we'll have a clearer view of its strengths and weaknesses, helping us determine if it's a valuable addition to our trading arsenal. Stay tuned as we dissect the double median indicator, examining its intricacies and conducting live market analyses. But first, let's understand the fundamentals and rationale behind this intriguing trading strategy. So, grab your notepads, buckle up, and let's delve into the double median indicator trading strategy. Don't forget to hit the subscribe button and ring the notification bell, as we'll be unraveling more exciting trading strategies in our future videos. Now, let's get started. Explanation of median and moving average. The median and moving average are both widely used statistical indicators in trading, offering insights into market trends and smoothing out price data. While they share similarities in their objective of indicating the underlying trend, their calculation methods and resulting interpretations differ significantly. The moving average, a common tool in technical analysis, calculates the average price of a security over a specified period, smoothing out fluctuations and highlighting the trend's direction. It's calculated by summing up a set number of closing prices and dividing them by the chosen period. This method is effective at reducing noise and providing a clear trend direction. On the other hand, the median indicator determines the middle value in a dataset when arranged in ascending or descending order. Unlike the moving average, which considers all values equally, the median focuses solely on the middle value, disregarding extreme highs or lows. It's robust against outliers and can offer a more stable representation of the central tendency in the data. Description of double median indicator strategy. For our double median indicator strategy, we'll utilize two median indicators within TradingView. The first median indicator will remain at the default setting with a length of 3, acting as the faster-moving component in our analysis. This quicker indicator responds swiftly to price changes, capturing short-term fluctuations in the market. The second median indicator, set to a length of 21, serves as the longer-term component in our strategy. This indicator aims to provide a broader perspective by considering a more extended period of price data. The 21-length median indicator is comparable to a longer-term moving average in a traditional moving average strategy, yet it operates based on median calculations rather than means. By employing these two median indicators with different lengths, we aim to create a comprehensive view of the market, leveraging the quicker indicator for short-term trends and the longer-term one for a broader assessment of the overall trend direction. In essence, while the double median indicator strategy employs settings reminiscent of a traditional double moving average strategy, the crucial distinction lies in the use of median indicators instead of moving averages, offering a unique perspective on market trends with a focus on robustness against extreme price movements. Implementation of the double median indicator strategy. Our application of the double median indicator strategy revolves around a trend-following approach, seeking to capitalize on the alignment of both shorter-term and longer-term trends in the market. When both the longer-term 21-length and shorter-term 3-length median indicators signal a bullish trend simultaneously, it triggers a potential buy signal. Conversely, a sell signal is generated when both indicators align in a bearish direction. The strategy's buy signal occurs when the shorter-term median indicator indicates a bullish trend, supported by the longer-term median indicator also signaling a bullish trend. This alignment suggests a strengthening upward momentum in the market, prompting a potential entry point for a long position. Conversely, the sell signal emerges when both median indicators turn bearish, indicating a potential downturn in the market. This alignment signals a potential exit point for an existing long position or a potential entry for a short position, depending on the trader's strategy. Pros and cons of the double median indicator strategy. Pros. Objective trend confirmation. The strategy relies on clear buy and sell signals generated by the alignment of two distinct median indicators, providing a more objective confirmation of trends. Robustness against noise. Median calculations are less affected by extreme outliers compared to traditional moving averages, potentially offering a more robust representation of the trend. Simplicity. The strategy's rules are relatively straightforward, making it accessible to traders of varying experience levels. Cons. Potential delay in signals. As a trend-following strategy, the double median indicator strategy might exhibit a delayed response to rapid market changes, potentially missing early entry or exit points. Whipsaw in choppy markets. During choppy or sideways market conditions, the strategy may generate false or conflicting signals, leading to losses or frequent trades without significant gains. Risk of trend reversals. Relying solely on trend alignment might expose traders to the risk of missing potential trend reversals, especially in volatile markets where trends can change abruptly. While the double median indicator strategy offers a systematic and straightforward approach to trend following, traders should exercise caution, combine it with other indicators or analysis techniques, and adapt it to suit varying market conditions and risk appetites to mitigate its limitations and maximize its strengths. Closing thoughts on the double median indicator strategy. As we conclude our exploration of the double median indicator trading strategy, it's crucial to underscore the significance of two fundamental pillars in successful trading: risk management and diligent research. While the double median indicator strategy presents a structured and systematic approach to identify potential trends and trading opportunities, it's imperative to emphasize the paramount importance of risk management. No strategy is foolproof, and prudent risk management strategies are the bedrock of sustained success in the markets. Employing techniques such as setting stop-loss orders, diversifying portfolios, and sizing positions appropriately are critical to mitigate potential losses and preserve capital. Furthermore, conducting your due diligence is indispensable. Backtesting any trading strategy, including the double median indicator approach, helps you understand its historical performance under various market conditions. This process enables you to assess its strengths, weaknesses, and overall viability before implementing it with real capital. Remember, a strategy that works exceptionally well in one market phase might falter in another, underscoring the importance of adaptability and continuous evaluation. Lastly, every trader's journey is unique. While educational resources and strategies like the double median indicator can provide valuable insights and tools, your trading decisions should align with your risk tolerance, financial goals, and personal circumstances. Always supplement any strategy with your analysis, understanding, and intuition about the market. In conclusion, the double median indicator strategy serves as a valuable addition to a trader's toolkit, offering a structured approach to trend following. However, success in trading demands a holistic approach that encompasses risk management, due diligence, and adaptability. By incorporating these principles into your trading journey and continuously refining your strategies, you pave the way for more informed, confident, and potentially profitable trading decisions. Thank you for joining us on this journey into the double median indicator strategy. Remember to stay curious, stay informed, and trade responsibly. Happy trading!
Welcome back to TQFM Trading Strategies. Today, we're diving into the exciting world of scalping trading strategies. If you're looking for a dynamic approach to trading that leverages the power of indicators, you've come to the right place. We'll be peeling back the layers of a strategy that could potentially boost your trading game to a whole new level. If you're just joining us, we're your go-to channel for in-depth explorations of trading strategies, market insights, some news, and all things trading related. So, if you're the sort of person who enjoys that stuff, don't forget to hit that subscribe button for related future content. In this video, we're about to explore a trend inside a trend strategy that utilizes not one, but two stochastic indicators, a fast one with a length of 20 and a slow one with a length of 200. These indicators are your trusty sidekicks when it comes to gauging market momentum and identifying ideal entry and exit points. Now, we all know that trading can be a roller coaster ride, with ups and downs, twists and turns. That's why we're going to reveal a strategy that can help you navigate the market's complexities with confidence. So, if you're eager to learn how to read the market signals like a pro and increase your chances of success, keep watching. Indicators, your guiding lights. Our strategy revolves around the dynamic duo of stochastic indicators. The fast stochastic with a length of 20 and the slow stochastic with a length of 200 are your compasses in this trading adventure. The fast stochastic is your short-term guide, while the slow stochastic takes the role of the long-term navigator. Strategy breakdown. Trend inside of trend. Our mission is to use the fast stochastic to target the trend within a more extended trend. When the slower stochastic is positioned at the bottom, signaling a potential downtrend, we exercise patience. We wait for the fast stochastic to bounce and give us the green light to sell. The goal here is to capitalize on a short-term dip within a more significant downward movement. Or vice versa for uptrends. Waiting for confirmation. Patience is the name of the game. We don't rush into action. Instead, we wait for both stochastic indicators to hit the bottom, signaling that the trend might be stabilizing. It's at this point that we make our exit, ensuring that we secure our profits. Vice versa for long positions. Now, when the slow stochastic climbs to the top, suggesting a potential uptrend, we shift our focus. We wait for the fast stochastic to pull back from its peak, indicating a potential buying opportunity. As the fast stochastic falls in line with the slow stochastic at the top, we know it's time to sell, locking in those gains. Know when to let go, but what if the trend falters? What if the slow stochastic crosses the midline? In such cases, our strategy is to abandon the position. This keeps us from riding a trend that's lost its steam, potentially preventing significant losses. The importance of risk management and position sizing cannot be overstated when employing technical strategies, especially when backtesting like we are today. These two elements serve as the protective shields in your trading arsenal. Risk management helps you define how much you're willing to lose on each trade, mitigating the potential for catastrophic losses. Position sizing, on the other hand, allows you to carefully allocate your capital, ensuring that you don't overcommit to a single trade and risk your entire stake. By incorporating sound risk management and position sizing strategies into your technical trading approach, you not only safeguard your capital but also pave the way for consistent, long-term success. Remember, in trading, it's not just about making gains, it's about preserving what you've earned, and these principles are the cornerstone of that journey. In the volatile world of scalping trading, where fortunes can change in the blink of an eye, having a well-defined strategy is your secret weapon. By harnessing the power of two stochastic indicators, you can navigate the market with confidence and precision. Remember, the key to success is not just in knowing when to enter a position but also when to gracefully exit. Whether it's riding the short-term waves within a larger trend or cutting your losses when the market takes an unexpected turn, this strategy offers you the tools to stay in control. In the world of trading, one fundamental truth remains: nothing is ever certain. Markets are dynamic, influenced by countless variables, and subject to unforeseen shifts. However, through diligent backtesting of various strategies, we can shed light on what works, what doesn't, and why. This invaluable process helps us gain a deeper understanding of market dynamics and equips us with the tools to make informed decisions. It's like charting a course through uncharted waters. While we can't predict every wave, we can learn to navigate them. Nevertheless, it's crucial to remember that trading isn't suitable for everyone, and risk tolerance varies from person to person. Before taking the plunge into the trading world, it's highly recommended to consult a personal financial advisor who can assess your individual circumstances and goals. Their guidance can be a crucial step in ensuring that your trading journey aligns with your financial well-being. Stay tuned for more insights and strategies right here at TQFM Trading Strategies, where we're committed to helping you become a more informed and successful trader. Happy trading, and may the markets be ever in your favor.
Welcome back to TQFM. Today, we've got an exciting topic lined up that's sure to pique your interest. We're diving deep into a popular day trading strategy, moving average crossovers. But before we jump into the specifics, let's set the stage by talking about why technical analysis plays a crucial role in trading. You see, in the world of trading, information is power. It's all about understanding price movements, trends, and patterns to make informed decisions. Technical analysis provides us with a toolkit to analyze historical price data and uncover potential trading opportunities. It's like having a roadmap to navigate the markets effectively. Now, back to our strategy for today, moving average crossovers. What makes this strategy fascinating is its simplicity and versatility. Whether you're just starting your trading journey or you're a seasoned pro, this strategy can be a valuable addition to your arsenal. Whether you're a day trader, swing trader, or even an investor, understanding moving average crossovers can give you insights into market trends that could help you make better trading decisions. So, stick around as we break down the moving average crossover strategy step by step, from setting it up to identifying buy and sell signals, all the way to risk management and live trading demonstrations. By the end of this video, you'll have a solid understanding of how to apply this strategy in your own trading journey. Let's get started. Now that we've set the stage, it's time to delve into the heart of our moving average crossover strategy. We'll start with Section 1, Understanding Moving Averages. So, what exactly are moving averages, and why are they so vital in trading? Well, think of moving averages as your trusty companions in deciphering market trends. At their core, moving averages are mathematical calculations that help us smooth out price data over a specified period. They reveal the average price of an asset over that time, making it easier to spot trends and filter out the noise. Now, there are two primary types of moving averages: simple moving averages, SMA, and exponential moving averages, EMA. Each has its strengths and use cases. The simple moving average, or SMA, gives equal weight to all data points within its period. It's straightforward and reliable, making it a popular choice for many traders. On the other hand, the exponential moving average, or EMA, assigns more weight to recent data points. This means EMAs react faster to price changes, making them preferred for shorter-term analysis. Choosing the right time frame for your moving averages is crucial. Shorter time frames, like the 5-day or 10-day, are great for day traders looking to catch quick trends. Longer time frames, such as the 50-day or 200-day, are excellent for investors assessing long-term trends. We got a solid grasp of moving averages. Now, it's time to set up our moving average crossover strategy. To start, we'll need two moving averages, the 50 period and the 200 period. But why these specific time frames? Let me explain. The 50 period moving average is often referred to as the short-term average. It reacts more quickly to price changes, making it great for identifying short to medium-term trends. Meanwhile, the 200 period moving average is the long-term player, smoothing out noise and helping us spot long-term trends. Now, let's get practical. I'm going to show you how to add these moving averages to a trading chart using a popular trading platform. Here we are on TradingView, but the process is quite similar on most platforms. Find the Indicators or Studies tab, search for Moving Average, and select it. Next, you'll need to set your parameters. Enter 50 for the short-term moving average and 200 for the long-term moving average. And there you have it. You've successfully set up the moving average crossover strategy on your trading chart. In this section, we covered why we choose the 50 period and 200 period moving averages and demonstrated how to add them to your chart. Now that we've got our moving average crossover strategy set up, it's time to understand how to spot those critical buy and sell signals. The heart of this strategy lies in two key signals, the golden cross and the death cross. Let's dive into what they mean and how to recognize them. First up, the golden cross. This occurs when the short-term moving average, in our case the 50 period, crosses above the long-term moving average, the 200 period. It's a bullish signal, suggesting that the asset's price is in an uptrend. Now, on the flip side, we have the death cross. This happens when the short-term moving average crosses below the long-term moving average. It's a bearish signal, indicating a potential downtrend. Golden cross, uptrend. Death cross, downtrend. It's that simple. These crossovers are powerful tools for traders to gauge market sentiment. Let's take a look at some real price charts to see when these signals occur and how they can guide our trading decisions. In this section, we've introduced you to the golden cross and the death cross, shown you real examples of when they appear on price charts, and explained what these signals imply about market trends. Stay tuned, as we're about to tackle an equally important aspect of trading: risk management. Now, before we continue, let's talk about something that's absolutely vital in trading: risk management. No matter how good your strategy is, trading involves risk. And that's why understanding and implementing proper risk management is crucial to your success. Here's the deal: risk management safeguards your capital and ensures you're not wiped out by a single bad trade. It's your safety net in the unpredictable world of trading. To protect your capital, you need to set stop loss and take profit levels. A stop loss is the price at which you're willing to exit a trade if it goes against you. A take profit level is where you lock in your gains. Let's say you're comfortable with a 1% risk on a trade. You can set your stop loss to limit potential losses to 1%, and you take profit to secure profits when they reach a certain level. Position sizing is another essential element of risk management. It's all about determining how much of your capital to allocate to a single trade based on your risk tolerance and account size. For instance, if your risk per trade is 1% and your account size is $10,000, you'd risk $100 on a trade. This helps ensure that no single trade can devastate your account. In this section, we've stressed the importance of risk management, explained how to set stop loss and take profit levels, and provided guidance on position sizing. Remember, successful trading isn't just about winning trades. It's about protecting your capital for the long run. As we approach the conclusion of this video, it's essential to evaluate the moving average crossover strategy and understand both its strengths and limitations. Let's recap. The moving average crossover strategy offers simplicity and versatility, making it accessible to traders of all levels. Its ability to identify trends can be incredibly powerful in the right hands. But it's not without its limitations. This strategy may struggle in choppy or sideways markets, generating false signals. Additionally, it can't predict market shocks or sudden reversals. Before you dive headfirst into live trading, I strongly encourage you to practice on paper or with a demo account. Get a feel for how this strategy works in different market conditions. It's a crucial step in your learning journey. Remember, no trading strategy is foolproof. Risk always exists in the markets. Even with the best strategy, you'll experience losses. That's why risk management, as we discussed earlier, is your shield against such losses. In conclusion, the moving average crossover strategy is a valuable tool, but it's just one tool in your trading toolbox. Understanding its pros and cons, practicing, and implementing sound risk management will be key to your success. Before we wrap up, a quick word of caution. Trading involves risk, and it's not suitable for everyone. It's crucial to consult with a financial advisor before diving into the markets. Your financial well-being is of utmost importance, and we want you to make informed decisions. Always do your research and seek professional advice when needed. Thank you for joining us today on this journey through the moving average crossover strategy and the world of trading. Your engagement means the world to us. If you'd like to connect further, you can find us on social media. Be sure to like, subscribe, and hit that notification bell to stay updated with our latest content. For additional resources and insights, visit our website at yourwebsite.com. We're here to support your trading journey and provide valuable information. Remember, trading is a continuous learning process. Keep honing your skills, practice diligently, and, most importantly, trade responsibly. Until next time, happy trading!
Hey there, traders, and welcome back to TQFM Trading Strategies, your go-to channel for cutting-edge trading insights and strategies. Today, we've got something exciting in store for you as we dive into the dynamic world of cryptocurrency trading. I'm your host, Your Name, and in this video, we're taking a closer look at a strategy that's been making waves in the crypto markets, the Double Fisher Indicator Combination Trading Strategy. Now, we know that the crypto space can be a wild ride, especially when you're dealing with the notorious Bitcoin, and that's why we're here to help you make sense of it all. In this video, we'll be focusing on the 1-minute charts of Bitcoin, a high-speed arena where fortunes can be made and lost in the blink of an eye. But before we dive into the nitty-gritty details of this strategy, let's take a step back and understand the thinking behind it. We believe that successful trading is not just about blindly following indicators, but also about comprehending why they work and how they can help you navigate the turbulent waters of cryptocurrency markets. So, join us on this journey as we break down the double Fisher indicator combination trading strategy, step by step, on the Bitcoin 1-minute charts. By the end of this video, you'll have a solid understanding of how this strategy operates and, more importantly, the thought process behind it. But remember, trading can be risky, and it's essential to have the right tools and knowledge at your disposal. So, make sure to hit that subscribe button, ring the notification bell, and stay tuned for our upcoming videos that will further enhance your trading skills. Without further ado, let's dive into the exciting world of the double Fisher indicator combination trading strategy on Bitcoin 1-minute charts. Are you ready to trade smarter? Let's get started.
In the world of financial markets, traders and investors continually seek innovative strategies and tools to gain an edge. One such tool, the double Fisher transform indicator, has gained popularity for its ability to filter out market noise and provide clear signals. In this essay, we will explore the origins of this indicator, its practical application using a 10 and 30 length combination, and discuss the importance of risk management and discipline in executing this trading strategy. The double Fisher transform indicator. The double Fisher transform indicator, also known as the Fisher transform indicator, was developed by John Ehlers, a prominent figure in the field of technical analysis. Ehlers, a respected engineer and trader, sought to create an indicator that could effectively identify trend reversals and filter out market noise. The Fisher transform accomplishes this by converting price data into a Gaussian normal distribution. In essence, it provides a statistical measure of price movement, making it easier for traders to identify turning points in the market. Using a 10 and 30 length combo, the double Fisher transform indicator is often more effective when used in combination with multiple time frames. For instance, a popular approach involves using a 10 length and a 30 length double Fisher transform. The 10 length indicator provides a shorter term perspective, while the 30 length indicator offers a longer term view. By employing this combo, traders can gain a more comprehensive understanding of market trends. The 10-length indicator is sensitive to short-term price fluctuations and offers signals that respond quickly to market changes. It is useful for identifying intraday trading opportunities and short-term trend reversals. On the other hand, the 30-length indicator provides a broader perspective and is effective in identifying long-term trends and major trend reversals. It filters out short-term noise and helps traders make more informed decisions regarding medium to long-term positions. The combination of these two indicators allows traders to strike a balance between short-term and long-term trading goals. The 10-length indicator helps identify entry and exit points for short-term trades, while the 30-length indicator offers insights into broader market trends, helping traders make more informed investment decisions. Risk management and discipline. No trading strategy is complete without a robust risk management and discipline framework. Trading the double Fisher transform indicator requires strict adherence to these principles. Position sizing. Determine the appropriate position size based on the level of risk you are willing to take for each trade. Avoid over-leveraging and diversify your portfolio to minimize risk. Stop-loss orders. Always set stop-loss orders to limit potential losses. The double Fisher transform indicator can provide accurate signals, but it's not infallible. Protect your capital by cutting losses when necessary. Risk-reward ratio. Evaluate the risk-reward ratio for each trade. A favorable risk-reward ratio can significantly improve the overall profitability of the strategy. Emotional control. Emotions can be a trader's worst enemy. Stick to your trading plan, and do not let fear or greed drive your decisions. Maintain a disciplined approach to executing trades. Continuous learning. The financial markets are dynamic and subject to change. Keep learning, adapt to evolving market conditions, and refine your trading strategy as needed. Conclusion. The double Fisher transform indicator trading strategy, when combined with a 10 and 30 length combo, offers traders a powerful tool to identify market trends and make informed trading decisions. Developed by John Ehlers, this indicator transforms price data into a Gaussian normal distribution, reducing market noise and enhancing trend identification. However, its effectiveness is heavily reliant on proper risk management and discipline. Success in trading the double Fisher transform indicator requires prudent position sizing, setting stop-loss orders, maintaining a favorable risk-reward ratio, emotional control, and continuous learning. By following these principles, traders can harness the potential of this indicator to enhance their trading strategies and increase their chances of success in the dynamic world of financial markets.
Today we're going to do a video about one way you could scalp Bitcoin and other crypto using the Fisher transform indicators. The Fisher transform is an equation built by, the Fisher guy. You can find it on TradingView under Fisher transform. It looks something like this. We're going to want two of them, and we're going to put them together to do this. And you can go ahead and you can set that first one to 10. And you can probably go ahead and set that second one to 30. And you can turn the faster one green and the slower one red. It should give you something looking a little bit like this. And the Fisher transform is a working momentum indicator that can show you changes in momentum, or that is otherwise, you can call that change of price over time. And when we look at this graph and two separate equations, a faster one and a slower one, we can look at the relative change over time to itself, which gives us something like this. And the whole thought about this is to look at when price and momentum begin to diverge along a trend. So let's look at just right here. This is a good trend. So it's under the middle lines. That means it has a lot of downward momentum here, obviously. Very, very specific downward trend. And then it starts to break through the middle line, and it comes back down. And it doesn't pierce the bottom there. That means this could be a solid, or the start of a solid little bit uptrend. So you could take a long as this crosses back over under here, or as it crosses back up. So we're just going to do it at that first high, because we're aggressive with it, let's say. And you can take it to the bottom of the low there. And the idea is you want to hold it until you start to see momentum divergence in the other direction. You see the faster momentum breaking down below, or you see the slower momentum starting to cut through the middle line here, and definitely when they both get below, like down here, you want to be out before that. And it's a free active trading process. So let's go forward in here and look at some sample trades. Alright, it's starting to break up a little bit. So look at a long, come back down, so we'll get into one of those. Lows. And let's goes. Oh, it's starting to fail really quickly. Yeah, they're probably stopping out of that one. So if you took it anywhere in there, I'm just going to say, like, right down there. You lost a little bit on that one bailing out. See what happened. Yes, and lot shot. So in this example, you see it's building some strength, and it goes back down and crosses under. So I want to see it hold that. And let's go with a long right there, and under there. And let's see what happens. That easy. See, it's running at the top there. Is it running above? Running above. Alright, see, it's starting to come down below. It's a good trade. You can go ahead and take that off.
Welcome to this video on a versatile scalping trading strategy that can be applied to any market and time frame. Have you ever felt overwhelmed by the vast sea of trading strategies out there?
Do you dream of finding a trading approach that's versatile, adaptable, and most importantly, effective? Well, you're in the right place. Welcome to TQFM Trading Strategies, where we test all sorts of trading strategies so you can save time on your backtesting and education yourself. Today, we're unveiling a scalping strategy that's not just powerful but flexible. Join us, and let's explore the world of profitable scalping together. If you're new here, welcome to TQFM Trading Strategies, your go-to destination for comprehensive and insightful trading content. If you're into that sort of thing, make sure to subscribe for more. We'll be using tradingview.com to demonstrate this strategy, which combines two powerful indicators, Bollinger Bands and the Arun indicator. The beauty of this strategy is its adaptability, allowing traders to fine-tune it through experimentation and share their insights in the comments below. Whether you're a beginner or an experienced trader, you'll find valuable insights in this video. So, let's dive in and explore how to make the most of this strategy for successful scalping. In the background, we will be demonstrating the setup of these indicators on tradingview.com, and we'll provide examples of trades in different market conditions. So, don't forget to watch the entire video to see these principles in action. Remember, practice and patience are key to mastering any trading strategy, so happy scalping, and let's dive into the world of successful trading.
The first key component of this strategy is the Bollinger Bands, which are set with a length of 20 and 2 standard deviations. Bollinger Bands consist of a simple moving average, SMA, in the middle and 2 standard deviation lines, creating a channel around the price. Here's how you can use them for scalping. During uptrends, when the price is in an uptrend, look for opportunities to buy near the lower Bollinger Band. This is an optimal entry point because it often corresponds to a temporary pullback within the broader upward trend. Sell at the top. Conversely, when the price reaches the upper Bollinger Band during an uptrend, it may be a good time to consider taking profits. This is an indicator that the price might be overextended. Tight stop loss. To manage risk, set a tight stop loss order just below the lower Bollinger Band when going long or above the upper Bollinger Band when going short. This minimizes potential losses in case the trend reverses. The second component of this strategy is the Arun indicator, which is set to a length of 120 bars. The Arun indicator provides insights into longer-term trends and helps confirm your scalping decisions. Uptrend confirmation. When the Arun indicator makes a peak near 100 during an uptrend, it's a strong signal that the market is in a longer-term bullish trend. This complements the Bollinger Band signals, giving you added confidence in your long entries. Downtrend confirmation. For short positions, wait for the Arun indicator to peak near 100 during a downtrend. This signifies a longer-term bearish trend, making it a suitable time to consider selling. By combining Bollinger Bands and the Arun indicator, you have a powerful scalping strategy that offers both entry and confirmation signals. The adaptability of this strategy to different markets and time frames is a significant advantage. As you experiment and fine-tune the parameters, remember to share your findings in the comments below to foster a community of learning and improvement. Before we conclude, it's crucial to emphasize the risks involved in trading. Trading, especially in volatile markets, can lead to significant financial losses. Therefore, it's essential to approach trading with caution and a clear risk management strategy. Remember that no trading strategy is foolproof, and past performance does not guarantee future results. We strongly encourage you to consult with a personal financial advisor or seek professional guidance before making any trading decisions. A financial advisor can help you align your trading goals with your broader financial plans and ensure that your trading activities are suitable for your unique circumstances. Lastly, if you found this video helpful and informative, please consider showing your support by liking and subscribing to our channel. By doing so, you'll stay updated with our latest trading strategies, tips, and market insights. Your support keeps us motivated to provide you with more valuable content. Thank you for watching, and we look forward to having you as part of our trading community. Welcome back to another exhilarating episode of TQFM Trading Strategies, the channel that's your compass in the ever-changing seas of the financial markets. Our mission remains the same, empowering you with the knowledge and strategies needed to not just survive, but thrive in the trading world. In today's video, we're about to unleash a trading strategy that's like a finely tuned sports car built specifically for Bitcoin's 1-minute bar chart data on TradingView. It's fast, it's agile, and it's designed to seize opportunities in the blink of an eye. Picture this, 3 powerful indicators working in harmony, their signals synchronized to pinpoint those fleeting moments of potential profit. We're talking about super trends, Bollinger Bands, and the art of scalping. It's a strategy that's tailor-made for traders who crave action, excitement, and the thrill of quick wins. As we delve into this strategy, we'll dissect its core elements, revealing how to not only harness short-term fluctuations, but also to tap into the broader medium and longer-term trends. Yes, you heard it right. We're going to show you how to navigate the rapids of crypto's wild price swings with finesse. So, if you've been searching for a strategy that's as dynamic as the cryptocurrency markets themselves, you're in the right place. Buckle up, because we're about to dive headfirst into a world of trading where opportunity knocks every minute. First off, let's set up our indicators. Super trend, 10 length, with a factor of 10 for medium-term trend identification. Another super trend, 10 length, with a factor of 30 for slow trend confirmation. Bollinger Bands, 20 length, with a standard deviation of 2 for short-term price volatility assessment. Our strategy revolves around using the Bollinger Bands to measure short-term fluctuations and the super trends to identify medium and longer-term trends. Here's how it works. In an uptrend, we're looking to buy when the price is near the lower Bollinger Band. This is our entry point. We aim to scalp a profit until the price bounces off the middle Bollinger Band, indicating the continuation of the trend. Conversely, in a downtrend, our selling point is when the price bounces to the top Bollinger Band. This is where we exit to secure profits. We'll wait for the price to fall back to the lower Bollinger Band to continue riding the downward trend. Now, it's crucial to manage your risk properly. You can either trade singular lots or use a pyramiding risk structure. Pyramiding involves adding to your position as the trade goes in your favor. Just remember to set stop-loss orders to limit potential losses. Let's look at an example trade to illustrate this strategy. Identify an uptrend with the super trend indicators and check that the price is near the lower Bollinger Band. Enter a buy position. Scalp for profits until the price bounces off the middle Bollinger Band. Secure your gains and set a stop-loss. Wait for another opportunity or re-entry. Now, before we rush into the exciting world of implementing this scalping strategy, it's essential to consider both the pros and cons. As with any trading strategy, there are potential benefits and drawbacks that you need to be aware of. Pros. 1. Quick profits. One of the most significant advantages of this strategy is the potential for rapid, short-term profits. Scalping allows you to capitalize on small price movements, potentially leading to numerous winning trades in a single day. 2. Risk management. The use of stop-loss orders is inherent in this strategy, which can help limit potential losses. When used effectively, it can provide a structured approach to risk management. 3. Adaptability. This strategy is versatile and can be applied to various markets and assets, not just Bitcoin. It can be especially effective in highly volatile markets. 4. Learning opportunity. Scalping demands that you closely monitor the market and indicators, which can be an excellent learning experience for traders, helping them become more proficient in technical analysis. Cons. High frequency and stress. Scalping requires constant attention to the market, often leading to high-frequency trading. This can be mentally and emotionally taxing, potentially leading to stress and burnout. Transaction costs. Frequent trading can result in higher transaction costs due to spreads, commissions, and fees, which may eat into your profits. Risk of overtrading. The excitement of quick profits can tempt traders into overtrading, taking excessive positions and increasing the risk of substantial losses. Small margins. Scalping relies on small price movements, which means that individual trade profits are often relatively small. To make substantial gains, you may need to take on more significant positions, increasing risk. Market noise. In the 1-minute chart, market noise and false signals are common, making it challenging to distinguish between genuine trends and random fluctuations. As you can see, there are both potential rewards and risks associated with this scalping strategy. Before you dive in, it's essential to assess your risk tolerance, develop a solid risk management plan, and thoroughly backtest the strategy to ensure it aligns with your trading goals and objectives. Keep in mind that no strategy is foolproof, and success in trading often comes down to discipline, adaptability, and continuous learning. So, as we move forward, remember to weigh these pros and cons carefully and tailor this strategy to your unique trading style and preferences. And there you have it. A scalping strategy tailored for Bitcoin's 1-minute bar chart data using Supertrend and Bollinger Bands. Remember, this strategy requires discipline, risk management, and continuous monitoring of the indicators. Before we wrap up today's discussion, I want to leave you with a crucial reminder about the inherent risks in trading. While we've presented you with a powerful scalping strategy tailored for Bitcoin's 1-minute chart, it's essential to recognize that trading, especially in volatile markets like cryptocurrencies, carries significant risk. No strategy, no matter how well crafted, can guarantee profits. Markets can be unpredictable, and price movements can change in an instant. What we've provided here is a framework, a starting point, but it's up to you as a trader to conduct your own tests, due diligence, and risk assessment. Always remember that every trade you make involves real money, and it's your hard-earned capital at stake. It's crucial to have a clear risk management plan in place, set stop-loss orders, and never trade with money you can't afford to lose. Furthermore, we strongly recommend consulting with a financial advisor or a professional before making any investment decisions. They can provide you with personalized guidance and help you align your trading strategies with your financial goals and risk tolerance. Lastly, if you found this video helpful and informative, please consider showing your support by hitting that like button and subscribing to our channel. Your engagement fuels our passion to provide you with more trading insights and strategies. And, as always, let us know in the comments if there are specific trading topics or strategies you'd like us to cover in future videos. We're here to empower you on your trading journey, and your feedback is invaluable. Thank you for joining us today on TQFM Trading Strategies. Stay vigilant, stay informed, and remember that knowledge and discipline are your greatest assets in the trading world. Until next time, happy trading.
In the fast-paced world of trading, having a solid strategy is the key to success. In this video, we will delve into a powerful trading strategy that employs two technical indicators, the median indicator set to 30 and the McGently dynamic moving average set to 100. We'll explore how these indicators can work in harmony to help traders identify profitable opportunities while managing risk effectively. Technical indicators are essential tools for traders, providing valuable insights into market trends and potential entry and exit points. The median indicator and McGently dynamic moving average are no exceptions. These indicators offer unique advantages when used together, making them a valuable addition to any trader's toolkit. Understanding the median indicator, 30. Before we dive into the intricacies of this strategy, it's essential to have a comprehensive understanding of the median indicator set to 30. This indicator, which has its roots in statistical analysis and technical analysis, is designed to calculate the median price over a 30-period lookback. The concept of the median, a central measure of a dataset, is crucial here. It represents the middle point of a set of numbers when arranged in order, effectively cutting the data into two equal halves. In the context of trading, the median indicator's operation is straightforward yet powerful. It takes the median of the high and low prices over the past 30 periods, creating a single data point for each period. This process smooths out price fluctuations and noise in the market, offering a more stable and less erratic representation of price movement. Imagine a river with turbulent waters. The median indicator acts as a filter, making the water appear calm and navigable. By doing so, it helps traders identify underlying trends more clearly, enabling them to make informed trading decisions. When the median indicator aligns with the McGently dynamic moving average, it signals a strong consensus in the market direction, enhancing the reliability of our trading strategy. McGently dynamic moving average, 100. Moving on to the McGently dynamic moving average set to a 100-period lookback, this technical indicator stands out due to its adaptability, which sets it apart from traditional moving averages. While conventional moving averages provide a simple average of past prices over a fixed period, the McGently dynamic moving average goes a step further. It possesses a unique ability to adjust its calculation method according to the market's dynamics, making it a valuable tool for traders seeking to capture more extended trends and maximize profit potential. Traditionally, fixed-period moving averages tend to be slower in responding to market changes, often resulting in delayed signals. The McGently dynamic moving average, on the other hand, is designed to adapt swiftly to shifting market conditions. This adaptive feature allows it to stay closer to the current price action, effectively reducing lag. Imagine you're driving a high-performance car on a winding road. Conventional moving averages are like a sluggish, heavy vehicle that struggles to take sharp turns. In contrast, the McGently dynamic moving average is akin to a nimble sports car, smoothly navigating every twist and turn of the market. This agility is invaluable because it enables traders to stay in trends longer, potentially leading to substantial profits. When we combine the adaptability of the McGently dynamic moving average with the stability offered by the median indicator, we create a synergy that enhances our trading strategy's effectiveness. The McGently dynamic moving average helps us capture trends with precision, while the median indicator filters out noise and sharp fluctuations, providing a clear and reliable signal for trade entries and exits. Together, they form a potent combination that can significantly improve our trading performance. Strategy overview. Now, let's combine these two powerful indicators to create a robust trading strategy. By using both the median indicator and McGently dynamic moving average, we can identify bullish and bearish signals with greater confidence. The key here is to wait for both indicators to align, confirming the direction of the trade. This approach significantly reduces the likelihood of entering false signals and improves the overall accuracy of the strategy. Trading rules. For successful implementation of this strategy, it's crucial to establish clear trading rules. We'll discuss the entry signals for both bullish and bearish trades and emphasize the importance of setting stop-loss and take-profit levels to manage risk effectively. Additionally, we'll delve into position sizing and risk management strategies to ensure that your trading account remains safeguarded. Backtesting and historical performance. Before putting this strategy into action, it's essential to validate its effectiveness through backtesting. We'll explore the importance of historical performance analysis, sharing real-world results obtained using this strategy. Moreover, we'll candidly discuss any limitations or drawbacks to provide a comprehensive understanding of what to expect. Practical application. Trading isn't just theory, it's a practical endeavor. We'll provide valuable tips on how to apply this strategy in real trading scenarios. Discipline and patience are virtues every trader must cultivate, and we'll stress their significance. Real-life examples of trades executed using this strategy will further illustrate its potential. Conclusion. In conclusion, the median indicator, 30, and McGently Dynamic Moving Average 100 trading strategy offers traders a powerful toolset to navigate the financial markets. We've highlighted the importance of risk management throughout this journey. As you explore and practice this strategy, remember that successful trading requires dedication and continuous learning. We invite you to like, subscribe, and comment on this video to join our trading community and stay updated with our latest insights. Unlock the profit potential of this strategy and embark on a journey toward more informed and profitable trading decisions. Happy trading! Hey there traders, and welcome back to TQFM Trading Strategies. Are you ready to dive into a trading technique that's as thrilling as it is effective? Well, you're in for a treat because today, we're unveiling a game-changing approach to 1-minute scalping that utilizes Bollinger Bands and the Super Trend Indicator. But that's not all. We're adding a unique twist that involves using the FAR Bollinger Band as your initial stop loss and aiming for a tantalizing 2-to-1 risk-reward ratio. But hold on tight, because we're not just here to drop knowledge bombs. We're here to help you master this strategy step by step. From setting up your charts and indicators to seizing those trade opportunities and locking in profits, we've got you covered. So, whether you're an experienced scalper looking to level up your game or a newcomer eager to explore the world of short-term trading, this video is your golden ticket. And here's the best part, we won't just throw theories at you. We'll illustrate everything with real-time chart action. You'll see the Bollinger Band squeezing, the Super Trend Indicator signaling trends, and the exciting breakouts that we're after. Plus, stay tuned for a mind-blowing risk-reward strategy that could completely reshape how you approach scalping. But remember, trading isn't just about strategies, it's about discipline, risk management, and making informed decisions. We'll dive deep into those aspects too, ensuring you're not just a scalper, but a smart scalper. So, whether you're watching from your trading desk, your comfy couch, or even during your coffee break, make sure to hit that like button, subscribe to TQFM Trading Strategies for more exciting content, and drop a comment. We love hearing from you. Now, let's embark on this scalping adventure together and unlock the potential of Bollinger Bands, Super Trend, and our groundbreaking risk-reward strategy. Ready to take your trading to the next level? Let's roll! Mastering 1-minute scalping with Bollinger Bands and Super Trend, a guide. Unlock the potential of 1-minute scalping by harnessing the power of Bollinger Bands and the Super Trend Indicator. In this guide, we will delve into a sophisticated strategy that utilizes technical analysis to its fullest. Brace yourself for high-speed decision-making as we explore a technique that employs the FAR Bollinger Band as an initial stop loss and targets a 2-to-1 risk-reward ratio. Step 1. Crafting your chart and indicators. Select a trusted platform. Secure a trading platform that offers real-time 1-minute charts, the Bollinger Bands, and the Super Trend Indicator. Configure your charts. Unveil the 1-minute candlestick chart of your chosen asset. This chart will be your lens into the market's micro-movements. Infuse Bollinger Bands. Embed Bollinger Bands onto your chart. These bands encompass a central simple moving average, SMA, along with 2 bands positioned at a distance of 2 standard deviations from the SMA. The standard setting consists of a 20-period SMA. Employ the Super Trend Indicator. Implement the Super Trend Indicator on your chart. This indicator is a dynamic guide to discern the prevailing trend direction. Feel free to adjust the parameters in accordance with your preferences and the asset characteristics. Step 2. Identifying propitious trading scenarios. Trend determination. Before plunging into any trades, decipher the overarching trend direction using the Super Trend Indicator. This indicator illuminates either a bullish, upward, or bearish, downward, trend. Bollinger Band expansion. Keep a vigilant eye on a phase of heightened volatility. This is characterized by the Bollinger Bands expanding, indicating a potential price surge or drop. This moment is your cue for action. Confirmation. Wait for the price to breach the farthest Bollinger Band in the direction of the prevailing trend. This breakout should ideally be accompanied by a robust candlestick closure beyond the Bollinger Band. Step 3. Entry and exit precision. Entry point, upon the breakout, promptly enter the trade in alignment with the trend. You can execute this via market orders or pending orders, based on your preference. Initial stop loss. Set a precise initial stop loss just beyond the far Bollinger Band in the opposite direction of your trade. This acts as a safety net to curtail potential losses if the market reverses. 2-to-1 risk-reward ratio. Aim for a profit target that's twice the size of your initial risk. Calculate the distance from your entry point to your stop loss, and then set your take profit level at double that distance. This balances the risk and reward for each trade. Step 4. Risk management and additional insights. Sizing up positions. Exercise caution by only risking a small percentage of your trading capital per trade. Given the frequency of scalping, even a string of unfavorable trades shouldn't dent your account significantly. Consistency matters. Abide by your trading strategy and stay immune to emotional impulses or attempts to recoup losses hastily. Time window. Be present and attentive during active trading hours, minimizing distractions. Dry runs first. Practice executing this strategy on a demo account before transitioning to real trading. This prepares you for real-time dynamics and boosts confidence. To wrap it up by coupling the prowess of Bollinger Bands and the super trend indicator, and introducing the far Bollinger Band as an initial stop loss and a 2-to-1 risk-reward ratio, you're poised to conquer the intense world of 1-minute scalping. This strategy thrives on swift decision-making, technical finesse, and the ability to thrive amidst rapid market fluctuations. Prioritize risk management, and remember to practice diligently before taking on the real market. Welcome back to TQFM Trading Strategies. Today, we have an exciting topic to delve into that can potentially enhance your trading game. We'll be exploring the moving average ribbon trading strategy, a powerful trend-following approach that can help you identify profitable opportunities in the markets. But before we dive in, let's understand what the moving average ribbon is and how it can benefit us as traders. The moving average ribbon is not your average moving average. Instead of relying on just one moving average, this strategy incorporates multiple moving averages to create what we call a ribbon effect. This ribbon consists of various moving averages displayed on the price chart, allowing us to visualize the trend's strength and direction in a clearer manner. Each moving average in the ribbon is represented by a distinct color, and as they spread apart or converge, they provide valuable insights into the market's overall trend dynamics. The primary purpose of this video is to equip you with a step-by-step guide to implement the moving average ribbon trading strategy effectively. By the end, you'll be able to confidently spot entry and exit signals, potentially improving your trading results. Here's what you can expect from this video. Understanding the concept of the moving average ribbon and its significance in trend analysis. Learning the specific rules for entering both long and short positions using this strategy. Placing the initial stop-loss level to manage risk effectively. Activating and utilizing the trailing stop feature to protect profits during extended trends. As you'll see, the moving average ribbon can help you identify profitable trades when the conditions are right. But remember, like any trading strategy, it has its advantages and limitations, which we'll discuss later. So, whether you're a beginner or an experienced trader, this video is for you. By the end of it, you'll have a solid understanding of the moving average ribbon trading strategy and be ready to incorporate it into your trading toolkit. Before we continue, if you find value in this content, make sure to hit that subscribe button and give us a thumbs up to support the channel and stay updated with future videos on trading strategies. Alright, let's get started with the moving average ribbon trading strategy. Strap in and let's explore how this technique can potentially take your trading to the next level. So, without further ado, let's jump right into it. So, what exactly is the moving average ribbon? Unlike a traditional single moving average, the ribbon consists of several moving averages, each displayed with a different color on the price chart. Let's see how it differs from a single moving average. In this example, we have the classic 50-day simple moving average shown in blue. Now, let's replace the single moving average with our moving average ribbon. As you can see, the ribbon spreads across the chart, creating a vibrant band of colors. Each colored line represents a distinct moving average, and the ribbon's width reflects the dispersion of these moving averages around the price data. This dispersion is what grants the ribbon its unique visual characteristics. The significance of using multiple moving averages lies in its ability to filter out noise and provide a clearer picture of the overall trend. When the ribbon is tightly packed, it signals a period of consolidation or a sideways market. Conversely, when the ribbon spreads apart, it indicates a strengthening trend. By observing the spacing and convergence of the moving averages in the ribbon, traders can quickly determine the strength and direction of the prevailing trend. During a strong uptrend, you'll notice the ribbon expands upward with distinct separation between the moving averages. On the other hand, during a pronounced downtrend, the ribbon spreads downward with the moving averages maintaining a clear distance. In range-bound markets or periods of indecision, the ribbon contracts and moves horizontally, signaling that the market lacks a clear trend direction. Furthermore, crossovers between different moving averages in the ribbon can provide early signals for potential trend changes, giving us an advantage when entering or exiting positions. So, to sum it up, the moving average ribbon indicator offers traders a dynamic way to visualize the strength and direction of the trend. Its multi-moving average approach provides valuable insights into trend dynamics, helping us identify potentially profitable opportunities. Now that we understand the moving average ribbon indicator, it's time to put this powerful tool into action. In this section, we'll explore the specific entry rules for both long and short positions using the moving average ribbon. Let's kick things off with long positions. To enter a long trade, we wait for a specific event to unfold on our moving average ribbon chart. Long entry rule, we look for the two faster moving averages in the ribbon to cross above the slower moving average. Here's a clear example of a long entry. The two faster moving averages, represented by the green and yellow lines, cross above the slower moving average, shown in red. This crossover signals a potential upward trend, and it's our cue to consider going long. Moving on to short positions. The entry rules for short trades are essentially the reverse of long trades. Short entry rule, we watch for the two faster moving averages in the ribbon to cross below the slower moving average. In this example, we have a clear short entry signal. The green and yellow moving averages cross below the slower red moving average, indicating a possible downtrend. This crossover prompts us to consider entering a short trade. Visual aids are essential for understanding these concepts better. Let's take a closer look at a few more examples. As you can see in these examples, the moving average ribbon provides us with straightforward entry signals, making it easier to spot potential trading opportunities. Now, before rushing into any trade, it's important to exercise caution and use additional confirmations, such as support and resistance levels or other technical indicators, to strengthen your trade decisions. Now that we've identified our entry points using the moving average ribbon, it's time to discuss an essential aspect of successful trading: risk management. In this section, we'll explore how to set an initial stop-loss level to safeguard our capital. Placing a stop-loss is crucial because it acts as a safety net, limiting potential losses if the market moves against our trade. So, how do we determine the initial stop-loss level using the moving average ribbon? For long positions, we look for the last significant low on the fastest moving average. Here's how it works. Suppose we've entered a long trade after the faster moving averages cross above the slower one. Now, we locate the last significant low on the fastest moving average. We then place our initial stop loss just below that last significant low. By doing so, we protect our trade from excessive losses in case the market reverses. Let's see this approach in action with a historical example. In this example, we entered a long trade when the faster moving averages crossed above the slower one. As the trade progresses, we identify the last significant low on the fastest moving average. Placing our initial stop loss just below that low level provides us with a safety buffer. Even if the price retraces temporarily, our risk is limited, and we can stay in the trade with peace of mind.
The same principle applies to short positions, but in reverse. For shorts, we look for the last significant high on the fastest moving average. Once again, let's illustrate this with a historical example. In this case, we entered a short trade when the faster moving averages crossed below the slower one. We then locate the last significant high on the fastest moving average. Placing our initial stop loss just above that high level protects our position from potential adverse moves, ensuring that our risk is managed effectively. In this section, we'll explore an essential component of the moving average ribbon trading strategy, the trailing stop. This powerful feature can help us protect our profits and stay in winning trades during extended trends. So, how do we activate the trailing stop? During a long position, we watch for a specific event on our moving average ribbon chart. Trailing stop activation, we look for the fastest moving average to rise above the slowest moving average. Once this happens, our trailing stop is activated, and it marks a turning point in our trade management. Now, let's delve into the concept of a trailing stop and its benefits. Unlike a fixed stop loss, which remains stationary, the trailing stop adjusts dynamically as the price moves in our favor. This means that as the price continues to move in the desired direction, the trailing stop moves along with it, maintaining a distance from the current price level. The beauty of the trailing stop is that it allows us to lock in profits during trending markets. If the price retraces slightly, the trailing stop won't be triggered, giving our trade some room to breathe. Only when the price reverses significantly against our position will the trailing stop be activated, closing the trade and securing the profits we've accumulated. But how do we adjust the trailing stop to the slowest moving average? Once the trailing stop is activated, we simply move our stop loss level to the price level of the slowest moving average in the ribbon. Let's see this in action with an example. In this hypothetical long trade, as the fastest moving average rises above the slowest one, our trailing stop gets activated. As the price climbs, the trailing stop dynamically moves with it, securing our gains along the way. Finally, when the trend eventually reverses and the fastest moving average crosses below the slowest, our trade is automatically closed at the price level of the slowest moving average. Advantages of the moving average ribbon trading strategy. Trend identification. The moving average ribbon helps traders identify the prevailing trend with greater accuracy. By using multiple moving averages, the ribbon offers a clear visual representation of trend strength and direction, making it easier to spot potential entry and exit points. Noise reduction. Incorporating several moving averages in the ribbon reduces market noise and false signals that could mislead traders. The strategy filters out short-term fluctuations, providing a smoother and more reliable trend analysis. Maximizing profits in strong trends. The trailing stop feature in the strategy allows traders to stay in winning positions during extended trends. By dynamically adjusting the stop-loss level as the price moves in the desired direction, the strategy helps lock in profits and potentially ride significant price movements. Limitations and possible challenges. False signals. Like any technical indicator, the moving average ribbon may generate false signals, especially during choppy or sideways markets. Traders must exercise caution and use additional confirmations to avoid entering trades based solely on ribbon crossovers. Whipsaws in volatile markets. During periods of high volatility, the ribbon may produce whipsaws, frequent and sudden changes in trend direction. These false signals can lead to premature stop-outs and potentially erode profits. Market adaptation. While the strategy can be effective in trending markets, it may not perform optimally in range-bound or consolidating markets. Traders should be aware of the strategy's limitations in various market conditions and consider employing alternative approaches when necessary. In this final section, we'll discuss a crucial aspect of successful trading: risk management and position sizing. Implementing proper risk management techniques is vital to preserving your capital and ensuring long-term profitability. As exciting as trading can be, it comes with inherent risks. It's essential to approach the markets with a disciplined mindset and a well-thought-out risk management strategy. To protect your trading capital, never risk more than you can afford to lose on any single trade. Setting a reasonable risk percentage for each trade ensures that no single loss can significantly impact your account. A common rule of thumb is to risk no more than 1 to 2% of your total account balance on any trade. This approach allows you to stay in the game even during a series of losing trades. Additionally, consider your risk tolerance level. Some traders may be comfortable with higher risk levels, while others prefer a more conservative approach. Tailor your risk management strategy to suit your individual comfort zone. Congratulations, traders! You've now unlocked the secrets of the moving average ribbon trading strategy. Let's quickly recap the key points before you dive into the markets. The moving average ribbon offers multiple advantages, including improved trend identification, noise reduction, and the potential for maximizing profits during strong trends. However, be aware of the limitations, such as false signals and whipsaws during volatile market conditions. Always use additional confirmations and exercise caution when trading. Proper risk management is the backbone of successful trading. Determine your risk tolerance, set appropriate position sizes, and diversify your trades to protect your capital. Before you take the strategy into the live markets, practice it on demo accounts to gain confidence and refine your skills. Remember, discipline and patience are essential virtues in implementing any trading strategy. Stick to your plan, manage your emotions, and stay focused on the bigger picture. Thank you for joining us on this exciting trading journey. If you found this video valuable, don't forget to like, share, and subscribe to the TQFM Trading Strategies channel. We're dedicated to providing you with more valuable content to help you on your trading path. In our future videos, we'll explore more trading strategies, risk management techniques, and the latest market insights. So, hit that subscribe button, give us a thumbs up, and turn on the notification bell to stay updated. Thank you for being part of our trading community. Keep learning, keep practicing, and may your trading journey be filled with success. Until next time, happy trading, and may your trades be profitable. Welcome to TQFM Trading Strategies. In today's video, we dive into the captivating world of the Relative Strength Index, RSI, indicator, one of the most popular and powerful tools in the realm of technical analysis. If you're an aspiring trader seeking to unravel the secrets of successful trading or a seasoned investor looking to refine your skills, you're in the right place. In this comprehensive video, we'll walk you through the multifaceted applications of the RSI, exploring not one, but three distinct trading strategies: overbought/oversold, trending, and the art of multi-time frame analytics. We'll equip you with the knowledge and insights to effectively identify potential entry and exit points, validate market trends, and refine your timing to optimize trading decisions. But that's not all. We understand that trading involves both reward and risk. So, we'll also delve into the crucial aspect of risk management while highlighting the limitations of the RSI as a standalone indicator. We'll guide you on how to combine the RSI with other technical tools to maximize reliability and refine your trading strategies. By the end of this video, you will walk away with a deep understanding of how to use the RSI to your advantage, avoid common pitfalls, and cultivate the traits of successful traders. So, if you're ready to embark on an exciting journey into the world of the RSI indicator, hit that play button and let's get started on your path to trading mastery. Don't forget to subscribe to TQFM Trading Strategies for more insightful content on honing your trading skills and achieving financial success. Let's make your trading journey a rewarding one together. The Relative Strength Index, RSI, stands as one of the most widely utilized momentum oscillators in the realm of technical analysis, offering traders valuable insights into market dynamics. By measuring the speed and change of price movements, the RSI plays a pivotal role in identifying potential entry and exit points in the stock market. As an indispensable tool for traders, the RSI aids engaging the overbought and oversold conditions of assets, pinpointing potential reversals or continuation of trends. This video delves into the multifaceted applications of the RSI, exploring its significance in different trading scenarios. We will embark on an exploration of three main sections, each catering to distinct trading strategies: overbought/oversold, trending, and multi-time frame analytics. By shedding light on these key aspects, we aim to equip traders with a comprehensive understanding of the RSI's diverse utility and how to harness its power effectively. The RSI serves as an indispensable tool for traders seeking to navigate the complexities of the stock market. Understanding its applications in identifying overbought and oversold conditions, confirming trends, and integrating multi-time frame analysis empowers traders to make informed decisions and adapt to varying market conditions. By embarking on this exploration of the RSI's versatility, traders can elevate their trading prowess and strive towards achieving consistent success in their endeavors. Understanding RSI conditions, the overbought/oversold strategy harnesses the power of the RSI to gauge extreme market sentiments. RSI readings above 70 indicate overbought conditions, signaling that an asset's price has risen rapidly and may be poised for a potential reversal or corrective pullback. Conversely, RSI readings below 30 suggest oversold conditions, indicating that the asset's price has declined significantly and might be ripe for a potential rebound. Identifying short selling and exit opportunities, traders adept in the overbought/oversold strategy utilize RSI readings above 70 as a critical signal for potential short selling opportunities. When an asset becomes overbought, it signifies a potential weakening of the uptrend, presenting an attractive chance to capitalize on downward price movements. Additionally, traders can employ this signal as an indication to exit or take profits on existing long positions before a possible price reversal unfolds. Unearthing buying and entry opportunities. Conversely, RSI readings below 30 serve as an essential trigger for traders looking to identify potential buying or entry opportunities. An oversold condition suggests that selling pressure may have been excessive, possibly leading to an imminent price recovery. Savvy traders can take advantage of such situations by entering long positions, anticipating a rebound and capitalizing on the subsequent price rise. Confirmation through technical indicators. While the RSI can provide valuable insights into overbought and oversold conditions, prudent traders understand the importance of confirmation. Relying solely on the RSI may lead to false signals or whipsaws. To mitigate this risk, traders often combine the RSI with other technical indicators like moving averages, trend lines, or volume analysis. By corroborating RSI signals with additional indicators, traders gain greater confidence in their trading decisions and refine the timing of their entries and exits. In the realm of short-term trading, the overbought/oversold strategy stands as a valuable approach to identify potential inflection points in the market. By discerning overbought conditions as opportunities to sell and oversold conditions as opportunities to buy, traders can leverage the RSI's insights to enhance the success of their trades. However, the true power of this strategy emerges when the RSI signals are thoughtfully integrated with other technical indicators, providing a more comprehensive and reliable approach to navigating the dynamic landscape of the financial markets. Trending strategy. The art of trend identification. The trending strategy focuses on deciphering the prevailing direction of price movements in a market. Traders achieve this by closely examining price action patterns and utilizing technical tools such as moving averages. By identifying higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend, traders can pinpoint the trajectory of the market. The role of longer length RSI. To validate and reinforce the identified trend, traders turn to the RSI with a longer length. A longer RSI period, typically around 14 or 21, provides a broader perspective on the market's strength and direction over a more extended time frame. By considering the RSI's reading in conjunction with price action, traders can gain deeper insights into the momentum behind the prevailing trend. The momentum indicator. In an uptrend, a rising RSI serves as a powerful indication of robust momentum. As prices continue to climb, the RSI's upward movement signals that the buying pressure remains strong. Similarly, in a downtrend, a falling RSI indicates significant selling pressure, affirming the downward momentum in the market. These RSI movements act as a reinforcement of the trend, aiding traders in staying aligned with the prevailing direction. The midline as a trend confirmation. A key element of the trending strategy involves monitoring the RSI's position relative to its midline, typically set at 50. In an uptrend, the RSI's ability to stay above 50 highlights the persistence of bullish momentum, signifying that buyers continue to control the market. Conversely, in a downtrend, the RSI's position below 50 indicates a sustained bearish sentiment, signaling that sellers maintain their dominance. The trending strategy provides traders with a comprehensive approach to capitalize on the momentum of a market in motion. By skillfully identifying trends through price action and moving averages and corroborating them with a longer length RSI, traders can ascertain the strength and persistence of the trend. Furthermore, the RSI's position relative to its midline serves as a valuable confirmation tool, ensuring traders align their positions with the underlying market sentiment. As the trending strategy combines the power of price analysis and RSI momentum, traders gain a competitive edge in navigating the dynamic landscape of trend-based trading strategies. Let's look at combining strategies for multi-time frame analytics. The power of multiple time frame analysis. Multi-time frame analytics represents a sophisticated approach to trading, empowering traders with a broader perspective of the market's trends and price movements. By examining price action across different time frames, traders gain a comprehensive understanding of the market's overall direction and potential entry points. This strategic method leverages the RSI's versatility to provide a deeper and more nuanced view of market dynamics. Identifying the primary trend with longer time frames and RSI. The first step in multi-time frame analytics involves analyzing longer time frames, such as daily or weekly charts, to identify the primary trend. By combining a longer length RSI, traders can confirm the strength and sustainability of the trend. An RSI reading above 50 on a longer time frame signals a bullish trend, while an RSI below 50 indicates a bearish trend. This approach ensures that traders align their trades with the dominant market sentiment. Refining entry timing with shorter time frames and RSI. With the primary trend identified, traders zoom into shorter time frames, such as hourly or 4-hour charts, to refine their entry timing. By employing a shorter length RSI, typically around 7 or 9 periods, traders gain insights into shorter-term momentum fluctuations. When the RSI on the shorter time frame aligns with the primary trend direction identified earlier, traders can pinpoint opportune moments to enter trades with enhanced precision. The importance of trading in line with the trend, emphasizing the significance of trend alignment. Multi-time frame analytics ensures that traders capitalize on higher probability trades. When both the longer and shorter time frames, as well as their respective RSI readings, corroborate the prevailing trend, traders enjoy increased confidence in their trading decisions. This approach minimizes the risk of entering countertrend trades and maximizes the potential for profits within the context of the overall market direction. Multi-time frame analytics emerges as a formidable approach to trading, harnessing the adaptability of the RSI and the power of multiple time frame analysis. By identifying the primary trend on longer time frames and refining entry timing with shorter time frames, traders can make well-informed decisions in line with the market's dominant sentiment. By integrating overbought/oversold, trending, and multi-time frame analytics, traders equip themselves with a diverse arsenal of strategies to navigate the complexities of the stock market effectively. As traders embrace these versatile tools and tailor them to suit their individual trading styles, they gain a competitive edge and embark on a path toward consistent success in their trading endeavors. Risk management and limitations of RSI. Risk management, the backbone of successful trading. As traders explore the diverse applications of RSI-based strategies, it becomes imperative to highlight the paramount importance of risk management. While the RSI offers valuable insights into market momentum, it is not without its limitations and potential risks. Implementing robust risk management practices is essential to safeguarding capital and preserving trading longevity. Limitations of RSI as a standalone indicator. While the RSI is a powerful tool, it is not infallible. One of its limitations lies in generating false signals and whipsaws, especially during choppy or sideways market conditions. Relying solely on the RSI for trading decisions may lead to suboptimal outcomes, underscoring the need for a comprehensive approach that incorporates other technical indicators. Increasing reliability through combination with other indicators. To address the limitations of the RSI, traders are encouraged to use it in conjunction with other technical indicators. By combining the RSI with tools such as moving averages, trend lines, or volume analysis, traders can gain more reliable and well-rounded insights into market dynamics. This fusion of indicators enhances the accuracy of entry and exit signals, reducing the risk of erroneous decisions. Practical tips for effective risk management. Prudent risk management entails setting appropriate stop-loss orders to limit potential losses in adverse market conditions. Traders should establish stop-loss levels based on their risk tolerance and the asset's price volatility. Employing trailing stops can also help secure profits while allowing trades to capitalize on favorable price movements. Diligent monitoring and timely adjustments to stop-loss levels are vital for optimizing risk management strategies. The caution of over-reliance and emphasis on adaptability. While the RSI is a valuable tool, traders must avoid over-reliance and understand that no single indicator guarantees success. Market conditions can change rapidly, and traders must remain adaptable, adjusting their strategies as needed. Continuous learning and staying abreast of market developments are essential elements for thriving in the dynamic world of trading. To wrap it up, recapitulation of RSI's versatility. Throughout this essay, we explored the multifaceted utility of the Relative Strength Index, RSI, as a powerful momentum oscillator. From identifying overbought/oversold conditions to confirming trends and executing multi-timeframe analysis, the RSI serves as a versatile tool for traders seeking profitable opportunities. The synergy of RSI and technical analysis. We emphasize the significance of combining the RSI with other technical analysis tools to enhance its effectiveness. By integrating multiple strategies and corroborating signals, traders can make more informed and confident decisions, amplifying the potential for successful trades. Cultivating the traits of successful traders. To succeed in the ever-evolving landscape of trading, we encourage traders to cultivate discipline, prioritize risk management, and remain adaptable. These attributes are fundamental in navigating market uncertainties and sustaining long-term success. The ever-relevant RSI. In conclusion, the RSI remains an invaluable part of a well-rounded trading strategy. While acknowledging its limitations, traders can harness the RSI's strengths by integrating it into a comprehensive approach that incorporates risk management and synergistic technical analysis. As traders master the art of utilizing the RSI and embrace continuous learning, they equip themselves for a fulfilling journey towards consistent profitability in the dynamic world of financial markets. Welcome back, or if you are new, welcome to the channel. Today, we have an exciting video for you as we delve into a masterful scalping strategy tailored for the 1-minute chart. In this video, we'll be using the powerful combination of the Fisher transform and stochastic indicators to capitalize on short-term trends in the direction of longer-term trends. But before we begin, don't forget to hit that subscribe button and the bell icon to stay up to date with our latest videos testing out various trading strategies. Let's dive in. Scalping, the art of making quick and precise trades, is a favorite strategy for short-term traders. Its ability to capture small price movements within tight time frames can lead to impressive profits. However, to succeed, we need a well-defined strategy with a focus on managing risks and maximizing profits. Let's begin by understanding the key indicators we'll be using in this scalping strategy. Relying on indicators and technical analysis and scalping offers objective decision-making and quick trade identification, making it suitable for fast-paced trading. Traders can use indicators to spot trends, set risk management levels, and customize their strategies. However, the lagging nature of some indicators can lead to missed opportunities and false signals in rapidly changing markets. Over-optimization and complexity may also hinder quick decision-making. It is crucial for traders to validate their strategies and be aware of the limitations of indicators while maintaining a disciplined and adaptable approach to succeed in scalping. The proper mindset for scalping is a delicate balance of discipline, patience, and emotional intelligence. Firstly, traders must understand that the stock market is inherently unpredictable, and success is not guaranteed in any single trade. They should approach trading with a long-term perspective, focusing on consistent, sustainable growth rather than seeking quick riches. Keeping emotions in check is crucial. Fear and greed can cloud judgment and lead to impulsive decisions. Successful traders remain calm and rational, sticking to a well-defined trading plan and risk management strategy. Additionally, they embrace continuous learning, staying informed about market trends, and refining their trading techniques. Accepting losses as a natural part of the process and learning from mistakes helps traders evolve and become more proficient over time. Ultimately, cultivating a patient, disciplined, and adaptable mindset is essential for navigating the dynamic world of stock trading. So now that you fully understand the idea and mindset for scalping, let's set up the scalping trading strategy so we can test it. The Fisher Transform Indicator is a versatile tool that can identify trend reversals and gauge trend strength. By using a longer period of 120, we can capture the underlying longer-term trend's essence, giving us a significant advantage. Next, we have the stochastic indicator, which measures overbought and oversold conditions in the market. With the settings of 120 for length, 30 for K%, and 40 for D%, we aim to identify significant short-term price movements. Now that we understand our indicators, let's set up our 1-minute chart and align our strategy with the longer-term trend to increase our chances of success. Using the Fisher Transform, length 120, we can spot the longer-term trend. This will help us gain insights into the overall market sentiment, allowing us to trade in the direction of the prevailing trend. The heart of our strategy lies in the entry criteria for our scalping trades. To ensure we are on the right track, we'll use the stochastic indicator, length 120, K% 30, D% 40, to identify short-term momentum within the longer-term trend. This will help us determine when to enter a trade. We have specific trade entry rules that are based on the alignment of short-term momentum with the longer-term trend. By waiting for clear signals, we increase the probability of successful trades. Now that we've entered our trades, it's essential to manage them wisely. To protect ourselves from potential losses and fast-paced scalping trades, we must place a well-calculated stop loss. I'll show you how to determine the right level for your trades. Setting realistic take-profit targets is crucial for scalping success. We'll explore a dynamic approach to trailing stop loss or locking in profits as our trades progress. As traders, we must always prioritize risk management and maintain the right mindset. I can't stress enough the significance of proper risk management in scalping. It directly impacts our long-term success and sustainability as traders. Scalping can be intense, but by mastering our emotions and staying disciplined, we position ourselves for consistent profits. Congratulations, traders! You've learned a powerful scalping strategy using the Fisher Transform and stochastic indicators on the 1-minute chart. Remember to practice this strategy on a demo account before implementing it in live trading. If you enjoyed this video and found it helpful, give it a thumbs up and share it with your trading buddies. Subscribe to our channel for more exciting trading strategies, and as always, happy trading. Welcome back, traders. Today, we're delving into a powerful trading strategy that harnesses the combined strength of three essential indicators: momentum, stochastic, and Bollinger Bands. As we explore this strategy, we'll uncover their rich history, their common applications, and how they can revolutionize your trading game. These indicators have stood the test of time, being trusted by traders around the world for decades. Let's start with momentum. Developed by the legendary trader Gerald Appel, this indicator gained popularity in the 1970s. It's a key tool for assessing the long-term trend and provides invaluable insights into market sentiment. Moving on, we have the stochastic indicator, which was introduced by George Lane in the late 1950s. Lane aimed to identify overbought and oversold conditions in the market, empowering traders to seize opportune moments for buying or selling. Over the years, it has become a staple in many traders' toolboxes. Lastly, we have the Bollinger Bands, created by John Bollinger in the 1980s. Bollinger sought to capture market volatility by visually representing price movements within a defined range. Today, it remains a widely used indicator for identifying potential entry and exit points based on price volatility. Now, in this video, we'll dive deep into the intricacies of these indicators and how they synergize to create a comprehensive trading strategy. But remember, there's more to this video than just learning about the indicators. We'll also reveal insider tips, demonstrate real-life examples, and provide practical insights to help you maximize your trading potential. So, whether you're a seasoned trader looking to refine your skills or a newcomer eager to learn, this video is your guide to unlocking the full potential of momentum, stochastic, and Bollinger Bands. Stay tuned as we unpack this strategy step by step. Don't miss a single second, as each moment is filled with valuable information that can elevate your trading game. Get ready to embark on an exciting journey towards trading success. Remember to like this video, subscribe to our channel, and hit that notification bell so you never miss an update. Now, let's begin our exploration of this powerful trading strategy. Let's start with the indicators themselves. We have momentum, which analyzes the long-term trend with a length of 100. It answers the fundamental question, is the market trending upward or downward? By determining whether the momentum is above or below zero, we gain valuable insights into the market sentiment. Next up is the stochastic indicator. With a length of 5 and %K and %D parameters set at 3 and 2, respectively, it helps us identify overbought or oversold conditions. This allows us to pinpoint potential entry and exit points in the market. Lastly, we have the Bollinger Bands. These bands, with a length of 20 and a standard deviation of 2, provide a visual representation of market volatility. By assessing the distance between the bands and the price, we can spot potential reversals or continuation patterns. Now, here's where the magic happens. We combine these indicators to execute our trades effectively. Firstly, we determine the long-term trend using the momentum indicator. If the momentum is above zero, we know we're in an upward trend, while a momentum below zero indicates a downward trend. This acts as our guiding light. Once we have the long-term trend identified, we bring in the stochastic and Bollinger Bands to fine-tune our entries and exits. In an upward trend, we look for buying opportunities when the stochastic is oversold and the Bollinger Bands indicate potential upward momentum. Conversely, in a downward trend, we search for selling opportunities when the stochastic is overbought and the Bollinger Bands signal a potential downward movement. But that's not all, we also focus on risk management. Our strategy aims for a 2-to-1 reward-to-risk ratio. This means that for every trade, our potential profit target is twice as large as our potential loss. By adhering to this ratio, we ensure that our winning trades outweigh the losing ones, leading to consistent profitability over time. And here's an exciting twist. This strategy can also be employed as a scalping strategy. Scalping involves capturing quick profits from short-term price fluctuations. Traders using this approach can adjust the timeframes and indicators to align with shorter timeframes, allowing them to benefit from smaller price movements. So, whether you're aiming for long-term trends or quick scalping opportunities, this strategy has got you covered. And there you have it, a comprehensive trading strategy that combines momentum, stochastic, and Bollinger Bands. With careful analysis, risk management, and the flexibility to adapt to various trading styles, this strategy opens up a world of possibilities for traders. Now, while this trading strategy we've discussed today is already powerful, there are always additional indicators and tricks that can take your trading to the next level. In future videos, we'll explore some of these exciting additions to further enhance this strategy and maximize your potential profits. For instance, we could delve into incorporating the Relative Strength Index, RSI, a popular momentum oscillator that measures the speed and change of price movements. It helps identify overbought and oversold conditions, complementing the stochastic indicator we've already discussed. We could also explore adding the Moving Average Convergence Divergence, MACD, indicator, which provides insights into trend strength and potential crossovers. By combining the MACD with our existing indicators, we can gain a comprehensive understanding of market dynamics and make more informed trading decisions. Additionally, we could touch upon Fibonacci retracements, a powerful tool for identifying potential support and resistance levels based on key price ratios. This technique, when used in conjunction with our strategy, can provide valuable confirmation and precision in determining entry and exit points. These are just a few examples of the many indicators and tricks we can explore together in future videos. Each addition has the potential to amplify the effectiveness of this strategy and open new doors for your trading success. So, make sure to subscribe to our channel and hit the notification bell, as we'll be sharing valuable insights and expanding on this strategy in upcoming videos. Get ready to take your trading skills to new heights. Remember, the journey towards becoming a successful trader is an ongoing process. With each video, we'll equip you with more tools, techniques, and knowledge to stay ahead in the markets. Stay tuned as we continue to uncover the untapped potential of this trading strategy and explore exciting additions that will supercharge your trading results. Remember to like this video, share it with your fellow traders, and keep an eye out for our future content. Until then, happy trading. Remember, always conduct thorough research, practice with demo accounts, and seek guidance from experienced traders. Stay tuned for more insightful content, and until next time, happy trading.
Welcome back to our channel. Today, we have an exciting topic to discuss, a 1-minute scalping trading strategy using momentum and moving average ribbons. This strategy can be applied to stocks, forex, and cryptocurrencies, allowing you to capture short-term price movements while riding the longer-term trend. Let's dive right in. Are you ready to discover a powerful trading strategy that can help you seize opportunities in the market within just 1 minute? Well, you're in luck. In today's video, we're going to explore an exciting 1-minute scalping strategy that combines the tried and true principles of momentum trading with the fascinating concept of moving average ribbons. But before we dive into the specifics, let's take a quick trip down memory lane. The concept of moving averages has been around for decades, with traders using them to identify trends and potential entry and exit points. Over time, experts have fine-tuned these techniques to suit various markets, including stocks, forex, and cryptocurrencies. Now, here's where it gets interesting. While many traders have applied moving averages and momentum indicators in conventional ways, we're going to show you a unique twist today. We'll be using these powerful tools differently, incorporating a 1-minute scalping approach that can potentially boost your win-to-loss ratio and offer an attractive risk-to-reward profile. So, if you're ready to take your trading to the next level and learn how to extract maximum profits in minimal time, you'll want to stick around until the end of this video. We're about to unveil the secrets of this exciting strategy and explore its pros and cons, empowering you to make informed trading decisions with confidence. Get ready for a game-changing trading adventure. Let's dive into the world of 1-minute scalping, momentum trading, and moving average ribbons. Trust me, you won't want to miss a single moment of this fascinating journey. The foundation of this strategy lies in the moving average ribbons. By combining multiple exponential moving averages, EMAs, of different lengths, we can identify the overall trend and trade in alignment with it. Take a look at these moving averages: 10 EMA, 20 EMA, 50 EMA, and 100 EMA. When the shorter-term EMAs are positioned above the longer-term EMAs, it indicates an uptrend. Conversely, if the shorter-term EMAs are below the longer-term EMAs, it suggests a downtrend. To confirm the momentum and the direction of the trend, we can use indicators such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD. This helps us ensure that the price has enough strength and is not overbought or oversold. Once we have confirmed the trend and momentum, it's time to identify potential entry points. Look for short-term pullbacks or retracements that align with the overall trend. These are opportunities to enter trades when the price is showing strong momentum in the direction of the longer-term moving averages. To manage risk, it's crucial to set stop-loss orders. This helps limit potential losses if the trade goes against you. Place your stop-loss orders below the recent swing lows in an uptrend or above the recent swing highs in a downtrend. Profit targets are equally important. Determine your targets based on your desired risk-to-reward ratio. You can use various techniques such as identifying support and resistance levels, Fibonacci retracements/extensions, or trailing stops to lock in profits as the trade moves in your favor. Now, let's discuss the pros and cons of this strategy. Pros: first, this strategy allows for quick trades, making it suitable for those who prefer short-term trading. Second, by aligning with the longer-term trend, we increase our chances of trading in the right direction. Lastly, the use of moving average ribbons and momentum indicators adds an additional layer of confirmation, enhancing the strategy's effectiveness. Cons: scalping strategies require quick decision-making and active monitoring of price movements. It demands a high level of attention and discipline. Additionally, transaction costs, such as spreads and commissions, can have a significant impact on the profitability of frequent trades. And there you have it, fellow traders. We've explored the ins and outs of the 1-minute scalping strategy using momentum and moving average ribbons. I hope you found this information valuable and are excited to apply it to your own trading endeavors. However, it's important to remember that no strategy is perfect, and there's always room for improvement. While this approach can be highly effective, it's essential to continue learning, adapting, and refining your techniques based on your personal trading style and market conditions. So, I encourage you to do your own testing and research. Take the time to understand the nuances of this strategy and how it aligns with your individual goals and risk tolerance. Remember, trading is a continuous learning process, and the more knowledge you acquire, the better equipped you'll be to navigate the dynamic world of financial markets. Before we wrap up, if you enjoyed this video and found value in the content we've shared, please consider hitting that like button and subscribing to our channel. By doing so, You'll stay updated with our latest trading insights, strategies, and market analyses, helping you stay one step ahead in your trading journey. Lastly, always keep in mind that trading is not easy. It requires dedication, discipline, and a commitment to continuous improvement. But with the right knowledge, skills, and mindset, you can achieve your trading goals. Thank you for watching. Don't forget to like, subscribe, and hit the bell icon to stay notified about our future trading videos. Happy trading, and see you next time.
Welcome back to TQFM Trading Strategies, your go-to channel for practical and effective trading techniques. In today's video, we'll explore a powerful trading strategy combining the accumulation/distribution indicator, ADI, with the relative strength index, RSI, to identify continued highs or lows in trend. By the end of this video, you'll have a comprehensive understanding of how to use these indicators to enhance your trading success. So make sure to watch the video to the end so as not to miss any important information. Let's dive in. Hey traders, it's great to have you here. Today, we'll discuss how to use the accumulation/distribution indicator in conjunction with the RSI to spot strong trends and potential trend continuations. But first, let's quickly recap what we know about the ADI and RSI. The ADI, developed by Mark Chaikin, measures money flow into and out of a security based on price and volume. On the other hand, the RSI, short for Relative Strength Index, gauges the speed and change of price movements, identifying overbought and oversold conditions. Now, let's jump into our strategy. We'll focus on identifying continued highs or lows in a trend using these two indicators. Here's an example of a stock's price chart with the ADI and RSI plotted below it. Our objective is to find moments when the ADI and RSI both confirm the strength of the prevailing trend. In this example, we have an upward trend, and our goal is to spot potential continued highs in the price. As the stock price rises, we expect the ADI to follow suit, indicating buying pressure during price advances. Similarly, the RSI should stay in the overbought territory, above the 70 level, affirming the strength of the uptrend. Now, let's switch to a downward trend and look for potential continued lows in the price. As the stock price falls, the ADI should decline as well, showing selling pressure during price declines. Simultaneously, the RSI should stay in the oversold region, below the 30 level, signifying the strength of the downtrend. The real magic happens when the ADI and RSI align with the trend, confirming its strength. This convergence gives us confidence in the ongoing trend and potential opportunities for trades. Here are some key takeaways from this strategy. When both the ADI and RSI confirm an uptrend, rising ADI and RSI above 70, it's a signal for potential continued highs in the stock price, indicating a bullish opportunity. When both the ADI and RSI confirm a downtrend, falling ADI and RSI below 30, it suggests potential continued lows in the stock price, presenting a bearish opportunity. Always be mindful of divergences. If the ADI and RSI show conflicting signals, exercise caution, as it may indicate a weakening trend or a potential reversal. And there you have it, a simple yet powerful trading strategy using the accumulation/distribution indicator in combination with the relative strength index. Remember, successful trading requires discipline, risk management, and continuous learning. Traders can further enhance and customize the accumulation/distribution indicator, ADI, and RSI trading strategy by incorporating additional elements and techniques. Here are some ways to make or improve the trading strategy. Multiple time frame analysis. Consider analyzing the ADI and RSI signals on multiple time frames. For instance, if you identify a bullish trend on the daily chart with ADI and RSI confirming it, check the signals on shorter time frames, example, hourly or 15-minute charts, for better entry points and precise timing. Confirmation from other indicators. Combine the ADI and RSI signals with other technical indicators to strengthen your trading decisions. For example, using moving averages or Bollinger Bands can provide additional insights into the trend's direction and potential support/resistance levels. Volume confirmation. While the ADI already incorporates volume data, you can add an additional volume indicator, like the on-balance volume, OBV, to confirm the ADI signals. Volume can be a powerful tool to validate price movements and market sentiment. Divergence analysis. Pay close attention to divergence patterns between the ADI, RSI, and price. Bullish or bearish divergences can signal potential reversals, acting as a warning to manage risk and avoid false breakouts. Support and resistance. Combine the ADI and RSI analysis with key support and resistance levels. When ADI and RSI signals align with critical price levels, it strengthens the trading signal. Combining with fundamental analysis. While this strategy focuses on technical analysis, consider integrating fundamental analysis into your decision-making process. Understand the broader market conditions, company news, and economic factors to complement your technical insights. Backtesting and optimization. Test the strategy on historical data to evaluate its performance over time. Adjust parameters such as RSI period, ADI settings, or entry/exit criteria to find the most suitable combination for your trading style. Risk management. Implement proper risk management techniques, such as setting stop-loss orders and position sizing based on your risk tolerance and account size. A well-defined risk management plan is crucial to protect your capital. Trend confirmation from higher time frames. Confirm the direction of the trend on higher time frames. If you are trading on a daily chart, look at the weekly or monthly chart to ensure that your trades are aligned with the longer-term trend. Real-time market sentiment analysis. Stay updated on current market news and events to assess their potential impact on your trades. Sudden changes in market sentiment can influence the ADI and RSI signals, so being informed is essential. Remember that no trading strategy is foolproof, and the market can be unpredictable. Always be prepared to adapt and adjust your approach based on changing market conditions. Regularly review and fine-tune your strategy to stay ahead in the dynamic world of trading. Additionally, consider keeping a trading journal to track your trades and learn from both successful and unsuccessful trades. Continuous learning and improvement are the keys to becoming a successful trader. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to TQFM Trading Strategies for more valuable content. As always, feel free to leave your questions and comments below, and I'll be happy to help. Happy trading, and I'll see you in the next video.
Welcome back, fellow traders, to another thrilling episode of our YouTube channel, where we dive deep into the world of trading strategies that can skyrocket your profits. Today, get ready to buckle up because we have a game-changing trading strategy that will leave you on the edge of your seat. But before we dive into this exhilarating trading strategy, let's address the elephant in the room. We know that trading can be a roller coaster ride filled with challenges and uncertainties. From market volatility to emotional decision-making, traders like you face hurdles that can make or break your success. That's why educational content like ours is here to empower you with the knowledge and tools you need to overcome those obstacles and level up your trading game. We're here to guide you, to provide that edge you've been searching for, and to ensure that you stay ahead of the game. Have you ever found yourself trapped in a sea of conflicting information, unsure which strategy to trust? Don't worry, we've been there too. Our goal is to cut through the noise and present you with proven strategies that have stood the test of time. The double CCI strategy is not just another random theory, it's a battle-tested technique that has the potential to transform your trading results. Say goodbye to endless guesswork and embrace a strategy that's backed by solid indicators and logical rules. But it doesn't end there. We understand that risk management is a constant concern for traders. The fear of losing hard-earned capital can be paralyzing.
That's why we've carefully crafted the double CCI strategy with built-in risk management measures. We're not here to encourage reckless trading. We're here to ensure you make calculated moves in the market. By setting stop losses and aiming for a favorable risk-to-reward ratio, we're putting the odds in your favor and safeguarding your trading journey. We believe that education is the key to success in trading. That's why we're committed to providing you with in-depth insights, step-by-step explanations, and real-world examples that resonate with traders like yourself. We want to see you thrive, to witness your growth as a trader, and to celebrate your victories alongside you. By engaging with our content, you're not just passively watching, you're actively equipping yourself with the tools and knowledge that can shape your financial future. So, fellow traders, get ready to conquer the challenges, to break through barriers, and to embark on a transformative trading journey. Join us in the comments section below, share your experiences, ask questions, and let's build a vibrant community of traders supporting each other's success. Remember, together we are stronger, and together we can unleash the true potential within us. Now, without further ado, let's delve into the mesmerizing world of the double CCI strategy and witness firsthand how it can reshape your trading experience. Get ready for a thrilling adventure that will leave you hungry for more. Like, subscribe, and hit that notification bell to ensure you never miss an episode filled with trading wisdom. Let's make profits and create a legacy that will be remembered in the trading world. Welcome to our community, and let's rock the markets. Introducing the double CCI strategy, the 1-minute scalping technique that's set to revolutionize your trading game. Are you tired of missing out on those quick profit opportunities? Well, hold on tight because we're about to reveal the secret behind this strategy's jaw-dropping success. Now, let's break it down. The double CCI strategy combines not one, but two powerful CCI indicators to create a winning formula. We've carefully fine-tuned these indicators to maximize accuracy and profitability. With the first CCI set to a fast length of 50 and the second CCI set to a longer length of 100, we've struck the perfect balance between speed and reliability. But wait, there's more. We've taken it up a notch by using only the smoothing lines of these CCI indicators. That means we're cutting through the noise and focusing solely on the most critical signals. It's like having a secret trading weapon right at your fingertips. Now, here's where things get seriously exciting. Picture this, you're sitting at your trading station, watching the fast CCI smoothed line closely. Suddenly, it bursts through the oversold level, signaling a potential bullish momentum shift. That's your cue to buy, my friends. It's time to ride the wave of opportunity. But hold on, we're not leaving you high and dry. We've got your back when it comes to risk management too. We're all about protecting your hard-earned capital. That's why we've set up a strategic stop-loss below the last low, ensuring your risk is limited. And here's the cherry on top. We're aiming for a thrilling 3-to-1 risk-to-reward ratio. It's a shot at big profits that will leave you grinning from ear to ear. But it doesn't end there. Brace yourselves because when the fast CCI smooth line crosses down from the overbought level, signaling a potential bearish momentum shift, it's time to sell. Just like that, you're locking in gains and making smart moves in the market like a pro. Now, imagine the possibilities when you take this strategy and supercharge it with additional indicators or a dynamic trailing stop. The sky's the limit when it comes to enhancing your trading game and maximizing your profits. But remember, fellow traders, always do your own research, test, and adapt the strategy to suit your personal style. So, are you ready to unleash the power of the double CCI strategy and embark on a thrilling journey of trading success? Dive into the comments section below and let us know your thoughts. Like, subscribe, and join our growing community of traders who are ready to take their profits to unprecedented heights. That's it for today's mind-blowing episode. Remember, trading is all about seizing opportunities, and the double CCI strategy is your ticket to unlocking a world of potential. Stay tuned for more exciting strategies, expert insights, and thrilling trading adventures. Until next time, happy trading.
Welcome back, traders! In today's video, we are diving into the exciting world of scalping, a trading technique that offers the potential for quick profits. Specifically, we'll be focusing on the highly popular 1-minute scalping strategy, which can be applied to stocks, options, forex, crypto, and futures. So, if you're ready to master this dynamic trading approach, stay tuned. But first, let's quickly understand what scalping is and why it holds significant importance in the trading world. Scalping is a trading strategy that aims to profit from small price movements within a short period. It's all about seizing those quick opportunities in the market to accumulate multiple small gains. Now, imagine harnessing the power of the 1-minute scalping strategy, where you can potentially execute dozens of trades in just a single hour. This approach offers a unique set of benefits that can appeal to both experienced traders and those just starting their trading journey. Firstly, with the 1-minute scalping strategy, you have the advantage of high trading frequency. As market conditions change rapidly, this approach allows you to stay engaged and actively seek out numerous trading opportunities within a short time frame. Secondly, this strategy is designed to target quick profit opportunities. By focusing on small price movements, you can potentially secure profits swiftly. This can be particularly appealing for traders who prefer a more dynamic and fast-paced trading style. Now that we've covered the benefits of the 1-minute scalping strategy, let's dive deeper into understanding this powerful technique and how it can be applied across a range of markets, including stocks, options, forex, crypto, and futures. Get ready to expand your trading arsenal and become a master of the 1-minute scalping strategy. In the upcoming sections, we'll explore the core principles, techniques, and real-life examples that will help you take your trading skills to the next level. So, don't forget to like this video and subscribe to our channel to ensure you don't miss any part of this exciting series. Now that we understand the basics of the 1-minute scalping strategy, let's move on to the key principles and techniques that make this approach effective. The first step is setting up the right indicators, which play a crucial role in identifying entry and exit points for our trades. For our super trend volatility stop strategy, we will be utilizing two essential indicators, the super trend and the chandelier stop. These indicators, when used together, can provide valuable insights into market trends and volatility. Let's start with the super trend indicator. The settings we'll be using are a length of 10 and a factor of 6. This combination allows us to capture short-term trends and potential reversals in the market. Next, we have the chandelier stop indicator, which helps us assess volatility and set appropriate stop levels. For this strategy, we'll use a length of 10 and a multiplier of 2. Understanding and measuring volatility is crucial for the success of the 1-minute scalping strategy. Volatility indicates the magnitude and frequency of price movements, which can present excellent trading opportunities for us. In this strategy, we'll be using the volatility stop indicator, which is part of the chandelier stop indicator we discussed earlier. By monitoring the volatility in the market, we can adjust our trading approach accordingly and manage our risk effectively. Different markets exhibit varying levels of volatility, so it's important to adapt to the specific market you're trading. Understanding how volatility impacts your chosen market will enhance your ability to identify favorable entry and exit points. Now that we have the super trend and chandelier stop indicators set up, and we understand the role of volatility in our strategy, it's time to put this knowledge into action. In the next part, we'll explore how to apply the 1-minute scalping strategy to different markets, including stocks, options, forex, crypto, and futures. Get ready to unlock the full potential of the super trend volatility stop strategy. In the upcoming section, we'll dive deep into each market and reveal the specific techniques and considerations required for successful scalping. Don't forget to like this video and subscribe to our channel so you won't miss out on any valuable trading insights. Applying the 1-minute scalping strategy to different markets. Now that we have our indicators set up, let's explore how to apply the 1-minute scalping strategy to different markets, starting with stocks. Selecting the right stocks is crucial for successful scalping. When choosing stocks for scalping, it's important to consider certain criteria. Liquidity and volume play a significant role. Look for stocks with high liquidity and ample trading volume, as this ensures smoother trade execution and tighter bid-ask spreads. Scalping opportunities are abundant in the stock market, but it's crucial to identify the right entry and exit points to maximize profits. In the next step, we'll demonstrate how to spot potential scalping opportunities in stock charts and provide real-life examples. To spot potential scalping opportunities in stock charts, keep an eye out for price volatility, breakouts, and short-term trends. The super trend and chandelier stop indicators we discussed earlier will be instrumental in identifying these opportunities. Let's take a look at an example. Suppose we notice a stock that has experienced a sudden surge in volume and shows a breakout above a key resistance level. This could be an ideal scalping opportunity. By combining the insights from our indicators and analyzing the price action, we can determine the optimal entry and exit points for our scalping trades. Moving on to options, let's explore how the 1-minute scalping strategy can be applied in this derivative market. Options provide flexibility and can be a great fit for scalping. Options trading involves the right, but not the obligation, to buy or sell an asset at a specified price within a predetermined time frame. Scalping with options allows us to leverage short-term price movements and capture quick profits. However, it's important to understand that scalping options comes with its own set of advantages and risks. The flexibility of options allows us to tailor our trades to our desired risk-reward ratio, but it's crucial to manage the potential downside. To select suitable options for scalping, we can use option Greeks. Option Greeks are measures of various risk factors associated with options, such as delta, gamma, theta, and vega. Delta measures the sensitivity of an option's price to changes in the underlying asset. Gamma measures the rate of change of delta. Theta reflects the time decay of an option. And vega represents the sensitivity to changes in implied volatility. By analyzing these option Greeks, we can identify options that align with our scalping strategy. They help us assess the potential profit and loss, as well as the impact of time decay and volatility changes. Let's shift our focus to the forex market, where scalping has its own unique characteristics and advantages. The forex market operates 24/5, providing ample trading opportunities for scalpers. Forex scalping requires understanding currency pairs and their volatility. Some currency pairs are more suitable for scalping due to their higher liquidity and tighter spreads. It's important to choose currency pairs that exhibit sufficient volatility within the 1-minute time frame. Volatility is key for quick price movements and potential profits in scalping. To apply the 1-minute scalping strategy in forex, we can utilize technical indicators specifically designed for this market. The super trend and chandelier stop indicators we discussed earlier can be effective tools in identifying entry and exit points. Let's look at a real-time example. Suppose we notice a currency pair with strong upward momentum and a breakout above a resistance level. This could be an ideal scalping opportunity. By combining the insights from our indicators and analyzing the price action, we can execute precise trades and take advantage of short-term fluctuations in the forex market. Scalping has gained significant popularity in the cryptocurrency market, thanks to its high volatility and liquidity. Let's explore the unique opportunities and considerations for scalping in the crypto market. Cryptocurrencies experience rapid price movements, creating ample opportunities for scalpers. However, it's important to consider the specific characteristics of each cryptocurrency, such as liquidity, trading volume, and market sentiment. Additionally, implementing proper risk management and understanding the impact of transaction fees is crucial in crypto scalping. By adapting our strategies to the crypto market, we can take advantage of its unique dynamics. Lastly, let's explore the potential of the 1-minute scalping strategy in futures trading. Futures contracts offer opportunities for scalping due to their leverage and liquidity. When scalping futures, it's essential to consider factors like liquidity, volatility, and trading hours. Liquidity ensures smooth execution, while volatility provides the necessary price movements for quick profits. Technical indicators such as the supertrend and chandelier stop can be applied effectively in futures scalping, helping us identify optimal entry and exit points. By aligning our strategies with the unique characteristics of the futures market, we can capitalize on short-term price movements and potentially achieve profitable scalping trades. Before we conclude, it's crucial to emphasize the importance of risk management in scalping. Scalping, by nature, involves quick trades and frequent market exposure, which requires diligent risk management. Setting appropriate stop-loss orders and managing position sizes are essential aspects of risk management. It's crucial to define your risk tolerance, determine the maximum loss you're willing to accept, and adhere to proper risk-reward ratios. Implementing solid risk management practices helps protect your capital and ensures long-term success in scalping. Now, let's address some common pitfalls and mistakes that traders often make when scalping. By understanding these challenges, you can avoid them and improve your scalping performance. Some common mistakes include overtrading, chasing the market, and failing to adhere to your trading plan. It's important to stay disciplined, stick to your strategy, and not let emotions dictate your trading decisions. By learning from these common pitfalls and applying proper discipline, you can enhance your scalping skills and increase your chances of success. Congratulations! You have now learned the fundamentals of the 1-minute scalping strategy and how to apply it to various markets, including stocks, options, forex, crypto, and futures. Remember, the 1-minute scalping strategy offers great potential for quick profits, but it requires practice, discipline, and effective risk management. Always start with demo accounts to gain familiarity before trading with real money. We hope this video has provided valuable insights and techniques to help you master the art of scalping. If you enjoyed this content, please like, comment, and subscribe to our channel for more trading strategies, tips, and updates in the future. Happy scalping!
Hey there, traders. Welcome back to TQFM Trading Strategies, your go-to destination for profitable trading techniques. In today's video, we have an exciting scalping strategy to share with you, the double super trend scalping strategy. If you're interested in short-term trading with a strong risk-to-reward ratio, then you've come to the right place. So, let's dive right in. Before we jump into the strategy, let's understand the key component of this approach, the super trend indicator. This indicator helps us identify trends and potential entry points. It consists of two settings, ATR3 length 10 for short-term trend analysis and ATR10 length 10 for longer-term trend analysis. The short-term super trend, ATR3 length 10, assists us in determining the immediate trend direction for stop-loss and target placement. When the short-term trend aligns with the longer-term trend, we have a higher probability of success. By taking trades in the direction of this alignment, we increase our chances of profitable outcomes. Now, let's focus on the longer-term super trend, ATR10 length 10. This indicator displays the overall trend to help us filter signals. By considering the longer-term trend alongside the short-term trend, we gain valuable insights into the market sentiment and increase the accuracy of our trading decisions. Here's how we execute the double super trend scalping strategy. When both the short-term and long-term trends align in the same direction, we take a trade in that direction. We use the faster super trend, short-term, to set a stop-loss, which helps protect our capital. Additionally, we calculate our exit target by setting it at twice the risk, ensuring a favorable 2-to-1 reward-to-risk ratio. It's important to note that this strategy is based on fractal principles, allowing us to enter trades using any bar where the super trends align, rather than timing the first bar of the shorter-term trend. Now, let's discuss the backtesting results to give you an idea of the strategy's performance. In our testing using TradingView, we conducted 100 trades with an initial account balance of $10,000. Out of these trades, we had 58 winners and 42 losers, resulting in a win rate of 58%. Our overall profit and loss, P&L, stood at $954.15, with an average trade profit of $9.54. This accounts for a return on capital of 9.54%. The average winning trade amounted to $28.47, while the average losing trade was $16.60, giving us a robust risk-to-reward ratio of 1.715. And there you have it, the double super trend scalping strategy explained. With its focus on short-term trends, risk management through stop-loss placement, and attractive risk-to-reward ratio, this strategy can potentially enhance your trading results. If you found this video helpful, make sure to hit that like button and subscribe to our channel for more profitable trading strategies. Don't forget to check out our other videos where we explore different techniques and tools to help you excel in the trading world. Happy trading, and until next time, stay profitable. Thank you for joining us today. If you have any questions or comments, feel free to leave them down below. Remember, trading involves risks, and it's essential to do your own research and seek professional advice before making any financial decisions. Take care, and see you in the next video.
Hey there, fellow traders. Are you tired of struggling to find profitable trading strategies? Do you often miss out on potential reversals and find it challenging to filter out false signals? Well, you've come to the right place. In today's video, I'm going to introduce you to a powerful trading strategy called MACD divergence scalping, inspired by the trader Charles G. This strategy has the potential to revolutionize your trading game and help you overcome some common trading issues. So, grab your notepads, because we're about to dive into the exciting world of TQFM trading strategies. But before we jump into the details of this incredible trading strategy, I want to remind you to stick around until the end of this video. Why? Because I have a special treat for you. Throughout this video, I'll be referencing freely available public indicators on TradingView that you can use to follow along and implement this strategy yourself. So, make sure you have TradingView open in another tab or on your mobile device, and let's explore the power of MACD divergence scalping together. Trust me, you don't want to miss out on this valuable opportunity to enhance your trading skills. Indicator 1, MACD divergence by Matsu_BitMEX. But before we get started, let me introduce you to the first key indicator we'll be using, MACD divergence by Matsu_BitMEX. This indicator plays a crucial role in detecting price momentum divergences for possible reversals. By using the standard settings, we can effectively identify these divergences and make informed trading decisions. Indicator 2, MACD. Next up, let's talk about the MACD indicator. MACD stands for Moving Average Convergence Divergence, and it helps us display the longer-term trend, which acts as a filter for our signals. With a fast length of 50, a slow length of 100, and a signal length of 10, we can gain insights into the overall market trend. This information allows us to refine our entries and exits, increasing the probability of profitable trades. Now, let's delve deeper into the MACD indicator and its common usage in the trading community. MACD, or Moving Average Convergence Divergence, is a versatile technical indicator that provides valuable insights into price trends and potential reversals. It consists of two lines, the MACD line and the signal line. The MACD line is derived by subtracting the longer-term exponential moving average EMA from the shorter-term EMA. The signal line, on the other hand, represents the EMA of the MACD line itself. When we use the MACD with a fast length of 50, a slow length of 100, and a signal length of 10, we gain a comprehensive understanding of the market's overall trend. The fast length captures shorter-term price movements, while the slow length focuses on longer-term trends. By comparing the MACD line and the signal line, we can identify potential crossovers and divergences, which serve as key entry and exit signals in our MACD divergence scalping strategy. The MACD is widely used by traders to gauge the strength of a trend, identify overbought or oversold conditions, and spot potential trend reversals. When the MACD line crosses above the signal line, it generates a bullish signal, indicating a possible uptrend. Conversely, when the MACD line crosses below the signal line, it produces a bearish signal, suggesting a potential downtrend. Additionally, divergences between the MACD indicator and price action can indicate an impending reversal, providing us with valuable opportunities to enter or exit trades. By integrating the MACD indicator into our trading strategy, we can effectively filter out false signals and align our trades with the prevailing trend. This combination of short-term MACD divergences and the longer-term trend displayed by the MACD indicator significantly enhances our decision-making process, giving us an edge in the markets. Now that you have a good grasp of the MACD indicator's purpose and its common applications, let's move on to analyzing the backtesting results to further solidify the potential of the MACD divergence scalping strategy. Strategy usage. Now that we have a good understanding of the indicators, let's dive into how we can utilize them within the MACD divergence scalping strategy. It's all about spotting short-term MACD divergences that start to roll the longer-term MACD over. When this occurs, it's a signal to enter either a long or short position. Make sure to set your stop loss above or below the last high, depending on your position. As for your exit strategy, watch out for MACD divergences in the opposite direction or a bar closing above or below your stop level. Backtesting results. But wait, don't just take my word for it. Let's take a look at the backtesting results using TradingView. In our test titled MACD Divergence Scalping, we started with an account balance of $10,000. Over 100 trades, we had 51 winners and 49 losers, resulting in a 51% winning percentage. The total profit and loss amounted to $98.45, with an average trade profit of 98 cents. Our return on capital was 0.98%, showcasing the strategy's potential. The average win was $4.22, while the average loss stood at $2.38, giving us a favorable risk-to-reward ratio of 1.773. These backtesting results provide us with valuable insights into the dynamics of the market and how price behaves. Firstly, the 51% winning percentage indicates that the MACD divergence scalping strategy has the potential to generate consistent profits over time. While not every trade will be a winner, the strategy's edge lies in its ability to capture more winning trades than losing ones. By analyzing the total profit and loss of $98.45 and the average trade profit of 98 cents, we can observe the cumulative effect of executing this strategy over a series of trades. It emphasizes the importance of staying disciplined and following the strategy's rules consistently. Remember, trading is a marathon, not a sprint, and it's the cumulative profits over a series of trades that ultimately contribute to long-term success. Furthermore, the return on capital (ROC) of 0.98% demonstrates the strategy's ability to generate a positive return relative to the capital invested. While 0.98% might seem modest, it is crucial to recognize that achieving consistent, positive returns in trading is a significant accomplishment. It's a testament to the effectiveness of the MACD divergence scalping strategy in capturing profitable opportunities in the market. Analyzing the average win and average loss further reinforces the importance of risk management and the favorable risk-to-reward ratio of 1.773. This ratio indicates that, on average, the strategy's winning trades generated profits that were approximately 1.773 times larger than the losses incurred from losing trades. This indicates a well-balanced approach where the potential gains outweigh the potential losses, offering a favorable risk-reward profile. These insights remind us that successful trading is not solely about hitting massive gains in every trade. Instead, it's about employing a systematic and disciplined approach that focuses on consistency, risk management, and aligning trades with high-probability setups. The MACD divergence scalping strategy, with its balanced risk-to-reward ratio and consistent profitability, exemplifies these principles. By incorporating this strategy into your trading arsenal, you can gain a deeper understanding of how price moves and the potential opportunities that emerge from MACD divergences. It empowers you to make more informed trading decisions, increasing the likelihood of capturing profitable trades while minimizing the impact of losing trades. And there you have it, folks. The MACD divergence scalping strategy has proven to be a powerful tool in maximizing profits and minimizing risks. I encourage you to follow along and utilize the free indicators available on TradingView as we explore this strategy further. If you found this video helpful, make sure to give it a thumbs up and subscribe to our channel for more insightful trading strategies. We have a treasure trove of videos waiting for you to unlock your full trading potential. Remember, success in trading is all about equipping yourself with the right tools and knowledge. Happy trading, and I'll see you in the next video. Thank you for watching. If you enjoyed this video, be sure to check out our other content for more valuable insights and strategies. Don't forget to hit that like button and subscribe to our channel to stay updated with our latest videos. Until next time, happy trading!
Hey there, fellow traders. Welcome back to TQFM Trading Strategies, your go-to channel for profitable trading techniques and expert advice. In today's video, we have an exciting strategy to share with you that combines the power of Bollinger Bands and Heiken Ashi candlesticks for spotting potential reversals. This strategy is designed to help you detect price extremes and take advantage of trend reversals. So, if you've been struggling with finding reliable entry and exit points, this video is tailor-made for you. Make sure to watch till the end for some amazing backtesting results and an opportunity to try it out on TradingView, absolutely free. Indicator 1, Bollinger Bands. Let's start by exploring the first indicator of our strategy, the mighty Bollinger Bands. Bollinger Bands consist of three lines, the middle band, which is a simple moving average, SMA, and the upper and lower bands, which are calculated by adding and subtracting a specified standard deviation from the middle band. In our case, we're using a length of 20 and a deviation of 2. The purpose of Bollinger Bands in our strategy is to detect price extremes, which can potentially indicate an upcoming reversal. When the price moves above or below the Bollinger Bands, it suggests that the market has become overextended, and a reversal might be on the horizon. Keep an eye out for these situations as we move forward. Now, let's dive deeper into the fascinating world of Bollinger Bands. Developed by renowned technical analyst John Bollinger, Bollinger Bands have become a widely used tool among traders. They provide valuable insights into price volatility and potential trend reversals. Bollinger Bands consist of three lines, the middle band, which is a simple moving average, SMA, and the upper and lower bands, which are calculated by adding and subtracting a specified standard deviation from the middle band. In our strategy, we are using a length of 20 for the moving average and a deviation of 2. The primary purpose of Bollinger Bands is to detect price extremes. By plotting the upper and lower bands around the moving average, Bollinger Bands create a dynamic channel that adapts to market conditions. When the price moves above the upper band, it suggests that the market has become overextended to the upside. Conversely, when the price moves below the lower band, it indicates an overextension to the downside. These price extremes often serve as potential reversal points, indicating that the market may be due for a correction or a shift in direction. When combined with other confirming signals, such as the Heikin-Ashi candlestick pattern we'll discuss later, these price extremes can provide valuable entry and exit points for traders. Bollinger Bands are widely used across various trading styles and timeframes. Traders employ them in day trading, swing trading, and even longer-term investing strategies. They help traders identify periods of high volatility and anticipate potential trend reversals. Additionally, Bollinger Bands can be useful for setting stop-loss and take-profit levels, as they provide a visual representation of price levels where the market might react. As with any indicator, it's essential to understand its strengths and limitations. Bollinger Bands are a powerful tool for identifying price extremes, but they should be used in conjunction with other technical analysis tools and market context. Experiment with different parameters, timeframes, and trading styles to find what works best for you. Remember, Bollinger Bands can help you band together the forces of volatility and price extremes to navigate the markets more effectively. Indicator 2, Heikin-Ashi candlesticks. Now, let's explore the second indicator of our strategy, Heikin-Ashi candlesticks. These candlesticks offer a unique perspective on price action and provide a clearer visual representation of the underlying trend compared to traditional candlesticks. Heikin-Ashi candlesticks are calculated using a modified formula based on the open, high, low, and close prices. Instead of solely relying on the individual price points of each candle, Heikin-Ashi candlesticks incorporate the average price, resulting in smoother and more filtered price movements. The purpose of using Heikin-Ashi candlesticks in our strategy is to visually identify potential reversals. These candlesticks are particularly effective in smoothing out noise and revealing the underlying trend direction. When we observe a reversal Heikin-Ashi candlestick after the price has moved beyond the Bollinger Bands, it serves as a strong signal to consider entering a long or short position. When utilizing this strategy, it's crucial to implement proper risk management techniques. Placing a stop-loss order above or below the last candle helps protect your position in case the market moves against you. Moreover, aiming for a 2-to-1 risk-to-reward ratio means that the potential profit target should be twice the amount of your initial risk. This ensures that your winning trades outweigh your losing trades in terms of potential profitability. Heikin-Ashi candlesticks offer traders a valuable tool for trend identification and reversal signals. However, it's important to remember that no indicator works perfectly all the time. Combining Heikin-Ashi candlesticks with other technical analysis tools and market context can enhance the accuracy of your trading decisions. With Heikin-Ashi candlesticks, you can wick away the noise and get a clearer view of the underlying trend. Backtesting results. Now, let's take a look at the backtesting results using TradingView to see how this strategy has performed historically. We ran a test titled Bollinger Band HK Candle with an initial account balance of $10,000. Here are the key findings. Out of 100 trades, we had 49 winners and 51 losers, resulting in a winning percentage of 49%. Our total profit and loss, P&L, stood at $420.50, with an average trade profit of $4.20. This strategy generated a return on capital of 4.2% in just 6 days, considering we ran the test on 2,340 bars. On average, our winning trades yielded $21.45, while losing trades averaged at $12.69. The risk-to-reward ratio for this strategy is 1.690. Now, let's delve deeper into the backtesting results and understand how they can help us improve our own trading performance. These findings provide valuable insights into the effectiveness of the Bollinger Band Heikin-Ashi candlestick reversal strategy. First and foremost, we observed that out of the 100 trades we executed during the backtesting period, 49 were winners and 51 were losers. This gives us a winning percentage of 49%. While it's essential to keep in mind that past performance doesn't guarantee future results, this winning percentage indicates that the strategy has the potential to be profitable. The total profit and loss, P&L, resulting from these trades stood at $420.50. This figure reflects the net profitability of the strategy during the backtesting period. However, it's important to remember that P&L alone doesn't provide the complete picture. We also need to consider the average trade profit, which in this case is $4.20. Analyzing the return on capital, ROC, is another crucial aspect of understanding the strategy's performance. In just 6 days of backtesting, this strategy generated a return on capital of 4.2%. This means that if you had started with an initial account balance of $10,000, you would have made a profit of 4.2% within that short time frame. Now, let's examine the average profits of winning and losing trades. On average, our winning trades yielded $21.45, while the losing trades averaged at $12.69. Understanding these figures allows us to assess the potential gains and losses associated with this strategy. It's essential to note that maintaining a positive average trade profit is key to long-term success. Lastly, we must consider the risk-to-reward ratio, which in this case is 1.690. A risk-to-reward ratio greater than 1 indicates that the potential profit on winning trades outweighs the potential loss on losing trades. This is an important factor for risk management and ensuring that the strategy has a favorable risk-reward profile. By studying and comprehending these backtesting results, we can gain valuable insights into the performance and potential of this strategy. However, it's important to remember that these results should serve as a starting point for further analysis and customization. Each trader's individual risk tolerance, trading style, and market conditions may vary, so make sure to adapt the strategy to suit your own preferences and conduct thorough testing on your own. Incorporating the learnings from these backtesting results into your trading approach can significantly enhance your decision-making and ultimately contribute to more consistent and profitable trading outcomes. So, keep experimenting, keep learning, and let's elevate our trading game together. And there you have it, folks. Our Bollinger Band Heiken Ashi candlestick reversal strategy has shown promising results in our backtesting. By using the power of Bollinger Bands and Heiken Ashi candlesticks together, you can spot price extremes and potential trend reversals, giving you a strategic edge in.
Hey there, fellow traders. Why did the investor bring a ladder to the bank? Because they wanted to reach the high interest rates. Ha 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 ha. Welcome back to the TQFM Trading Strategies channel, your go-to destination for powerful trading techniques and insightful market analysis. Today, we have an exciting video lined up for you. We'll be diving deep into a remarkable trading strategy, combining 3 key indicators to help you identify potential breakout opportunities. But before we get started, remember to follow along with the free indicators on TradingView. Trust me, you don't want to miss out on this one. Now, let's jump right in and make some serious gains. Indicator 1, MACD. Our first indicator is the Moving Average Convergence Divergence, or MACD. It's a versatile tool for assessing long-term trends. The Moving Average Convergence Divergence, commonly known as MACD, is a popular technical analysis indicator that was developed by Gerald Appel in the late 1970s. Since its creation, it has become widely used by traders and investors to assess long-term trends and potential trend reversals in various financial markets. The MACD indicator consists of 2 main components, the MACD line and the signal line. The MACD line is calculated by subtracting the longer-term exponential moving average, EMA, from the shorter-term EMA. The signal line, often referred to as the trigger line, is typically a 9-period EMA of the MACD line. The fast length, slow length, and signal settings mentioned in our strategy determine the time periods used for calculating the EMAs and the signal line. In this case, a fast length of 100 and slow length of 200 are chosen to capture longer-term trends, while the signal setting of 10 smooths out the MACD line further to generate trading signals. The MACD indicator serves multiple purposes in trading. Trend identification: by analyzing the MACD line and its relationship with the signal line, traders can identify the overall direction of the market. When the MACD line crosses above the signal line, it is considered a bullish signal, indicating a potential upward trend. Conversely, when the MACD line crosses below the signal line, it suggests a bearish signal and the possibility of a downward trend. Trend reversal signals: the MACD also helps traders spot potential trend reversals. A divergence between the MACD line and the price movement may indicate an upcoming reversal. For example, if the price of an asset is making higher highs, but the MACD is making lower highs, it suggests a bearish divergence and a potential reversal in the bullish trend. Momentum analysis: the MACD histogram, which represents the difference between the MACD line and the signal line, provides insights into the strength of the trend. When the histogram bars are above the zero line, it indicates bullish momentum, while bars below the zero line suggest bearish momentum. Confirmation with other indicators: traders often combine the MACD with other technical indicators to strengthen their analysis. For instance, using the MACD alongside support and resistance levels, chart patterns, or other oscillators can help confirm trading signals and enhance decision-making. Overall, the MACD is a versatile tool that aids traders in understanding the long-term trend dynamics and potential reversals in the market. By incorporating this indicator into our strategy, we can make more informed trading decisions and increase the probability of successful trades. We've set the fast length to 100, slow length to 200, and signal to 10. These settings help us determine the overall direction of the market and identify potential trend reversals. By understanding the MACD, we can make more informed trading decisions. Indicator 2, Accumulation Distribution Indicator. Next up, we have the Accumulation Distribution Indicator. The Accumulation Distribution Indicator, ADI, is a popular volume-based technical analysis tool used by traders to assess the strength of buying and selling pressure in the market. It was developed by Mark Chaikin and is designed to provide insights into the flow of money into or out of a particular security. The ADI calculates a cumulative value based on the relationship between the closing price and the trading volume. The indicator considers whether the closing price is closer to the high or the low of the trading range for the period and assigns a positive or negative value accordingly. This cumulative value helps to identify the accumulation, buying, or distribution, selling of a particular asset. The standard settings for the ADI do not require specific input parameters, as it primarily relies on volume data. This makes it a flexible indicator that can be applied to different time frames and assets. Here are some key uses and benefits of the Accumulation Distribution Indicator. Gauging buying and selling pressure. By analyzing volume patterns, the ADI helps traders assess the strength of buying or selling pressure in the market. It considers the relationship between price and volume to determine whether there is accumulation, buying, or distribution, selling, taking place. Identifying trends and reversals. The ADI can be used to identify potential trends and reversals. In an uptrend, the indicator generally shows positive values, indicating accumulation and potential buying opportunities. Conversely, in a downtrend, negative values suggest distribution and potential selling opportunities. Reversals may be signaled when the ADI diverges from the price action. Confirmation of breakouts. The ADI can serve as a filter to confirm breakouts or breakdowns in price. If there is a breakout to the upside accompanied by increasing accumulation, positive ADI values, it suggests a stronger and more reliable breakout. Similarly, a breakdown to the downside with increasing distribution, negative ADI values, may confirm a more significant downside move. Identifying divergences. Divergences between the ADI and the price action can provide valuable insights. For example, if the price is making higher highs, but the ADI is making lower highs, it could indicate a potential weakness in the uptrend. By incorporating the accumulation distribution indicator into our strategy, we can better assess the strength of buying or selling pressure, differentiate between strong and weak trends, and align our trades with the prevailing market sentiment. This helps to reduce the risk of false breakouts and enhances our overall trading decisions. Indicator 3, Channel Breakout Strategy. Last but not least, we'll explore the channel breakout strategy. By setting the length to 5, we're able to identify short-term channel breakouts. The channel breakout strategy is a technical analysis tool used to identify short-term breakouts in price. It helps traders spot potential entry and exit points based on price movements outside predefined price channels. While the indicator itself does not have a specific historical origin or name, channel breakout strategies have been employed by traders for many years. The length setting of 5, as mentioned in our strategy, represents the period over which the channel breakout is analyzed. This value can be adjusted based on the trader's preference and the time frame being analyzed. Here are some key points about the channel breakout strategy and its uses. Identifying breakout levels. The strategy identifies price levels at which the price breaks out of a defined channel. The channel is typically formed by connecting the high and low points over a specific period. When the price breaks above the upper channel boundary, it signals a potential bullish breakout, while a break below the lower boundary suggests a bearish breakout. Confirmation of long-term trend. The channel breakout strategy works in tandem with other indicators, such as the MACD and accumulation distribution indicator, to confirm breakouts in the direction of the long-term trend. By combining these indicators, traders aim to align their trades with the prevailing market sentiment and increase the probability of successful trades. Setting profit targets and stop-loss levels. The strategy also helps traders determine profit targets and stop-loss levels. Once a breakout occurs, traders may set their profit targets based on the distance between the channel boundaries. Stop-loss levels can be placed below the breakout point to limit potential losses if the breakout fails. Volatility considerations. Channel breakouts are particularly useful in volatile market conditions where price movements tend to be more pronounced. By identifying and capitalizing on these breakouts, traders can take advantage of potential short-term price movements. It's important to note that while the channel breakout strategy can be a valuable tool, it should not be used in isolation. Traders should consider other technical indicators, fundamental analysis, and risk management techniques to make well-informed trading decisions. By incorporating the channel breakout strategy into our overall trading approach and using it in conjunction with other indicators, we can identify short-term breakout opportunities that align with a long-term trend. This helps increase the probability of successful trades and enhances our overall trading strategy. This indicator works in tandem with the MACD and accumulation distribution indicator. We use it to confirm breakouts in the direction of the long-term trend, ensuring we're entering trades that have a higher probability of success. Backtesting results. Now, let's delve into the intriguing backtesting results of this remarkable trading strategy. Through a thorough test on TradingView, we were able to analyze its performance, and here's what we discovered. Over the course of the test, a total of 100 trades were executed. Out of these trades, 49 emerged as winners, while 51 were classified as losers, resulting in a winning percentage of 49%. The overall profit and loss, P&L, amounted to $269.74, with an average trade value of $2.70. This translates to a commendable return on capital, ROC, of 2.7%. During the testing period, a total of 1,170 bars were analyzed, spanning over a period of 3 days. The average winning trade recorded a profit of $10.90, while the average losing trade incurred a loss of $5.19. Notably, the strategy displayed a risk-to-reward ratio of 2.100, indicating that the potential gains outweighed the potential losses. These backtesting results provide valuable insights into the strategy's performance. Although the winning percentage may seem modest at 49%, the favorable average win-to-loss ratio and the positive return on capital suggest the potential for profitability in the long run. It is important to consider these results as a starting point and to continually refine and adapt the strategy based on evolving market conditions. Remember, backtesting is a crucial step in evaluating the viability of a trading strategy, but real-time market conditions may differ. Exercise caution and always apply risk management techniques when implementing any trading strategy. These results provide us with valuable insights into the performance of our strategy. Although the winning percentage is 49%, the average win-to-loss ratio of 2.1 shows that the gains outweigh the losses. This indicates the potential for profitability in the long run. Remember, these results serve as a starting point, and it's essential to continuously refine and adapt your trading strategy as the market evolves. And there you have it, traders. The MACD Accumulation Distribution Channel Breakout Trading Strategy, a powerful approach to identify breakout opportunities while aligning with the long-term trend. If you found this video helpful, be sure to hit that like button and subscribe to our channel for more insightful content like this. Don't forget to check out our other videos, where we cover a wide range of trading strategies and market analysis. Until next time, happy trading!
Hey there, fellow traders. Welcome back to TQFM Trading Strategies, your go-to channel for profitable trading techniques. Today, we have an exciting strategy to share with you, the Double Momentum Indicator Scalping Trading Strategy. If you're looking to improve your scalping game, this one's for you. But before we dive in, make sure you have TradingView open and ready to follow along. We'll be using free indicators, so you can implement this strategy yourself. Let's get started. Indicator 1, Momentum Indicator, 30 period. Our first indicator is the Momentum Indicator with a length setting of 30. This indicator acts as our fast momentum cycle. It measures the rate at which price changes over a specific period. By using a shorter length, we can capture more immediate price movements. In this strategy, the 30-period momentum indicator helps us identify short-term trends and potential entry points for our trades. Keep an eye on this indicator as we proceed. Indicator 2, Momentum Indicator, 100 period. Moving on to our second indicator, we have the Momentum Indicator again, but this time with a length setting of 100. This indicator acts as our slow momentum cycle. By using a longer length, we can smooth out the price fluctuations and capture the broader trend. The 100-period momentum indicator provides us with a long-term perspective on the market. It helps us identify the overall direction and momentum of the market. Pay close attention to this indicator for trend confirmation. This powerful tool acts as our fast momentum cycle, providing valuable insights into the rate at which price changes occur over a specific period. Let's explore some fascinating facts about the momentum indicator that you'll find truly interesting. Historical perspective. The momentum indicator is based on the concept of momentum in physics, which states that an object in motion tends to stay in motion unless acted upon by an external force. Similarly, in trading, momentum represents the strength and speed of price movements. Calculation method: the momentum indicator calculates the difference between the current price and the price a specified number of periods ago, which is typically represented as a percentage. It quantifies the price change over that period, giving us a numerical value that reflects the momentum. Oscillator nature: the momentum indicator is classified as an oscillator because it fluctuates within a range. It provides both positive and negative values, indicating bullish and bearish momentum, respectively. Traders often look for extreme readings to identify potential trend reversals. Leading versus lagging indicator: the momentum indicator falls into the category of leading indicators. While lagging indicators follow price action, leading indicators provide signals ahead of price movements. By identifying potential changes in momentum, this indicator can help us anticipate shifts in price direction. Divergent signals: one fascinating aspect of the momentum indicator is its ability to generate divergent signals. Divergence occurs when the direction of the indicator's line differs from the direction of the price trend. It can signal potential trend reversals or changes in the strength of the current trend. Overbought and oversold levels: like many oscillators, the momentum indicator also offers overbought and oversold levels. These levels act as thresholds that traders can use to determine potential overextended market conditions. Crossing above the overbought level may suggest a possible reversal or consolidation, while crossing below the oversold level could indicate a bounce or potential upward movement. Time frame flexibility: the momentum indicator can be applied to various time frames, ranging from intraday trading to long-term investing. By adjusting the length parameter, traders can customize the indicator to suit their preferred trading style and time horizon. Remember, understanding the momentum indicator's features and nuances will empower you to make better trading decisions based on the dynamics of price momentum. So, keep exploring and learning, and stay tuned for more insightful trading strategies on TQFM Trading Strategies. Now, let's talk about the backtesting results of this strategy. We ran a comprehensive test on TradingView, and here's what we found. The test, titled Dual Momentum Strategy, began with a $10,000 account. Over the course of 22 days and 8,580 bars, we executed 100 trades. Out of these trades, 58 were winners and 42 were losers, giving us a winning percentage of 58%. The strategy generated a profit of $519, with an average trade of $5.19. This translates to a return on capital of 5.19%. The average winning trade was $25.31, while the average losing trade was $22.59. Our risk-reward ratio stood at 1.120. Impressive, isn't it? The backtesting results of the double momentum indicator scalping trading strategy speak for themselves. With a winning percentage of 58% and a solid return on capital, this strategy shows great potential. While the double momentum indicator scalping trading strategy we discussed is already effective, there are several indicators and strategies you can consider to enhance its performance. Let's explore a few options that can potentially complement this strategy and take it to the next level. Volume indicator: incorporating a volume indicator, such as the on-balance volume, OBV, or volume weighted average price, VWAP, can provide valuable insights into the strength and conviction behind price movements. By confirming momentum with volume data, you can gain a deeper understanding of market participation and potentially improve your trade entries and exits. Moving averages: adding moving averages, such as the 50-period or 200-period moving averages, can help you identify broader trends and provide additional confirmation to your momentum-based signals. When the momentum aligns with the moving average, it strengthens the validity of the trade setup. Support and resistance levels: incorporating support and resistance levels into your analysis can enhance the precision of your trade entries. Identifying key price levels where the market has historically reacted can give you an edge in determining optimal entry and exit points for your trades. Candlestick patterns, integrating candlestick patterns, such as dojis, engulfing patterns, or hammers, can provide valuable insights into potential reversals or continuation of trends. When these patterns align with your momentum signals, it adds another layer of confirmation to your trading decisions. Risk management strategies, implementing proper risk management techniques, such as setting stop-loss orders, trailing stops, or employing position sizing based on risk-reward ratios, can significantly improve the overall profitability and consistency of your trading strategy. It ensures that you protect your capital while maximizing your potential gains. Remember, when incorporating additional indicators or strategies, it's crucial to backtest and validate their effectiveness within the context of your trading style and preferred markets. This experimentation and fine-tuning will allow you to create a personalized trading strategy that aligns with your goals and objectives. By exploring and incorporating these additional indicators and strategies, you can further refine and optimize the double momentum indicator scalping trading strategy. Keep in mind that successful trading involves continuous learning, adaptation, and a willingness to experiment with new approaches. If you found this information valuable, don't forget to like this video and subscribe to our channel for more insightful trading content. We're committed to providing you with the tools and knowledge to excel in the world of trading. Feel free to leave any questions or comments below, and we'll be thrilled to engage with you. Until next time, happy trading and may the markets be ever in your favor.
Hello and welcome to TQFM Trading Strategies. In this video, we'll be discussing a brand new trading strategy. This strategy uses three indicators to act as fast, slow, and midline momentum cycles to help traders identify potential entry and exit points in the market. By the end of this video, you'll have a clear understanding of how to use these indicators in your trading, as well as the backtesting results of this strategy. In today's fast-paced and ever-changing market, having a solid trading strategy can mean the difference between success and failure. The triple RVGI trading strategy is designed to help you navigate the market with ease and confidence. By using these three momentum cycle indicators, you'll be able to identify potential entry and exit points more accurately, and ultimately make more informed trading decisions. It's important to watch the entire video so that you don't miss any crucial details, and you can follow along using the free indicators on TradingView. So sit back, relax, and let's dive into this powerful new trading strategy together. Indicator 1, Relative Vigor Index, RVGI, length 10. The first indicator we'll be using is the Relative Vigor Index, RVGI, with a length of 10. This indicator acts as our fast momentum cycle. It measures the strength of a trend and helps traders identify potential entry points. When the fast RVGI breaks the midline, it signals a potential trade entry in the direction of the trend. Traders can use the last high or low marked by the RVGI as their stop loss, and their exit point can be either when the fast RVGI crosses under the slow RVGI and the midline, or at 2 times their risk. Indicator 2, Relative Vigor Index, RVGI, length 20. The second indicator we'll be using is the Relative Vigor Index, RVGI, with a length of 20. This indicator acts as our slow momentum cycle. It helps traders identify the overall direction of the trend. When the fast RVGI crosses under the slow RVGI and the midline, it can signal a potential exit point for traders. Indicator 3, a Relative Vigor Index, RVGI, length 1000. The third indicator we'll be using is the Relative Vigor Index, RVGI, with a length of 1000. This indicator acts as our midline and helps traders identify the midpoint of the trend. Traders can use this indicator to help them identify potential entry and exit points. The Relative Vigor Index, RVGI, was created by John Ehlers and first introduced in his book, Rocket Science for Traders, Digital Signal Processing Applications. This indicator is used to measure the strength of a trend and identify potential entry and exit points. The RVGI works by calculating the difference between the closing price and the opening price of each bar. It then compares this difference to the overall price range of the bar to determine the true range. The RVGI then smooths these values using a moving average to provide a clearer picture of the trend's momentum.
In the triple RVGI strategy, we use the RVGI with a length of 10 to act as our fast momentum cycle. When the fast RVGI breaks the midline, it signals a potential trade entry in the direction of the trend. Traders can use the last high or low marked by the RVGI as their stop loss, and their exit point can be either when the fast RVGI crosses under the slow RVGI and the midline, or at 2 times their risk. Overall, the RVGI is a popular indicator used by traders to help identify potential trade opportunities and manage risk. Its calculation is based on the idea that the closing price tends to be higher than the opening price in an uptrend and lower than the opening price in a downtrend. Backtesting results? We backtested this strategy using TradingView and found that it had a winning percentage of 57%. We ran 5,070 bars over 13 days, resulting in 100 trades with 57 winners and 43 losers. The P&L was $1,302.70, and the average trade was $12.65. The return on capital was 13.03%. The average win was $31.93, while the average loss was $12.03. The risk-reward ratio was 2.654, which means that for every $1 risked, traders gain $2.65. The backtesting results provide valuable insights into the effectiveness of this trading strategy. The 57% winning percentage indicates that this strategy has a slightly better than coin flip chance of success, which is a good starting point. The $1,302.70 P&L and 13.03% return on capital indicate that this strategy is profitable over the testing period. However, it's important to note that backtesting results should be taken with a grain of salt, as past performance does not guarantee future results. It's also important to consider the specific market conditions during the testing period and how they may have affected the results. The average win of $31.93 and average loss of $12.03 suggest that the strategy's risk-reward ratio is favorable, with a ratio of 2.654. This indicates that, on average, the potential reward is more than twice the potential risk, which is a good sign for traders. Overall, the backtesting results provide some evidence that this strategy can be effective in generating profits, but traders should always use caution and continue to monitor and refine their approach. Conclusion? Thank you for watching this video on the Triple Relative Vigor Index Scalping Trading Strategy. We hope you found this strategy helpful in your trading. Don't forget to follow along using the free indicators on TradingView. If you enjoyed this video, please like and subscribe to our channel for more trading strategies and tips. We'll see you in the next video.
Are you tired of feeling like a fish out of water when it comes to trading? Do you feel like you're swimming upstream, trying to catch a break in the market? Well, fear not, my fishy friends, because today we're diving into a trading strategy that's sure to make a splash, the DMI-powered alligator. This strategy will help you spot short-term reversals and visualize trends, so you can ride the wave of success in the market. And don't worry, we won't leave you floundering. Just make sure to follow along with the free indicators on TradingView. So, let's dive in and make some waves in the market, shall we? Hello everyone and welcome to TQFM Trading Strategies. In this video, we will be discussing a powerful trading strategy that utilizes 2 key indicators, the DMI and the alligator. By the end of this video, you will understand how to use these indicators to spot short-term reversals and visualize trends as they continue. But first, make sure to follow along with the free indicators on TradingView so you can fully grasp the concepts we'll be discussing. Indicator 1, DMI. The DMI or Directional Movement Index is a popular technical indicator used by traders to identify the beginning of potential trends. It is a momentum oscillator that ranges from 0 to 100 and is calculated using 2 lines, the positive directional indicator, plus DI, and a negative directional indicator, DI. The DMI or Directional Movement Index was first introduced by J. Wells Wilder Jr. in his book, New Concepts in Technical Trading Systems, back in 1978. Wilder was a mechanical engineer who turned his focus to the stock market and developed a number of popular technical indicators, including the Relative Strength Index, RSI, and the Average True Range, ATR. The DMI is used to determine whether a stock is trending or not by comparing the highs and lows of the current and previous trading days. It consists of two lines, the positive directional indicator, plus DI, and the negative directional indicator, DI. The plus DI line is calculated by measuring the difference between the high of the current day and the high of the previous day, while the DI line is calculated by measuring the difference between the low of the current day and the low of the previous day. The two lines are then used to generate a third line, called the ADX or Average Directional Index, which ranges from 0 to 100 and helps traders identify the strength of a trend. When the ADX is below 20, it indicates that there is no clear trend and the market is moving sideways. When the ADX is above 20, it indicates that a trend is present, and the higher the value of the ADX, the stronger the trend. For this particular strategy, we are using a DMI with a length of 14 and smoothing of 14, which helps to spot short-term reversals that may indicate a trend is starting. So, keep an eye on those plus DI and DI lines and get ready to ride the wave of the market. For this strategy, we are using a DMI with a length of 14 and smoothing of 14. This helps to spot short-term reversals that may indicate a trend is starting. Indicator 2, Alligator. The Alligator indicator is a powerful tool that helps traders visualize trends as they continue. It is based on three moving averages, the jaw, teeth, and lips, and is used to identify when the market is in a trending or non-trending phase. The Alligator indicator was also developed by J. Wells Wilder Jr. and was first introduced in his book, New Concepts in Technical Trading Systems. Wilder named the indicator the alligator because, like the powerful predator, the market can move in a powerful and explosive way. The alligator consists of three moving averages, the jaw, teeth, and lips, which are used to determine whether the market is trending or not. The jaw is a blue line that represents a 13-period smooth moving average shifted 8 bars into the future. The teeth is a red line that represents an 8-period smooth moving average shifted 5 bars into the future. Finally, the lips is a green line that represents a 5-period smooth moving average shifted 3 bars into the future. The alligator works by examining the positioning of the three moving averages. When the jaw, teeth, and lips are close together, it indicates that the market is in a non-trending phase. However, when the jaw, teeth, and lips start to diverge, it indicates that the market is trending. The positioning of the three moving averages can also be used to determine the direction of the trend. If the jaw is above the teeth and the lips, it indicates an uptrend, and if it is below the teeth and the lips, it indicates a downtrend. In this strategy, we are using an alligator with lengths of 13, 8, 5, and 3. By paying attention to the positioning of the jaw, teeth, and lips, we can determine whether the trend is up or down. If the jaw is opening up, it indicates an uptrend, and if it is opening down, it indicates a downtrend. This information can then be used to enter long or short trades and place stop-loss orders accordingly. In this strategy, we are using an alligator with lengths of 13, 8, 5, and 3. We are looking at the positioning of the jaw, teeth, and lips to determine whether the trend is up or down. If the jaw is opening up, it indicates an uptrend, and if it is opening down, it indicates a downtrend. Backtesting results. Now, let's take a look at the backtesting results for this strategy. We ran the test on TradingView and found that over 100 trades, we had 55 winners and 45 losers, giving us a winning percentage of 55%. We also had an average trade of $3.63 and a total P&L of $373.60. Our average win was $34.03, and our average loss was $33.25. This gave us a risk-reward ratio of 1.023. Overall, we achieved a return on capital of 3.74%. These backtesting results are a useful way to assess the performance of the DMI-powered alligator trading strategy. One important takeaway from the data is the winning percentage of 55%. This tells us that the strategy is successful more than half the time, which is a good indication of its efficacy. The average trade of $3.63 and the total P&L of $373.60 also give us some useful insights into the profitability of the strategy. However, it is important to note that these figures are based on past performance and may not be indicative of future results. Looking at the average win and average loss amounts, we can see that the strategy has a risk-reward ratio of 1.023, which is slightly above break-even. This means that for every dollar risked, the strategy aims to make just over $1 in return. While this may seem like a small profit margin, it can be effective when used consistently over a large number of trades. Overall, these backtesting results suggest that the DMI-powered alligator strategy is a potentially useful approach to short-term trading. However, it is important to remember that no trading strategy is foolproof and that traders must exercise caution and good judgment when using any approach to trading the markets. Conclusion. So there you have it, a powerful trading strategy that combines the DMI and alligator indicators to spot short-term reversals and visualize trends as they continue. Don't forget to like and subscribe to our channel for more trading strategies and insights. And remember, always do your own research and never risk more than you can afford to lose. Happy trading!
Are you tired of endlessly searching for the perfect indicators and strategies that will make you profitable in the market? Are you feeling frustrated with the countless hours spent researching and testing, only to come up short? Well, don't worry, you're not alone. Many traders face this same struggle. However, the good news is that learning more about technical analysis and price action can make a huge difference. And that's exactly what this video is all about. Introducing you to a new strategy that can help you predict short-term timing reversals in the market. But make sure to pay close attention to every detail we share, because missing even one key element could make a big difference in your trading success. So, let's get started. Welcome to TQFM Trading Strategies, where we bring you the latest and most profitable trading strategies in the market. In this video, we are going to introduce a new strategy called Bollinger Band Stochastic Reversal. This strategy uses 4 indicators to help traders accurately predict short-term timing reversals. We will define each indicator, explain its purpose in the strategy, and give you the exact settings we use to make the most profit. We'll also show you how to backtest this strategy using TradingView and give you the results of our tests. So, make sure you follow along and use the free indicators on TradingView to get the most out of this video. Indicator 1, Stochastic. The stochastic indicator was created by George Lane in the late 1950s. Lane was a technical analyst who believed that momentum precedes price movements. The stochastic formula compares the current closing price to the high-low range over a set period of time and produces a reading that oscillates between 0 and 100. When the reading is above 80, the market is considered overbought, and when it is below 20, the market is oversold. The stochastic is commonly used by traders to identify potential buy and sell signals. When the stochastic reading crosses above the oversold level, it can be a signal to buy, and when it crosses below the overbought level, it can be a signal to sell. The stochastic is a momentum indicator that measures the closing price relative to the high-low range over a set period of time. In this strategy, we use the stochastic with a length of 14% smoothing of 1, and d% smoothing of 3 to identify overbought and oversold market conditions. The purpose of using stochastic is to identify the best entry and exit points for our trades when the price is at a Bollinger Band standard deviation. Indicator 2, ATR. The ATR or average true range is a volatility indicator that measures the average range of price movement over a set period of time.
The average true range, ATR, indicator was developed by J. Wells Wilder Jr. in the 1970s. Wilder was a technical analyst and trader who believed that volatility was an important factor in trading decisions. The ATR formula calculates the average range of price movement over a set period of time, taking into account any gaps between trading sessions. The ATR reading is typically displayed in points or as a percentage of the current price. Many traders use the ATR to set stop-loss levels and to determine the potential volatility of a particular trade. By setting the stop-loss at 2 times the ATR, traders can reduce their risk exposure while giving their trades room to breathe and potentially profit from market fluctuations. In this strategy, we use the ATR with a length of 10 to set the stop-loss at 2 times the ATR. This helps to minimize the risk of losing money while maximizing profits. Indicator 3. Bollinger Band. The Bollinger Band is a volatility indicator that measures the standard deviation of the price from a moving average over a set period of time. The Bollinger Band indicator was created by John Bollinger in the 1980s. Bollinger was a technical analyst and trader who believed that volatility was an important factor in trading decisions. The Bollinger Band formula calculates the upper and lower bands by adding and subtracting a multiple of the standard deviation from a moving average over a set period of time. The standard deviation is a measure of the volatility of the price, while the moving average is used to smooth out the price fluctuations. The Bollinger Band reading is typically displayed as a line on a price chart. Many traders use the Bollinger Band to identify overbought and oversold market conditions, as well as to confirm trend reversals and potential trading opportunities. By combining the Bollinger Band with other technical indicators, such as the stochastic and ATR, traders can increase the accuracy of their trades and potentially improve their profits. In this strategy, we use the Bollinger Band with a length of 20 and a deviation of 2 to confirm market extremes. This helps us identify the right time to enter and exit trades. Indicator 4. Heikin-Ashi Candles Overlay. The Heikin-Ashi Candles Overlay is an indicator that overlays the traditional candlestick chart with a modified chart to help traders better identify trends. The Heikin-Ashi Candles Overlay was created by Dan Valcu, a trader from Romania, and first introduced in the late 1990s. The formula for Heikin-Ashi candles is based on a modified form of the regular candlestick chart and uses price data from the current and previous periods to create a more smooth representation of price action. The Heikin-Ashi chart shows the trend in a clearer way by using the average price of each candle, which filters out the market noise and makes it easier to spot the trend. Traders commonly use Heikin-Ashi candles to confirm trends, identify key support and resistance levels, and determine optimal entry and exit points for their trades. This particular indicator script was created and made public by CryptoRocks, and we use it with standard settings in this strategy to smooth the price for visual comfort while still using standard candlestick data for other indicators. Backtesting results. We backtested this strategy using TradingView, and the results were impressive. We ran 100 trades with an account start of $10,000. We had 40 winners and 60 losers with a winning percentage of 40%. The P&L was $539.25, and the average trade was $5.24. The return on capital was 5.39%, and we ran the bars for 1950 with a duration of 5 days. The average win was $27.55, and the average loss was $9.38. The R ratio was 2.937. Based on the backtesting results, the Bollinger Band stochastic reversal trading strategy has some strengths and weaknesses to consider. One of the strengths of the strategy is that it has a relatively high reward-to-risk ratio, R, of 2.937. This means that, on average, the strategy is able to generate nearly 3 times more profits than it loses for every trade it makes. Additionally, the average win of $27.55 is significantly higher than the average loss of $9.38, indicating that the strategy is able to capture larger gains than losses on profitable trades. However, one of the potential weaknesses of the strategy is that it has a relatively low winning percentage of 40%. This means that the majority of trades made using this strategy are losing trades. As a result, traders using this strategy should be prepared to experience some losing streaks and should have a robust risk management plan in place to minimize losses. Additionally, the strategy generated a relatively low return on capital of 5.39%, which may not be sufficient for some traders seeking higher returns. Overall, while the B-band stochastic reversal trading strategy has its strengths, traders should carefully consider its weaknesses and determine whether it aligns with their trading goals and risk tolerance. Conclusion. So, that's it for our Bollinger Band stochastic reversal strategy. We hope you found this video helpful, and we encourage you to try it out yourself using the free indicators on TradingView. If you enjoyed this video, don't forget to like and subscribe to our channel for more profitable trading strategies. Thank you for watching, and we'll see you in the next video.
Welcome, traders, to this exciting video where we are going to discuss a highly effective trading strategy, the Double Fisher Transform. This strategy is designed for short-term trend scalping and uses multiple indicators to ensure maximum profitability. Throughout this video, we will guide you through each indicator's settings, purpose, and how to use them in this strategy. Additionally, we will also be discussing the backtesting results of this strategy, which will help you understand how successful it can be. But wait, before we dive into this strategy, let us remind you to like and subscribe to our channel. By doing so, you will be notified of our latest trading videos that can help you improve your trading skills and strategies. Also, don't forget to comment below to share your thoughts, ideas, or questions with us. We are always happy to hear from our viewers. Now, it is essential to watch the entire video so you don't miss any information and can follow along with the free indicators on TradingView. We want to ensure that you fully understand how to use this strategy to your advantage, and we don't want you to miss any important details. So, let's get started with the Double Fisher Transform trading strategy and learn how you can take advantage of it to improve your trading skills. Indicator 1, a Fisher Transform, 9. The Fisher Transform indicator is a popular technical analysis tool that was developed by J.F. Ehlers, a trader and physicist. Ehlers designed this indicator to help identify potential reversals in the market, specifically in relation to price action and a moving average. The Fisher Transform is calculated using several mathematical formulas that are beyond the scope of this video, but what's important to note is that it uses price data to generate signals that can help traders identify potential trend reversals. The Fisher Transform is often compared to other momentum oscillators, such as the Relative Strength Index, RSI, or the Stochastic Oscillator, but it differs in that it can identify trend reversals more accurately in certain market conditions. In this strategy, we are using the Fisher Transform with a length of 9. This indicator is specifically designed for short-term trend scalping and helps filter out counter-trend signals. During uptrends, we take long trades, and during downtrends, we take short trades. By using the Fisher Transform, traders can identify potential trend reversals and enter trades in the direction of the prevailing trend. Overall, the Fisher Transform is a unique and powerful tool that can be used in a variety of trading strategies. Its ability to identify potential trend reversals and filter out counter-trend signals makes it a valuable addition to any trader's toolkit. Indicator 2, a Fisher Transform, 200. The second indicator in this strategy is the Fisher Transform with a length of 200. This indicator is used for long-term trend confirmation. It helps in identifying the direction of the long-term trend. The Fisher Transform with a length of 200 is calculated using the same formula as the Fisher Transform with a length of 9. Indicator 3, a moving average ribbon, 1, 20, 50, 100, 200. The moving average ribbon is a popular technical analysis tool that has been used by traders for many years. The origins of the moving average ribbon can be traced back to the work of Richard Donchian, a famous trader and market analyst who developed many innovative trading strategies in the mid-20th century. The moving average ribbon is calculated by overlaying multiple moving averages on the price chart. The ribbon consists of 5 moving averages with lengths of 1, 20, 50, 100, and 200. The shorter moving averages, 1 and 20, are more sensitive to price changes and provide an indication of short-term trend direction, while the longer moving averages, 50, 100, and 200, are more reliable indicators of long-term trend direction. The moving average ribbon is similar to other moving average-based indicators, such as the moving average convergence-divergence, MACD, and the exponential moving average, EMA. However, the moving average ribbon provides a more comprehensive view of the trend by combining multiple moving averages of different lengths. Traders use the moving average ribbon to help identify key support and resistance levels, as well as to confirm the direction of the trend. By analyzing the position and slope of the moving averages in the ribbon, traders can gain valuable insights into market dynamics and make more informed trading decisions. Indicator 4, Auger-coded entry-exit for Fisher, 9. The final indicator in this strategy is the Auger-coded entry-exit for Fisher with a length of 9. This indicator marks when the Fisher transform with a length of 9 moves above or below a range, indicating a potential entry or exit point. I coded this one myself, so you'll have to make your own, but it's pretty easy. Comment below for the code if you want it. Backtesting results. Now, let's take a closer look at the backtesting results of the double Fisher transform strategy. This strategy has been backtested with an account starting at $10,000 and running for 4,290 bars or 11 days. During this time, the strategy executed 100 total trades, with 56 of them being winners and 44 losers, resulting in a winning percentage of 56%. It's important to note that the P&L for this strategy was $469.95, with an average trade of $4.70 and a return on capital of 4.7%. While this may seem like a modest return, it's important to look at the average win and average loss for this strategy. The average win was $23.58, while the average loss was $19.33, resulting in a risk-reward ratio of 1.220. This means that for every dollar risked, the strategy was able to generate $1.22 in return. Overall, these backtesting results show that the double Fisher transform strategy has the potential to be an effective strategy for short-term trend scalping. While the returns may not be as high as some other strategies, the risk-reward ratio indicates that this strategy has a good balance of risk and reward. It's important to remember that these results are based on historical data, and there is no guarantee that the strategy will perform the same way in the future. However, by using these indicators and following the strategy's guidelines, traders may be able to improve their trading skills and increase their profitability. Conclusion? That concludes our discussion on the double Fisher transform trading strategy. Using the 4 indicators we discussed today, you can effectively scalp short-term trends while confirming long-term trends. And with the impressive backtesting results, this strategy is worth considering for your trading plan. Don't forget to like and subscribe for more trading videos, and happy trading!
Hello and welcome to this exciting video on trading strategy. In this video we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level. Alright, let's get started on the median commodity channel indicator strategy. So as the name indicates, it uses two free indicators, the median indicator and the commodity channel index indicator. The settings for the median indicator, and we're going to change the median length to 10. And we're going to change the average true length to 100. And we're going to keep the average true length multiplier at 1. Well, actually, I think we brought that down from 2 at the original outset. And the settings for the commodity channel index are going to be set to a length of 33 with a smoothing of 5 on the simple moving average. This is going to give us a set of indicators that work pretty well in tandem. You can see when trend is going up, the commodity channel index does a good job of showing that by trading above the midline. And when it extends above previous highs, the commodity channel index pushes above that upper bound. And the same thing on the low side. Zoom in right here and see it's trading a trend. This trend is broken and then pushes down past this prior low here. It pushes down to the bottom of the commodity channel index. So we can use that to trade trend and reciprocations in a way that we have in a lot of other indicators on this channel. So we could say that when this is to start a trend, this needs to first break out of the top here on the commodity channel index. And we can see that with it moving above the median. So we could take a long here. And we could do it on the big bar just for the heck of it. Then we're going to bring our stop down to the purple area there. It doesn't have to be exact. I give it a little bit of room because sometimes it tags it like there. I mean, it's just the last average true range. So I give it a little bit of space beyond that purple area. It don't have to be exact. I don't really have an exact measurement for that. I just use like a couple of ticks beyond it. Then we're going to look for 2-to-1 restored ratio. And that's the entry and exit example for the trade on the long side. So let's look at a short. This one looks like it might not have worked, but let's take a look at it anyway. So take a short position as it breaks down below there, and take that short, or move it to the top of the green right there. And no, we definitely didn't get it. So you would have gotten stopped out when it broke back above here, but then that was your entry for the long that we showed you earlier. So let's look for a short example. It's a pretty good short example here. See, it breaks the bottom there. Probably take it to the top of that green band. You look for 2-to-1 reward ratio, and you get it there. Let's look at this another long example here. It crosses above there, and by that, you gotta put your stop down the purple area. You look for 2-to-1 reward ratio, and you get it there. You can probably modify this by adding a longer term trend rate to give you a better idea of overall trend in the marketplace, as well as perhaps you could add another median indicator or Bollinger Band at 2 standard deviations to give you better stop placement if you don't like to get stopped out as much. Getting your stops tighter is ultimately what you want to do, even if you end up getting a lot of smaller losses, as long as you're able to get some nice big trades, right? Another way to run this is to just try to hold it as long as you can. So once it breaks up here on the commodity channel index and indicating a trend is starting, try to hot potato it and hold it as long as you can in that trend until you see it start to break below the commodity channel index, indicating it's ending this longer term trend. But that's probably easier to do with other indicators than these, but you can do that with this strategy. Anyways, let me know what you guys think about this one, and hope to catch you later. To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video.
understanding price action and developing a consistent trading strategy is paramount to success in the financial markets. However, with so much information available, it can be challenging to know where to start. That's where indicators and technical analysis come in. They help us to identify trends, market conditions, and potential opportunities for profitable trades. In this video, we will be discussing the Bollinger Band jump rope strategy, which combines multiple indicators to create a powerful tool for identifying short-term trends and maximizing profits while minimizing risk. By the end of this video, you will have a comprehensive understanding of this strategy and be equipped with the knowledge to apply it to your own trading. So, let's get started. Hello and welcome to our video on the Bollinger Band jump rope strategy. In this video, we will be discussing how to use the 4 indicators on TradingView to create a profitable trading strategy and testing that strategy on Ethereum futures. We will be sharing the settings for each indicator, explaining how to use them to enter and exit trades, and sharing the results of a backtest we conducted using this strategy. By the end of this video, you'll have a better understanding of how the markets work and how to become a more informed trader. The first indicator we'll be discussing is the Bollinger Bands with a length of 100 and a standard deviation of 0.66. The bands are colored with a dark fill and represent longer-term trends and trend breaks in the structure. The upper and lower bands are calculated by adding and subtracting 0.66 standard deviations from the moving average. The second indicator we'll be discussing is the Bollinger Bands with a length of 30 and a standard deviation of 0.66. The bands are colored with a lighter fill and represent shorter-term trends and breaks in short-term structure. The upper and lower bands are calculated by adding and subtracting 0.66 standard deviations from the moving average. The third indicator we'll be discussing is the super trend with a length of 10 and a factor of 1. This indicator displays short-term reciprocations in longer-term trends. It plots a line above and below the price bars that changes color based on the direction of the trend. A green line indicates an uptrend, while a red line indicates a downtrend. The fourth indicator we'll be discussing is the super trend strategy for plotting entries and exits on the chart and automating the strategy. We use the long-term trend to pick the direction, and as the short-term trend breaks out of the longer-term band, we enter with a stop at the other side of the dark band. We exit at a 3x reward-to-risk ratio or on the second or third signal in the direction of the trend whenever we begin to see sell signals at higher prices or buy signals at lower prices. This limits risk and maximizes reward for short-term scalping trends. The Bollinger Band jump rope strategy is a powerful tool for traders looking to scalp short-term trends while staying aligned with the long-term market direction. By using 2 sets of Bollinger Bands with different settings, traders can identify short-term and long-term trends as they develop. The super trend indicator acts as a risk management tool, allowing traders to trade within the trend and identify potential trend reversals. By combining these indicators and carefully selecting entry and exit points, traders can maximize their reward-to-risk ratio and generate consistent profits over time. We conducted a 100 sample TradingView backtest of this strategy using Ethereum futures market data. The account started with $10,000 and we executed 100 trades. Out of those trades, 76 were winners, resulting in a winning percentage of 76%. The P&L was $1,981.80, with an average trade profit of $19.82. We ran the backtest over 2,340 bars or 6 days, with an average win of $36.80 and an average loss of $33.95. The reward-to-risk ratio was 1.084. That's it for our video on the Bollinger Band jump rope strategy. We hope that you found it informative and useful in your trading journey. Remember to like and subscribe to our channel for more educational content on the financial markets. If you have any questions or comments, feel free to leave them down below. Thank you for watching and happy trading.
Hello and welcome to this exciting video on trading strategy. In this video we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level. So let's start with the thumbnail and talk a little bit about this picture and what it shows. This shows a trend as described using double money flow index indicators, an average directional indicator combo, and a moving average with a ribbon on it. So let's talk about the settings for these indicators. Your moving average ribbon doesn't really matter. It's just to give you a visual representation of trend on the bars. So this is set at the standard settings. One moving average at 20, one moving average at 50, one moving average at 100, and one moving average at 200 to create the ribbon. The second thing we're creating is the money flow index double combo. And this is done with a standard money flow index set at 14, and then a slower one set at twice the speed at 28. We've colored the fast one green and the slow one red. This shows you reciprocations in volume and price over time relative to itself in a way that gives you a trend inside of trend understanding. So we can say here, this trend began as these moving averages rolled over. But you can also see it began on the money flow index combo when it broke below the midline and stayed below it. That was the force, the money flow, that dragged these moving averages over. Furthermore, we have an average true range indicator at the bottom. We have the very fast one set to 1. This will give you a bar by bar representation of relative movement over time. Then we have an average on that average true range of 10 to let us know which bars are larger or smaller than the others in that trend. So we can use this setup to say things like the money flow has begun to go down. The moving averages are beginning to roll over. The ADX is beginning to move into a new range, or the average true range is beginning to move into a new range of movement. So as the money flow remains on average negative, it will continue to pull these moving averages down. And the larger bars in this trend, the spikes in the average true range, bar by bar, will represent the largest down moves in the pattern. So how do we make these lines and what do they mean? Well, these lines were created all starting when it first broke below and held the midline on the 80, or when it first broke below and stayed down there on the money flow index combo, signifying money flow had turned negative. People were selling. So we can start drawing these lines. And I put a line every time it broke down below the bottom range and touched it again, created this line. And then we have another line down here where it does it again. They kind of sit on top of each other. This will represent the bottom trend line in the downward trend overall, where money flow is pushing price into new lows over this longer time period. Then we have extra lines where it comes back, breaks above the 50. So it breaks down and then back above, and it creates one line. And then it goes down and breaks back above. That creates another line. And it breaks down and back above. That creates a third line. And breaks down and back above, sorta. And that's where it's going to hold. So I put an extra line there. And here it comes and breaks. It holds the upper band of the money flow index and then goes to break the top, indicating buying, lots of it. And you can see on the average true range, the larger bars have switched to be the buying bars. And I'll color them in. You can see that somewhere across the bottom here, probably right there, it goes, the average true range goes from showing you that the red bars are the bigger bars on average. There's one too, there's another one. But up until this point, the very bottom pretty much, the larger bars in trend are the red ones. And that makes sense because for a trend to continue, on average, the red bars need to be bigger than the green bars. Generally, you can have some weird trends where like this is like super slow, and that's a super crazy like bounce back in one bar and then super slow again, but that's not very often. And that would show basically as two small trends on the money flow index combo. So how would you use this for trading entries and exits? Well, it has to start from somewhere, so we have to go back a little bit of ways and say it was a period of buying, right? You had some reciprocation down here, like I just said, where it shows you two trends where it breaks the top and then breaks the bottom. It's just a split trend, like a little reciprocation, trading in a range, and then there's a lot of buying. So coming off that buying, once it breaks below, say you start watching it anytime in here and you're not already in a long, you're just going to wait for it to start to break below, and then you can start plotting your pattern and see how it turns out. You can either take that first entry when this red breaks below here and gives you that first push, or you can wait for it to come up, but it doesn't always do that. Sometimes this goes on for a while before it gives you a little bump. So this is going to be your kind of aggressive entry here, and that'll be your conservative entry, if that makes sense to you. Depending on your risk tolerance, it'll be one or the other. If you wait for this, you might end up missing a chunk of the trade. If you go here, sometimes you'll end up getting hit with a harder stop. So where would you hit a stop if you're going to take this trade on, say, this aggressive entry? Well, the way I like to do it is the last high and then like double it, or 50%, because sometimes the market likes to swing up. Basically, I'm putting my stop where this would break out above the money flow index combo. Not when it breaks back into the midline, but when it breaks back above the top, like here or here or over here. So that's sort of, I was going to code this into a computer. I would have the computer put a moving stop at wherever this mathematically computes to as it follows it down, and then would stop out. That's why I put this line here. It would stop out here if you did that. But the better way to play this is to hold it kind of like a hot potato as trend continues. Hope you don't get stopped out, and then when it's in this lower band, or preferably down below the bottom down here, you're going to aim for one of these large red bars as indicated by the average true range indicator. This would be a good exit here. That's a good exit there. That's a green one. That's a red one. It'd be a good exit there. That's a good exit there. That's a good exit there. So you're just waiting for, because ideally if you're short, you want to sell into weakness, or you want to cover your short into weakness. You're I guess selling into weakness up here too, but you want to cover the trade into further weakness. I'm getting a little tongue-tied there. So let's look at some more of these. We talked a little bit about that one, so let's do a different one. You can go here. This is one. You see it stays above the band, so this is a trend. And you can see it stays more or less below the band here, so that was a trend. Let's look at, this is a pretty interesting one here. So let's start drawing this out. This happened overnight, so these are kind of small bars, but you can still kind of see how this works. So we had some kind of range trading where it's hitting the bottom, hitting the top, hitting the bottom, hitting the top, hitting the bottom, and then it's kind of staying below there. And it's worked this red one down here. You could have taken this long, but that would have stopped you out here, and you wouldn't really have lost much. It would be a small trade. And then you could take this, sell this weakness, this small weakness, hoping at the start of a trend. But you're seeing the moving averages are starting to come down some more, right? Starting to pull down. That's one. Then the upswing isn't that strong, so hopefully the downswing is stronger. You can see you got some reciprocation, and then it kind of comes up to this and holds it. That's just kind of how you can use the visualization, or you can just trade them all if you're going to use a robot, but that gets very time intensive really fast, so most people tend to pick and choose, right? So let's talk a little bit about this. It comes down, breaks the bottom, so you can start drawing your lines. It's the first one. It comes up a line there, and it's going to go down, stay below it, stay below it, stay below it, come up, and then do we have it the end of this pattern? There it goes, touch the top over there. So this one actually lasts quite a long time, but didn't go very far after the initial. You know what? We can wrap it up on this one. That's close enough. If you got super technical, it's probably right on the line. We'll call that a new high over time, because it breaks this high by a little bit. So then let's start doing the middle lines here. So it's gonna come down here, touch, break back up, go down, break back up, start there. Back up, down, and break back. And you can start here. It's gonna go down, back up, where's the last one here? Was it here? It's gonna go down to the bottom, back up to midline, and then it finishes. So there's your trend, and that's how I drew the pattern. And there's it repeated on another downward trend. We'll do a long after this. But you can see like you'd enter here on this weakness, or you could get the conservative entry when it comes back up here. And then you're going to wait for some big red bars as trend continues. This is the first push here. That's 1. Then makes another one. That's 2. And then it kind of has a flat one. That's 3, and then ends. And this is just how you would draw that sort of reciprocation and momentum using the moving average, or not moving average. This is just how you draw that reciprocation and momentum using the money flow index combination strategy. And again, you know, you could take a short like here. You go to this high, that's $4. So we go to like $6. Give it some room just in case it wants to test it a little. And you're going to go down. See, that's a big red bar. You could take that one if you're really greedy, but ideally you wait for like this full wave to finish and then you go do another one. Most of them get 2, so that would be 1, 2, and then 3. They can continue as long as they want, really, till they come back up to finish. But you're most likely gonna get 1 and then 2 at least. Sometimes you just get the 1 and it stops you out, but that's then you're going long because it would be back up above here and indicating a trend the other way. And sometimes it can just flip you back and forth. So in a ranging market, it might just be best to not do this. So we come down here. If you want to be kind of the person who does a trailing stop, the way you can also do it, you can have your computer compute where this midline is, and then it comes back up here for the conservative entry and breaks back down, and then you can have it do a trailing stop on this midline. And then it would take you out when this crosses here, whatever the price is at that point. But down here, I mean, even if you took the second big spike here, not the first, but you took the first big spike, that's not a bad trade either. But the first, second, or third big spike are all really nice exits. And then it kind of dwaddles around. So if you really held on to it for dear life and you had it all the way to like that spike or like this spike way down here, like you did a little bit better, but how much better, right? This is a pretty cool long. So let's look at this. So you can see, let's see, it's kind of waffling around. Well, I guess it's kind of a downtrend, these two. Like I said, a lot of times they get 2, but sometimes they don't. This one got 2 up top. I actually got 3. 1, 2, 3 on top. Then I had 1, 2. I mean, this skin's kind of chunky, 2 or 3, depending how you want to cut it. Sometimes it's a little iffy when the range isn't that wide, right? But then it breaks back up here, and it's going to hold this a little bit. So you have your aggressive entry here, or your conservative entry there. And you can see the average true range is starting to spike up right at the open too, to indicate there's a lot of buying because these are the green bars are big. I mean, the red bars are big too, but it's going up. Trend is going up. Everything looks like it's going up here, and it's going to stay above the midline for the most part. Like it looks like it brings the red line down to it for a little bit, but it doesn't really draw that shorter term or the longer term one. It doesn't really draw the longer term one beneath it. So this trend's kind of continuing. Let's see, so you got continue to draw it out. We have a line where it breaks the top, and then a line where it breaks back the bottom. And then we can go and breaks up, and it breaks back down. So that's the first cycle. So we can start a line here. We can go for it to break, call that the same one. Break up, and then break down here. Let's call that one line. And start here, and go on, break down, break back up. And then we're going to break down again right up here, so that's line 2, and then we down, up, and down again up here, so that's line 3. This one gets kind of compressed at the top, and then in this trend you just hold it around for the first one, wait for the second one or the third one if you have the stones for it, and you get one of these big spikes here. These green bars here is a good exit in the second wave, maybe even this one here. If you see some of these red ones here and you want to get out of it, it's actually not a bad exit overall, because it kind of, after it hits here, it kind of flattens out. But either way, you get several decent exits up here. Even this one's even better, this big spike way up here, but that was way far into the third wave. So you got, you got 1, you got 2, you got 3, 4 for this trend. That's a long trade. So see, so you're going to take the aggressive one, the aggressive buy. Where would you put your stop? Well, you're going to go for the low down here, just 4, and then you're going to give it a little bit, so like 6 or 7. So I'd put my stop like over there. What's that? 48. Probably go down just a hair for around 48, just a little bit below 50. And let's say you held it to this spike here. It's going to give you about 3-to-1 risk to reward ratio for a good solid trade. And see, you got even some more big spikes if you wanted to keep on going. One there, another one there. But ideally, if you are long, you want to sell into strength, which can be identified using the money flow index around the top, along with the average directional or the average true range spiking when graphed at 1 bar at a time. To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video.
Welcome to this video on trading strategy. Whether you're a seasoned trader or just starting out, having a solid strategy is essential for success in the markets. In this video, we'll be sharing a powerful and proven trading strategy that you can use to identify high-probability trades and maximize your profits. But that's not all. We'll be using free indicators on TradingView so that you can follow along with the video and put this strategy into practice right away. Make sure you watch till the end to get all the details and insights you need to succeed. And we don't want this to be a one-way conversation. We want to hear from you. Engage with us by liking and commenting on the video, sharing your thoughts and experiences, and asking any questions you may have. We're here to help you become a better trader. We'll be covering all the key aspects of this powerful trading strategy, including the indicators we'll be using, the specific settings for those indicators, and how to identify optimal entry and exit points for your trades. We'll also be sharing some real-life examples of trades that we've taken using this strategy, as well as backtesting results that demonstrate just how effective it can be in a variety of market conditions. By the end of this video, you'll have a clear understanding of how this strategy works, and you'll be ready to start applying it in your own trading. So let's get started. The first indicator we will be using is the inverse Fisher transform by Kovanchas-Bilgic. It is an excellent indicator to use for this trading strategy. This indicator is based on the Fisher transform equation, which was designed to help traders identify trend reversals in the market. The Fisher transform is calculated using the following equation. Fisher transform equals 0.5 ln 1 plus x / 1x. In this equation, x represents the current price divided by the highest high or lowest low over a certain period of time. The Fisher transform equation then takes the natural logarithm of this value and multiplies it by 0.5. The inverse Fisher transform is simply the inverse of this equation, designed to help traders identify overbought and oversold conditions in the market. When the inverse Fisher transform is above a certain threshold, it indicates an overbought market, while values below the threshold indicate an oversold market. In this trading strategy, we'll be using the inverse Fisher transform with a length of 100. By doing so, this indicator will help us identify longer-term price trends, which can be especially useful for traders who prefer to take a more patient approach to trading. The inverse Fisher transform with a length of 100 will provide us with a more smoothed-out indicator, making it easier to identify when the market is overbought or oversold over longer periods of time. This can help us avoid getting whipsawed by short-term fluctuations in the market and allow us to make more informed trading decisions. So be sure to keep this in mind as we move forward with this strategy, and remember to follow along closely as we demonstrate how to use this powerful indicator in your own trading. Only taking long positions during uptrends and only taking short trades during downtrends. So be sure to keep this in mind as we move forward with this strategy, and remember to follow along closely as we demonstrate how to use this powerful indicator in your own trading. The second indicator we will be using with this strategy is the stochastic oscillator. The stochastic oscillator is another popular and useful indicator that we'll be incorporating into this trading strategy. By setting the stochastic to a length of 14, we'll be able to get a better understanding of short-term fluctuations within the longer-term trends that we're identifying with the inverse Fisher transform. The stochastic oscillator measures the relationship between a security's closing price and its price range over a given period of time. This information can be useful for identifying potential trend reversals and determining optimal entry and exit points for our trades. By using the stochastic in conjunction with the inverse Fisher transform, we'll be able to narrow down our entries and exits with greater precision, helping us to maximize our profits and minimize our risks. So be sure to follow along closely as we demonstrate how to use both of these indicators together in this powerful trading strategy. With a little practice and patience, you'll be well on your way to becoming a more successful and profitable trader. The third and final indicator that we'll be using in this strategy is the slow stochastic strategy, which was also created by TradingView. However, we'll need to modify the settings to ensure that it works in sync with the fast stochastic that we're using. To do this, we'll need to set the overbought and oversold levels to 50 and keep the length at 14. This will allow us to use the combination of these three indicators to scalp long during uptrends and scalp short during downtrends. By using all three of these indicators together, we'll be able to identify potential trading opportunities with greater accuracy and confidence. We'll be looking for situations where the inverse Fisher transform is indicating a longer-term trend, while the fast stochastic is indicating short-term fluctuations within that trend. Then, we'll use the slow stochastic to confirm our entry and exit points, ensuring that we're making the most profitable trades possible. So be sure to keep watching and follow along closely as we demonstrate how to use all three of these indicators together in this powerful trading strategy. We've now conducted a backtest on this trading strategy using the inverse Fisher transform and the other indicators that we've discussed. Let's take a closer look at the results of this backtest. Over the course of 1170 bars and 100 trades, this strategy generated an average win of $16.80 and an average loss of $21.43. The winning percentage was an impressive 74%, which is a testament to the effectiveness of the strategy in identifying profitable trades. The reward-to-risk ratio for this strategy was 0.784, which means that for every dollar that we risked, we generated approximately 78 cents in profits. This is a strong indicator of a solid trading strategy. Overall, this backtest resulted in a total profit of $686.10, with an average trade of $6.86. That represents a return on capital of 6.86%, which is an excellent result for just 3 days of trading. These results demonstrate the effectiveness of this trading strategy and the power of using the inverse Fisher transform and the other indicators that we've discussed. So be sure to keep watching as we demonstrate how to use these indicators in your own trading, and remember to engage with us by liking and commenting on the video. We'd love to hear from you. In conclusion, we've covered a powerful trading strategy using the inverse Fisher transform and a combination of other indicators to identify profitable trading opportunities. We've discussed the settings for each indicator, as well as how to use them in combination to scalp long during uptrends and short during downtrends. We've also conducted a backtest on this strategy, which demonstrated the effectiveness of these indicators in generating profitable trades with a high winning percentage and a solid reward-to-risk ratio. However, it's important to remember that trading can be risky, and past performance is not always indicative of future results. Therefore, we encourage you to test this strategy on your own tickers and timeframes, and to always use proper risk management techniques. Thank you for watching, and be sure to engage with us by liking and commenting on the video. And if you haven't already, please subscribe to our channel for more trading tips and strategies in the future. Welcome to this video about scalping trading strategy using 3 free indicators. If you are looking for an effective trading strategy that can help you make quick profits in the markets, then you have come to the right place. In this video, we will be exploring a scalping trading strategy that can be used by anyone, regardless of their level of experience in trading. We will be using 3 free indicators that are available to everyone, which means you can follow along with us and implement the strategy in your own trading. We will explain the indicators and how to use them to identify potential trading opportunities, as well as how to manage your risk and maximize your profits. It is important to watch the full video so that you can fully understand the strategy and how it works. We encourage you to follow along with us and try the strategy out for yourself. If you enjoy this video and find it helpful, please don't forget to like and comment on the video. And if you want to see more videos like this to help with your trading, be sure to subscribe to our channel. Let's get started. In this video, we will be discussing a scalping trading strategy that uses 3 indicators: the Supertrend, MACD, Moving Average Convergence Divergence, Fast, and MACD Slow. Each of these indicators plays an important role in helping us identify potential trading opportunities and manage risk. First, let's talk about the Supertrend indicator. The Supertrend indicator is a popular trend-following indicator that is used to identify the direction of the trend and potential entry points. The Supertrend indicator uses a moving average and a multiplier to plot a line above and below the price action. When the price is above the Supertrend line, it is considered bullish, and when the price is below the Supertrend line, it is considered bearish. For this strategy, we will be using a Supertrend length of 10 and a factor of 1 for stop losses. This means that the Supertrend line will be calculated based on the previous 10 price periods, and we will use a factor of 1 to set our stop loss levels based on the Supertrend line. Next, let's talk about the MACD indicator. The MACD indicator is a popular momentum indicator that is used to identify potential trend reversals and entry points. The MACD indicator consists of 2 lines, the MACD line and the signal line. The MACD line is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average, while the signal line is a 9-period exponential moving average of the MACD line. For this strategy, we will be using 2 MACD settings. The first MACD setting is a fast length of 12 and a slow length of 26, with a signal smoothing of 9 to signal entries. This means that we will be using the MACD fast to identify potential entry points in the direction of the trend. The second MACD setting is a fast length of 100, a slow length of 200, and a signal smoothing of 30 to filter trades. This means that we will be using the MACD slow to determine the overall trend direction and filter out trades that are against the trend. Finally, we will be using these indicators together to create a scalping trading strategy that measures the longer-term trend using the slower MACD and then scalps in the direction of that trend using the faster MACD and Supertrend. By using these 3 indicators together, we can identify potential trading opportunities that have a higher probability of success and manage our risk effectively. In this scalping trading strategy, we will be using the faster MACD to identify potential entry points that are in the direction of the trend identified by the slower MACD. The goal is to enter the trade and scalp a quick profit while maintaining a 2-to-1 reward to risk ratio or better. To achieve this, we will be using the Supertrend as a stop loss level. The Supertrend line will serve as a dynamic stop loss level that moves with the price action. When we enter a trade, we will set our stop loss level at the Supertrend line, and as the price moves in our favor, we will adjust the stop loss level to lock in profits and manage our risk. By using the faster MACD to identify potential entry points and the Supertrend as a stop loss level, we can scalp quick profits while maintaining a favorable reward to risk ratio. we conducted a 100 sample backtest using TradingView on this scalping trading strategy. In the backtesting data for this MACD supertrend strategy, we can see that over a period of 4 days and 1560 bars, there were 100 trades with 45 winners and 55 losers, resulting in a winning percentage of 45%. The average win was $20.03, while the average loss was $7.05, resulting in a favorable reward to risk ratio of 2.841. The total profit was $513.60, with an average trade profit of $5.14 and a return on capital of 5.14%. These results indicate that the strategy has the potential to be profitable over time. We encourage you to try this strategy out for yourself using the free indicators we provided, and if you find it helpful, please like and subscribe to our channel for more trading videos. In conclusion, the MACD Supertrend scalping strategy has the potential to be a profitable trading approach. By using the faster MACD to identify potential entry points and the supertrend as a stop-loss level, we can scalp quick profits while maintaining a favorable reward-to-risk ratio. We hope you found this video helpful and informative. If you enjoyed this video, please like and subscribe to our channel for more trading strategies videos. Don't forget to watch our other videos to learn more about trading and to explore different approaches and techniques that could help improve your trading skills. Thank you for watching, and we'll see you in the next video.
Hello and welcome to this exciting video on trading strategy. In this video we will discuss a powerful strategy that you can use to become a more informed trader and investor in the stock market. We will cover everything from the indicators and settings being used to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch this video until the end. You won't want to miss any of the crucial insights and tips we will be sharing, as this strategy uses free and widely available indicators so you can follow along while you do. And if you find this content valuable, please consider hitting the like button and subscribing to our channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section. Let us know your thoughts, questions, or even your own experience with the strategy and backtesting. So, without further ado, let's get started taking your trading game to the next level.
Trading successfully using fractals. Fractals are repeating price patterns across time frames that come together to build similar structures on larger time frames. They are a powerful tool that traders can use to identify potential buying and selling opportunities in the stock market. Let's start by discussing some common indicators that can be useful for identifying fractal patterns. Moving averages are an excellent example of how fractals work by repeating patterns of divergence. By studying how these structures interact on smaller scales, traders can gain insight into what the eventual shape of the larger structure will be. Specifically, when the 5-period moving average crosses above the 10-period moving average, we can expect the 10-period moving average to eventually cross above the 100-period moving average, forming a fractal pattern. Fibonacci retracements also work in fractals by identifying time-analogous ratios. By measuring distance based on the previous so many bars, rather than the dollar price on the right of the chart, traders can identify potential support and resistance levels within a fractal pattern. This can help traders identify potential buying and selling levels. Now let's talk about some strategic ways to buy and sell using fractal patterns for profits. Trend trading using fractals involves expecting the pattern to continue. By identifying the trend, traders can enter a buy position when the price breaks above a previous high or a sell position when the price breaks below a previous low. Counter-trend trading a fractal pattern involves predicting when the trend will end inside the pattern. Traders can use Fibonacci retracements and other technical indicators to identify potential support and resistance levels and overbought and oversold levels to enter buy or sell positions accordingly. Range trading a fractal pattern involves counter-trend trading a fractal that's getting smaller and tighter, resulting in an overall range-bound pattern. It's essential to remember that successful trading using fractals requires a combination of technical analysis, risk management, and discipline. By applying principles from physics and mathematics, traders can identify and trade fractal patterns profitably. In conclusion, using fractals for trading can be a useful strategy for identifying potential buying and selling opportunities in the stock market. By understanding how fractals work and using common indicators such as moving averages and Fibonacci retracements, traders can develop effective trading strategies such as trend, counter-trend, and range-bound fractal strategies. With proper risk management and discipline, traders can use fractals to trade profitably in the stock market. Let's create an example fractal trading strategy based on the ideas and indicators mentioned above. Our strategy will be a trend-following strategy that uses the moving averages to identify fractal patterns. Specifically, we will use the 5-period moving average, MA, and the 10-period MA to identify potential buy and sell signals. First, we will look for an upward fractal pattern, which is when the 5-period MA crosses above the 10-period MA. When this happens, we will enter a long position, as we expect the 10-period MA to eventually cross above the 100-period MA, forming a larger fractal pattern. Next, we will look for a downward fractal pattern, which is when the 5-period MA crosses below the 10-period MA. When this happens, we will exit our long position and enter a short position, as we expect the 10-period MA to eventually cross below the 100-period MA, forming a larger fractal pattern. We will use a stop-loss order to limit our risk on each trade. Specifically, we will set our stop-loss order at the low of the previous bar for long positions and at the high of the previous bar for short positions. Now, let's speculate on why this strategy might be effective given current economic understandings of capital markets. The fractal pattern is a recurring pattern that occurs in many different systems, including the stock market. By identifying these patterns and using them to trade, we can take advantage of the natural rhythm of the market. Additionally, using moving averages as our indicator allows us to smooth out the noise in the market and identify potential trends. Finally, using a stop-loss order helps us limit our risk and protect our capital in case the market moves against us. Overall, this strategy combines the power of fractal patterns with technical analysis and risk management to create a potentially effective trading strategy in the stock market.
To wrap things up, we hope you found the information helpful and insightful. If you have any questions or feedback, please leave them in the comments section below. And if you enjoyed this video and want to see more like it, please consider liking and subscribing to the channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So thanks again, and we'll see you in the next video. Hey there, in this video we're going to go over how to use a triple stochastic trading strategy and how to use multiple stochastics in general to better understand trend and reciprocation inside of said trend. To do this, we're going to use some commonly available free indicators that everyone can play around with and see for themselves. Forward test, back test, see if it's going to work in your own tickers and time frames. And learn how to understand what the market looks like evaluated through stochastics in general, because it will make you a better trader and investor. Before we begin, I'm the Augur of Avon, and this is TQFM Trading Strategies. I trade stocks and options and make videos about it to help you guys become better yourselves and kind of open up your mind to all sorts of different possibilities. Well, with all that being said, we're going to hop right into the chart. Let's start with how to set up the indicators. So you can use 2, 3, 4, or several stochastics at varying lengths to use this sort of methodology. Here, we have the first one set at 10, the second set at 100, and the third set at 300. Chop the market up into 3 different moving averages. We have the stochastic that alternates back and forth on a 10-minute cycle. We have the stochastic that alternates back and forth on the 100-minute cycle. And we have a stochastic that alternates back and forth on a 300-minute cycle. So the way that this works is we can look at the shorter-term stochastic for the individual ups and downs inside of a larger trend. We go to the next largest stochastic and use it to demonstrate the overall trend up or down. And we can go to a very slow stochastic to look at the strength of that trend relative to others in its local area. So the way that this would work is we see the middle stochastic crossing below the midline, signaling that a downtrend may be forming, and we see it pick up some steam, cross below its lower bound, and hold there for a little while. We see the longer term stochastic follow it. Then we see the short term stochastic pop up with some short term buying. This is where you could take a short trade, like so, and then as it follows down, you see it push one and come up and make another one. And this is where things get really important. We watch it trade around until this point here, where I guess it has it. I guess this point here, somewhere up in here where it breaks the fast stochastic to the bottom. At that point, you adjust your stop to the last high. So you're in it there. So you're in it there. You come out to this next low in your short trend, so you can adjust your stop to break even. And you do get stopped out, but it's no big deal. Let's look at some more. This is a nice trendy one. So we see the stochastic coming down below the 50 and holding there for a little while with some big red bars signaling a downtrend, maybe beginning. And then it comes up to touch the top of the short-term stochastic. We can look down at the very long-term stochastic and see that this is relative to other trends, has some strength. So we can take a short trade here off this high where it crosses. We put our stop at the last high and we can wait. It's going to come down, it's going to make the first low, it's going to come up, and it's going to make another low. Each one of these, since this is the last high, don't adjust your stop. And it comes up here, it makes a high, and then you gotta wait a long time for it to get back there. And you probably got stopped out on this one for probably about even. You probably would have adjusted your stop to break even somewhere around here. And that would have taken you out because you're already below it. So let's just grab another one randomly. Let's see, this one's kind of popping up. This one would have stopped you out as well. And this looks like it's going to hit you a lot. And that's sort of what happens. But they're very small. And this is going to be a decent trendy one. We see it breaking above the 50. We see it come down. You see it's not super crazy, but it's something. So we can take a long here. Stop down there. So it comes up, makes new highs. Bottom makes new highs. So you can adjust your stop to this low, which happens to be just about break even. And it stops you out. Feel free to take profit anytime along the way as well. This is just a way to minimize your risk and trade on the stochastic trend, right? So this is a super trendy one. You see it coming down here, breaking below. You see it come up here, so we can take a short. And that's a long. We can take a short. Let's use this bar, be conservative, or be aggressive and say that we took the, just for risk reward, conservative. This, we go up to the last high. And we watch it come down, boom, and come up, and then come down, boom, again. So we get to adjust our, no, I can't go reverse like that. Okay, so we get to adjust our stop to this right here. It goes down, boom, comes up, comes down, boom, comes up, and then it comes down and hits it here, so it's gone from the top to the bottom down there, so you can adjust your break even to the top there, and it stops you out. So you made some money on that one. And then on the way, I want a guys, it's a very choppy market. I want something, yeah, it's a nice trendy day here. So we can see it down here. I think this is the one I use for the thumbnail. So we can see it come down in here. This is a nice big push here. It pops it up over that. It comes down, catches it here. So you can take a long because it's still holding above there and it's above there, right? Long on this, so it's a short. What am I doing? And you take a long on the eye, and then it comes up, hits the top, comes down, hits the bottom. So you can adjust your stop to the bottom there. Then it comes up, hits the top. It comes down, hits the bottom. Same one, same level. It comes up, hits the bottom. It's all the same level. And then it comes up and hits the bottom, so you can adjust your stop. This low there, and it comes out and stops you out, and you made like $26. And when it doesn't work, you're most of the time getting stopped out at break even. So it's very similar to some ways that I do some things. This one also worked here. See, it comes down to here. This is actually kind of happened back up here. But this stochastic breaking below there. You use these highs. Comes down here, makes a low, makes a high. So you could use that, I guess, or you could use this. So let's be conservative for demonstration's sake, and say we use this. And then it's gonna come down. It makes a low, it makes a high, and then it makes a low. So you adjust your break even to there, and then it comes and stops you out. And then it makes another low. You just stop out one there. You're gonna get stopped out one way or the other, but the question is, where is it gonna stop you out, right? Is it gonna stop you out like a penny below where you entered, and at the same price you entered, and be on an equal low because the trend gets broken at that point, or is it gonna carry and continue? And you can make this faster if you want faster reciprocations to update your stop quicker. If you want, a more reciprocations inside of a trend, you can make this one faster, or you can make this one slower and make this one faster relative to it. And if you want a better idea of, lay of the land, you can use this guy, and you can either back him out like wicked far to represent like a daily chart or something, or you can move him in to be almost the same speed as this to kind of give you a sort of oscillator up and down. But it's all sort of preference, and a lot of people do this a lot of different ways. This is just kind of one way you can do it, and it's something I play around with because just understanding the way that this kind of fractal reciprocates back and forth will give you will teach you a lot about how the market functions in general. Because it's all sorts of trends. Like, these are little trends, and these little trends have to be strong for this one to be strong, and then this needs to be strong for this one to be strong. So that's just kind of how the market is. It's just kind of a relay, passing back and forth over time frames. This is one group of people who will buy because they're super aggressive, and they see a little short-term bottom, so they're gonna try to buy with stops below that. And if they don't get stopped out and they make money, other people are gonna see that, and then they're going to get on the adoption cycle. If that makes sense. Like, these are the first people to buy the iPhone, right? And if the iPhone's great and they love the iPhone, then these guys also buy the iPhone. And if this is great, and both these guys have a great time with the iPhone, then these guys also eventually come and buy the iPhone. And that's what I mean by it's not like an adoption cycle. And that's all the market is just infinite series of adoption cycles playing out on all sorts of time frames. And using multiple stochastics lets you have a very consistent relative way to monitor that and measure that, to trade consistently around that reciprocating fractal. So what are some other things we can see when we take a look at this kind of pattern here, this fractalization? Well, we can also say that if the two longer term ones are trading in the particularly bearish zone down here, there's a lot of selling, then it was probably above average time to take reciprocations counter trend in the shorter term. So this one comes up and hits the top. We see these two are still down at the bottom. So there's above average chance that this one is going to result in a quick reciprocation to the downside to continue these trends. And if it doesn't, well, these trends will fail, like here, where it came up and it didn't make it, and then it pushed these back up above these and it didn't work. It actually came back to just about flat to where you entered there. That's all if the market's marking up or marking down in short reciprocations, and that will build the larger term ones, and then the larger term ones will build the even bigger ones after that. Stay good here, like this one had to be strong to push this below, and then this had to be strong to push this below. So that if these are both below still, when this gets back to the top, it's probably a decent time to take a short before the reciprocation down to where they're both, well, to where they're all, because it likes to all get back to the same spot versus all break apart. And all this is predicated on the fact that if this wants to continue to go down, the downward moves on these have to, on average, be stronger than the up moves on these. So if you want, a good way to take 50-50 bets, you wait for it to go down, and then you start 50-50 betting on it to go down until it's going up, and then you can start 50-50 betting on it to go up in the same way. And there'll always be one that catches you off guard, but if you're, risking one to make one, and you win 2 or 3 for every one you lose when the trend breaks, you'll do alright. It's another way to optimize off this. So you can say sort of here, for instance, the medium term one's kind of at the top, the longer term one's kind of in the middle, and the short term one's at the bottom. So like right here in real time, if you wanted to, you could take a trade. And what we want to do is we want to find that last low down here that broke the bottom. And we can wait, and if this continues to stay nice and bullish, then by the time this gets back up to the top, this should be back at the top here. But that could take a little while. And yeah, we'll see how this works. Paper trading in real time. So we can see it ultimately didn't work, but before it did stop you out, it got back here to the top of the short-term stochastic and gave you an exit. So it reciprocated, just not enough to make you any money. And we can see that trend broke after that, and we're going down. So if you're using this methodology, you'd probably be waiting for this to get back up towards the top, or at least above the midline. Take a short to see if this trend would continue. Anyways, I hope you guys enjoyed that. Thanks for watching. If you like that, you'll like the other ones on my channel, so make sure to check out those as well. And I hope to see you guys around. Hello and welcome to this exciting video on the triple Bollinger Band trading strategy. In this video, we will discuss a powerful scalping strategy that you can use to become a more informed trader and investor in the stock market. We'll cover everything from indicator settings to trade to implementing a solid entry and exit strategy. But before we dive in, I want to encourage you to watch to the end of the video, that you won't want to miss any of the crucial insights and information we will be sharing. Now, this strategy uses free and widely available indicators, so you can feel free to follow along while we do. And if you find this content valuable, please consider hitting the like button and subscribing to the channel to stay updated on our latest trading strategies. Also, we'd love to hear from you in the comments section below. Let us know your thoughts, questions, or even your own experience with scalping. So let's get started and help you take your trading game to the next level. As the name implies, this trading strategy uses 3 Bollinger Bands. Let's start with a fast one with a length of 10. We set the standard deviation to 1. The second one, we have a length of 50, and we set the standard deviation to 1. And the third, we have a length of 100, and we also set the standard deviation to 1. This gives you a series of overlapping bands, and I like to set them up so the longest one, the slowest one, sits on top of the faster ones to give you this sort of fan shape to reflect price reciprocating inside of trend. So the way that you'd use this, the way that I use this, is I use the longer term trend and the short term trend inside of it to create a sort of jump roping situation. What I like to do is wait until price breaks down below the longer term band or breaks above the longer term band, and that gives me a trade. So in this instance, we take a short trade here at the close of this bar. I like to put my stops around the length of the longer term, or the other side of the longer term Bollinger Band, and I'm going to let it run for a little while. The idea of this trade is to hold it as long as possible, and I tend to use it to sell premium, but you can use it however you want. In this instance, this one would continue all the way until it broke the band on the other side down here, which is a pretty decent trade. That gives you a solid 13.28 risk to reward ratio. However, this is probably one of the better ones. Most of them do not have that kind of risk to reward ratio, but they can, and that's the point. So let's look what happens when it doesn't work. The trade immediately before it, if you want to take a long, you wait until it crosses the band here. You could probably buy that, put a stop below, and let it run. and it's gonna run, it's gonna run, it's gonna run, and it's gonna stop you out, which isn't that bad. And if you wanted to get out, you had plenty of opportunity to get out and take the trade. When this band crosses back a little here, you could probably exit for a break even, or when it comes up, it starts breaking down back down into these, you can take it off there. You have plenty of chance to get out if that's how you wanted to play it. But ultimately, that one didn't work. Let's look at another one that worked. This one here, it comes breaks below. You take a short there. Move one there. You're gonna let it ride, and it breaks back above over here. So if you hadn't already taken it off, when it started breaking back up into the band here or into here, or even if you were smart and you took off one of these lows, if you used a faster reciprocator, like a much faster length RSI or stochastic, and you kind of held it for a good amount of time, you waited for a low in trend to take it off, you could do that too. Try to maximize your risk to return. Try and maximize your risk to reward. But in this case, you made 1.4. Another one here, breaking up above. Take it long. And it goes like that. It goes like that where you're going to stop out. So the entire idea behind this strategy, and let me know if you've heard this one before, a common adage in trading is you want to cut your losers quickly and you want to let your winners run. And this is simply a very consistent mathematical way that I attempt to do that in my own trading. I obviously have different ways to maximize my entries and exits. There's a lot of time where I use this as a longer term trend identifier and I'm trading faster reciprocations inside of it. Sometimes, I also, measure the average time it stays above and below this band by calculating the absolute value of this band relative to this one, and then it gives me a nice reciprocated one. And I can start saying things like, well, this thing will last about 100 bars in general, and this has lasted, 250 or whatever. So somewhere around here is probably where it starts to get old, and I can trade a counter trend, or however I'm going to do it. I use this sort of idea in numerous ways, and I'm not the only one who does this. This is a idea behind a lot of indicators in one way or another, where you're looking at changes in momentum over time across different time frames. So if this sounds interesting, I suggest you experiment with it on your own tickers and time frames to see how it performs for you in back testing and forward testing. I personally like this for selling options, because in the way that I do it, a lot of times it burns a good amount of time, even if it's going to stop you out, and then stops you out pretty close to where it got you in. You know what I mean? So if you're short an option and you have enough theta decay, this trade, even though you lost because of price, could very much have ended up as a small winner or a scratch or break even. And then in that case, when it does run, I can really milk that short option as much as I want. So it breaks down there, and if you got in there, that's a pretty good swing on a short option. You would have roasted a lot of the premium. So that's how I use it a lot. And I don't use this specific band setting. I have a slightly augmented one that kind of has a lot more relatively built into it, and it runs off a stochastic, but it's the same sort of idea. Thank you for watching the video on the triple Bollinger Band trading strategy. We hope you found the information helpful and insightful, and if you have any questions or feedback, please leave them in the comment section below. We'll be happy to get back to you as quickly as we can. And if you enjoyed the video and you want to see more like it, please consider liking and subscribing to our channel. By doing so, you'll stay updated on our latest trading strategies and tips, helping you become a more successful trader and investor. Remember, trading is a constant learning process, and we're here to help you every step of the way. So don't forget to hit the like button and subscribe to the channel. And I'll check you in the next video. You have a great night.